So welcome to the session, paper number 10, corporate accounting and audit, where 50 marks is for your corporate accounting. And let us start. And in the first half, now let us try to complete all the 1.1. Issue of shares, forfeiture of shares, of course, plus reissue of shares, and then rights and bonus issue, sweat equity shares, Esops, and buyback. Yes, all these things we have to complete now itself. So let us start. So first, issue of shares. Hope you are having a very great idea on issue of shares, and of course it's a very easiest thing also. So I'm not going into the details of legal aspects. I mean to tell, the whole share price has to be collected just within 12 months. Whatever the amount that is received on application by the company has to be banked in a separate bank account. That cannot be used by the company till the shares were allotted. I'm not going to deal with all these things. Of course, 2 points, Cheppesa. But I'm not going into the legal aspects of all these things, because our main intention is to revise the whole concept just in a span of 8 hours. And also here our main intention is on the focus of your examination. We are going to deal what are the elements that were needed for the examination. So I'm not going to deal with all the legal aspects in any of the chapters. I'm going to deal what will be the special points in your problematics, and what is the overall topic all about, and format journal entries and ledger accounts as and when needed. Okay, so let me start with the first chapter, that is issue of shares. The first stage of share is nothing but application. The next stage is nothing but allotment, and next you have to participate, and next is all about calls. It might be the first call, second call, third call, whatever. Of course, finally last call, or we will be calling it as final call. In the first stage, company is going to ask the public to pay the money for the subscription of the shares. So if the public had given money, then we will be writing a journal entry like bank account debtor to equity share application account. And you have to check out, very, very important, whether you have to got minimum subscription or not. That is nothing but, yes, 90% of issued share capital. And after checking out to that one, immediately equity share application, whatever is there, will be converted into equity share capital. That is equity share application account debtor to equity share capital account. This is the first part. That is like application part. Now the second part. From the second part, first of all you have to capitalize, and then you have to receive the amount. In the first part you have to receive the amount, and then you have to capitalize. Reason being, you don't know whether the issue will be subscribed or not, whether the issue will be successful or not, and hence first of all issue the shares to public. Let the public subscribe the shares by giving the application money to the company, and then company will be allotting the shares to the public. So to make it as a successful subscription, listen carefully, to make it as a successful subscription, two things are needed. Public apply to the company, company allot the shares. What are the two things? Public apply to the company, and company allot the shares. Clear? So it is all about first part. So now in first part what happened? Public applied to the company, sir. In the second part what happened? Now the company is allotting the shares, sir. So let the company allot the shares. First of all it has to capitalize or receive money. Capitalize. So what is the journal entry? Equity share allotment account debtor to equity share capital account, and next one, get the money. Bank account debtor to equity share allotment account. Clear everybody? Sir, generally in the first two stages there will be no forfeitures. Yes, in the first two stages, that is at the time of application and allotment, there will be no forfeitures. Of course, at the time of application, forfeiture itself is not there, because it is your wish to purchase. But if you are subscribing a share just by paying application money, if you are subscribing a share by paying application money, it means that you have promised to the company, that you will be paying all the further part of share capital as and when called by the company. Say for example, the face value of the share is rupees 10 and application is rupees 2, allotment is rupees 2 and remaining 6 rupees is the first and final call. So now if at all company, if at all the public are paying to the company an application money, so they are promising that as and when you call the remaining amount, we will pay you. Did you get my point? Public are promising the company as and when you call the money, we will pay you. So that is a concept of your subscribing a share. At the time of subscription, enough of paying dash amount. Participate, you have to quick. Sir, మీరు ఎంత క్విక్ గా ఉంటే అంత ఫాస్ట్ గా రివిజన్ అవుతుంది. మీరు ఒకవేళ అలా గనక చేయకపోతే at the end you will be left with the topics that were uncovered. I don't want to do that. So I want to cover every topic. So you have to participate. ఖచ్చితంగా. I'll tell you only one simple reason. With a small number of students or with a small strength, class interesting గా ఉండదేమో, నిద్ర వస్తుందేమో, అన్ని సెకండరీ. We don't bother whether at least one is there in the class or not. That's it. So participate and be very quick about responding to the answers. Fine. So whenever public are paying the application money, they are promising that they will pay all the remaining money, allotment and first call money. Pakka everybody. And in this connection, there is another capital called reserve capital. In this connection, there is another capital called reserve capital. So please take care. Till now we have taught about stages. What is the first stage? Next stage? Next stage? Calls might be either first call, second call, till it will be final call. Pakka everybody. And now moving on to the next thing, listen very, very carefully. We are going with classification of capital. We are going with which capital? Not types of capital, classification of capital. Sir, then what do you mean by types of capital? Types of capital is nothing but equity share capital and preference share capital. How many types of capital are there for us? What are those two types, Amma? Equity share capital, preference share capital. And coming to classification of capital, number 1, authorized share capital. Number 2, issued share capital. Number 3, subscribed capital. Of course, in between these two things, you will be having called up capital, and finally you will be having reserve capital. Sir, I would like to cover these things because you may get a 2 marks question or you may get a 4 marks question, especially on this one, reserve capital. So be careful. Authorized share capital is that capital which is specified in memorandum of association, that too in capital clause. During the lifetime of the company, how much capital that is required to the company, it has to estimate and it has to give the same. Likewise, till now you did not complete your examination at all. You seriously don't know when the examination date will be. Postpone. But we are asking you, hey, can you guess how many marks that you can get in your paper 1? Can you guess, can we ask you guess your marks in paper 10? Yes or no? Yes, we can ask. And you can tell also, basing on your preparation. They respond, am I correct or wrong? In the same way, before starting of your business, depending upon the size of the business and depending upon the expansion of the business, a business can think, how much capital do I need during my lifetime? It is thinking like 10 lakhs shares of rupees 10 each. Then it needs 1 crore during its lifetime. So say for example, all the total 1 crore is called now. All the total 1 crore is called by the company, it is paid by the paid by the public, and the shares were totally allotted. Now the biggest point, that company want another 20 lakhs. So now what it has to do, sir? Alteration of MOA. And this alteration of MOA, this part you will be learning in law. So now moving on to the next thing, issued share capital. Out of 10 lakh shares, as of now, company would like to get 2 lakh shares at the rate rupees 10 each. So which is nothing but issued share capital, which is nothing but 20 lakhs. And subscribed capital. Say for example, out of this 2 lakhs, 1,80,000 equity shares. 1 lakh equity shares at the rate rupees 10 each were subscribed. Clear everybody? Which is nothing but 18 lakhs. Out of this 10 rupees, company is calling 1.8 lakh at the rate rupees 2. Or let me tell rupees 7. How much is called by the company? 7. So how much it comes to? Even I don't know, because I have learnt only up to 12 into 12. 12 lakhs. 12 lakh 60,000 is the total called up capital, of which one of the shareholder did not pay 60,000 rupees. So this is nothing but calls in arrears, and finally you will be left with an amount of 12 lakhs, which is nothing but your paid up capital. This is very important slot. This discussion is very important. Again, you are going to get the same in preparation of financial statements. Take care. So paid up capital is equal to dash minus dash. Called up capital minus calls in arrears. Hey, everybody respond. What is paid up capital? Called up capital minus calls in arrears. Perfect, everybody. This is what paid up capital. And in your balance sheet, or the terminology is all about issued, subscribed and paid up capital. Did you ever observe that in our balance sheets we will not post authorized separately, issued separately, subscribed separately and paid up separately? We will be posting only number 1, authorized share capital, number 2, issued, subscribed and paid up capital. Sir, we have understood that authorized share capital as per our example is like 1 crore. Issued we got 20 lakhs, subscribed we got 18 lakhs, paid up we got only 12 lakhs. So these three things are three different items and different amounts you are having. Then why this is called as issued, subscribed and paid up capital? Because whatever is paid, subscribed, whatever is paid is also issued. I hope you have got my logic. Whatever is paid is obviously subscribed. Whatever is paid is also issued. This 12 lakhs is a part of 20 lakhs. Will you admit or not? This 12 lakhs is a part of 18 lakhs. Will you admit or not? And that is the reason we are writing like issued, subscribed and paid up capital. It doesn't mean that issued is separate, subscribed is separate, paid up is separate. So what we have to write? Whatever is paid up is issued. Whatever is paid up is subscribed. Pakka, everybody. And now very important discussion. Dividend will be paid on. Dividend will be paid on dash capital. Will it be paid on? Of course, dividend will be paid either on equity shares or preference shares. My question is all about, will it be paid on authorized capital, issued capital, subscribed capital, called up capital, paid up capital or face value? Dividend will be generally paid on paid up capital. Exception, if there is a clause in articles of association that dividend will be paid on face value, then dividend will be computed and paid on face value, because you may get the same for bits. So take care. Dividend will be generally paid on which capital? But exception, if there is a clause in EAOA, then dividend can be even paid on face value. How to find paid up capital? Dash minus dash. Called up capital minus calls in arrears. Pakka, everybody? Moving on to the next thing, we have discussed about all these things: authorized, issued, subscribed, called up, paid up, and finally reserve capital. My dear children, there is a hard difference between capital reserve and reserve capital. Capital reserve means it is a reserves and surplus, which includes capital profits. Likewise, say for example, you have purchased an asset for 1 lakh. What is the cost price of your asset, Amma? And you have sold this asset. Cost price is 1 lakh and you have sold it at 1,20,000. How much is the profit you have got? Over and above cost price. Over and above cost price, which is called as capital profit, and it has to be transferred to capital reserve. Do you have accounting standard number 12? Government grants. Okay. So in that government grants, you will be having a point like, so you will be having a point something like a capital grant received by the government. Did you remember? If there is a capital grant which is received by the government, it is a capital profit which has to be transferred to capital reserve. And also, if you have remembered the next topic, we are going to deal the same forfeiture of shares. If the forfeited shares are reissued and if we are still with profit, and that profit is also capital profit which will be transferred to capital reserve. Pakka, everybody? So capital reserve includes dash profits. Capital profits. Reserve capital include dash profits. Reserve capital does not include profits at all. Getting my point, everybody? No, not P&L profits. Reserve capital is something like, listen very carefully, my dear children. Reserve capital is something like some portion of face value of shares or reserved for the time of liquidation. Did you get my point? Say for example, what is the face value of a share? Now company has decided to call only 9 rupees throughout its lifetime. Throughout the lifetime of the company has decided that it will be calling only how much amount? Still there is how many rupees pending. This 1 rupee wantedly company is not calling the amount. This will be called at the time of liquidation, because at the time of liquidation company may have short of funds. With that short funds it may not settle all the liability holders, due to which automatically sale of assets and settlement of liability. Very much point, everybody. So that is a concept of reserve capital. Reserve capital will be called by the company only at the time of liquidation. Pakka. Now the next one. Company can call a share either at its face value or along with premium or even along with discount. But discount is not available to outsiders. There are special conditions as per section 53 of Companies Act 2013. And now coming to this one. Whatever the stage of premium is there, it has to be collected only at once. It has to be collected only at once. So face value, one part can be application, one part can be allotment, one part can be first call, like that. But premium cannot be separated. Premium cannot be. Whole premium has to be called only with one stage. Then generally premium will be collected along with allotment. Generally premium will be collected along with. But if you want, premium can also be collected along with application money. Pakka, everybody. So that is a whole concept of your what is that, issue of shares. And of course still there is issue of shares with respect to discount, that we will be learning in sweat equity shares. So as of now I am just keeping that part pending. Whenever we have completed sweat equity shares, that part will be completed. Now let me go further into the concept of reissue of shares. So what do you mean by reissue of shares? But before reissue, first of all you have to complete forfeiture of shares. Remember, a fully paid up share can never be forfeited. A fully paid up share can never be forfeited. There are two kinds of shares in respect to this forfeiture. Number one is surrender of shares. Number two is forfeiture of shares. Hey, what is the difference between forfeiture and surrender? So say for example, you have caught into the classroom by using the mobile phone. Okay. I have forcibly thrown you out of my class. Forfeiture. Voluntarily you got headache while listening to my class. You told like I will go out and I have permitted you, which is nothing but surrender. Clear? Something like a shareholder is coming to you and a shareholder is surrendering his share, stating that, sir, I cannot pay the remaining uncalled amount. I cannot pay the remaining uncalled amount, and hence voluntarily I am surrendering my share to the company. Clear, everybody? And coming to forfeiture, we have identified those shareholders who are still unpaid. Even though we are calling them, they are not paying, and hence we have forcibly forfeited their share. Coming to the accounting treatment, whether it is surrendered or forfeiture, you will be using the word only forfeiture of share. There is no surrender of share separately. There is a concept surrender of shares. A shareholder can surrender his share voluntarily, but accounting treatment will be considered only with respect to the concept of forfeiture of shares. There is no concept with respect to surrender of shares. Pakka, everybody? So now coming to the concept of forfeiture of shares, how to write the entry. Listen. So, sir, at the time of issue, what is the entry you will be writing? Bank account debtor to equity share application account, and equity share application account debtor to equity share capital account. And also I told you at this time there is no concept of forfeiture. Also, my dear children, generally there will be no concept of forfeiture and unpaid amounts at the time of allotment. Because if you are not paying the allotment money, company will not allot a share to you. Correct or wrong? If you are not paying the allotment money, company will not allot a share to you. So automatically it will become something like equity share allotment account debtor to equity share capital account, and then bank account debtor to equity share allotment account. With these things we will not get a concept of forfeiture at all. Forfeiture generally starts only from first call. Yes, calls. So what is the journal entry? Equity share first call account debtor to equity share capital account. All the remaining amount was called. But unluckily we did not receive the amount. Bank account debtor to equity share first call, I did not receive. Clear, everybody? Even I did not write calls and arrears entry. So now I have forfeited. Did you get my point? We have forfeited before writing calls in arrears entry. Before writing, we have forfeited. So at the time of forfeiture, sir, we are cancelling the share capital. Will you admit or not? Chapali. And hence share capital has to be debited because share capital is having which balance? Credit balance. So to cancel that share, it has to be. So what is the journal entry? Equity share capital account debtor. It has to be debited with total called up capital. Clear everybody? It has to be debited with total. So I told you already that, say for example, application 2 rupees, allotment 2 rupees and first call is all the remaining 6 rupees. So how much is called in our example? Total face value is called and hence you will be debiting the same with 10 rupees. And 2. Remember, don't forget and never forget. Forfeiture of shares include amount paid up. Forfeiture of shares includes amount paid up. అదే నేను చెప్తుంది. Forfeiture of shares includes amount paid up. Sir, getting my point everybody? Forfeiture of shares always includes only amount paid up. So, how much amount is paid by our shareholder amma? 2 plus 2, 4. This paid up portion will be credited to forfeiture of shares account. Pakka. And whatever is the uncalled amount, unpaid amount, 6 rupees. As of now, you did not pass calls in arrears entry. Am I correct or wrong? And hence, this account is having debit balance. So, to close this one, it has to be credited. Something like to equity share final call account. Rayachu. Gap is the next. Is the concept clear? Pakka. Now, the next one. If at all you have already passed calls in arrears journal entry, then you will be writing an entry like calls in arrears account debtor to equity share final call account, and already this account gets cancelled. So now this account is still open and whatever is debited, now it has to be credited and hence you have to close. Clear everybody? Forfeiture of shares include only dash amount. Paid up portion. Unpaid portion will be credited either to calls account if at all calls in arrears entry did not pass. If calls in arrears entry was passed, then you have to credit the same to calls in arrears. Pakka. Because all these things you're going to get in bits. This may not be important for problematic at all. Because generally in problematic, that is what we will write the entries. If you write calls in arrears entry, you will be crediting calls in arrears entry. But you will be getting a bit like, he will be giving all the nonsense stuff. And he will be giving that company had passed the forfeiture entry before passing the calls in arrears journal entry. Then it has to be credited to respective call account. It has to be credited to respective call account. Pakka everybody. Now, however, this forfeited shares, company is having two options. Number one, company can cancel the shares. Clear? And number two, company can reissue the shares. Generally, company will follow this option will not be followed. And one more thing, securities premium can never be forfeited. Securities premium can never be forfeited. Because once if the premium is into the company, you can utilize securities premium only as per section 52 of Companies Act 2013. Babu, take it. Securities premium can never be forfeited. Securities premium has to be utilized only as per section 52 of Companies Act 2013, and in section 52 of Companies Act 2013 there is no clause for at the time of forfeiture of shares. So securities premium cannot be used for the purpose of forfeiture. Pakka. Okay. Now company will be generally reissuing the share. At what price reissue will be done? General rule, reissue will be done always at a discounted price. Pakka everybody? Reissue will be generally done only at a discounted price. Of course, if it wants, it can issue even at face value or at premium also. But generally, it will be done only at a discounted price. Then how much maximum discount that a share can bear, sir? Maximum discount is nothing but forfeiture of shares. Clear everybody? Sir, what is the face value of a share? As of now, how much amount is paid by our shareholder? How much amount did not pay? This is additional benefit, remember, okay? Because with this additional benefit, now we are reissuing the share. Now that share can be reissued. If you want, you can issue at 10 rupees. That is face value. If you want, you can issue even at greater than 10 rupees, which is nothing but your securities premium. And if you want, you can issue even at less than 10 rupees also. but maximum discount can be amount forfeited. That is 10 rupees minus 4 rupees, which is nothing but 6 rupees. Which is your minimum reissue price? Minimum reissue price. Less than that, it is not possible. Correct or wrong? Say for example, company has decided to issue the share at rupees 8. Possible or not possible? Check out. How much is the total face value? 10. What is the issue price? 8. What is the discount? 2. What is the maximum discount we can go for? 4. So this is permitted. Company would like to issue the share for rupees 3. How much is the loss you have got? 7. But what is amount forfeited? So since your 7 is more than rupees 4, this kind of issue is not at all permitted. Pakka everybody? So whatever amount forfeited, it will be your maximum discount or maximum loss. Perfect everybody? Now the next concept, further move on reissue of shares. In our example, how much is the face value? What is the forfeited amount? What is the new price? This is called as minimum reissue. But company is reissuing the same at rupees 8. Company is reissuing the same at rupees 8. How much is the total discount you have got? That 2 rupees you can use for feature of share. How sir? Bank account debtor, I am getting 8 rupees. To equity share capital account, but I am giving 10 rupees share to you. Discount how much is there sir? 2 rupees. See, already you have credited for feature of share with rupees 4. Now you have to debit the same. For feature of shares account debtor rupees 2. Clear everybody? And now moving on to the next thing. Listen very very carefully. So at this context, what is the total forfeiture you are having? You have reissued that share with a maximum discount of rupees 2. So still you were left with a profit of rupees, which is a capital profit which has to be transferred to capital reserve. So the journal entry will be forfeiture of shares account debtor to capital reserve rupees 2. Pakka. So now I'll ask you one final example on this context. Say for example, there are 10 shares. There are how many shares? 10 shares. Forfeited. Same face value 10 rupees. Paid a portion 4 rupees. Called a portion 10 rupees. Clear? And reissue of shares were only 6 shares. And reissue price at rupees 7. Clear everybody? Now my question, how much will be the profit on reissue? React quick, hold your calculators or use your sense. Compute cheyandi, answer cheppandi. $50. I want total. Total profit on reissue is equal to dash 50. Okay, 15. Inka. They make it quick. 10. Next. For 10 shares, you have got 4. 6 rupees is automatically your loss here. Reissue of shares, we have reissued only 6 shares. The reissue price is rupees 7. Fine. Let me deal with the same. Or yeah, take time and tell the answer. 8 rupees. Fine, let me start and listen carefully, everybody. Sir, if you check out, listen very very carefully. How many shares are reissued? 6 shares. Remember this one, okay? And how much is amount forfeited? 4. And reissue of shares. Shares were reissued at 7 rupees. So how much is the loss you are having? 3. So loss on reissue of shares is equal to 3. And forfeiture of shares is equal to 4. If you set off these two things, how much will be your profit on reissue? 1 rupee per share. 1 rupee per share. Remember my dear children, you have to close forfeiture of shares account only for the reissued shares. So what is profit on reissue per share? Multiplied by 10 shares, 6 shares. That is very important because only reissued portion has to be considered. So 1 into 6, which is nothing but 6, and your profit on reissue is 6 rupees, not 8, not 10, not 15. Now one more thing, in this context, sir, all the shares were reissued or still forfeited shares are there? And hence you will be having balance of forfeiture shares. How much balance of forfeited shares you will be having, sir? Sir, totally you are having 4 shares. Multiplied by how much is forfeited? 4. So you will be having 16 rupees. Clear everybody? So that is your whole concept, and be careful. Pakka? Why you are thinking about securities premium? There is no premium at all here. Indulona. Asal avasarame ledu. If you take like that, then reissue price, let it be rupees 11. Okay, then what the journal entry will become? Bank account at top, 6 shares multiplied by 11 rupees you are getting. To equity share capital, 6 shares multiplied by 10. To securities premium, 6 into 1. This part clear kada? Next, forfeited of shares. How much forfeiture of shares now you are having? There is no loss on reissue because shares are issued at premium. If the shares are issued at discount, then you will be having that. But if the shares are issued at premium, there is no loss. So entire 4 is your profit on reissue multiplied by 6 shares, which comes to 24 rupees directly. Clear? Which will be directly transferred to capital reserve. Pakka? And last, I'm about to close this issue, reissue and forfeiture with the concepts of types of allotments. Types of allotments. Number 1, full allotted or over allotments or under allotments. If the shares were fully allotted, in the sense, if you have issued 1 lakh shares, public have exactly subscribed for 1 lakh shares. If it is under allotment, it is something like if you have issued for 1 lakh shares, public had subscribed for less than 1 lakh shares. In this context, you have to check out whether you have got minimum subscription or not, and then you have to proceed further for the issue practically. And if it is over allotment, you are having 2 parts. First in, first out. Say for example, you have got 1 lakh shares, and issued 1 lakh shares, 1,20,000 shares were allotted by the public. Applied by the public, not allotted. So whenever, sir, I can use the term allotted and allotted here. Because 1 lakh applied and immediately allot. Less than 1 lakh shares applied by the public and minimum subscription is there, then company will allot. But even though I have issued 1 lakh shares, I cannot allot 1,20,000. Reason being, my maximum allotment will be only for 1 lakh. Anyways, so FIFO, whoever had applied first, they will be allotted and all the remaining will be refunded. Clear everybody? Or the, what is it called? Pro rata allotment. Famous concept is nothing but pro rata allotment. So pro rata allotment is all about, they will be giving one, what is that called? One protocol for subscription of the shares. For the first 10,000 shares, we will allot in full. For the next 50,000 shares, we will allot in the ratio 1:2. For the remaining shares, we will allot the remaining. So like that, they will be giving one protocol for pro rata allotment. And nowadays, practically what happens, it is just like drawing in lots. Say for example, company is issuing 10 crores equity shares. And there will be hard number of public who are applying for the same. So what they are going to do? They are going to put one arbitrage. Something like, it is just drawing in lots. Odd lots pictures tar antar kada. Likewise, randomly. It's like a lucky draw. It's just like a lucky draw. Clear everybody? Anyways, so that is the final concept of your issue of shares, reissue of shares and forfeiture of shares. Be careful at the time of pro rata allotment because you will be tested pro rata allotment, shares forfeited and reissue of shares. Pro rata allotment in the sense, if at all, say for example 1 lakh shares are issued, first for the first 10,000 shares, you just draft one table. For the remaining 50,000 shares, you just draft another table. For the remaining shares, 60 and 40,000 shares, you just draft another table. Say for example, what is it called? Number of shares applied, number of shares applied, number of shares applied, and check out number of shares to be allotted. And then you just have to continue with all your computations. What are all your computations you have to do? As simple as such, application money received. Application money received. Check out how much you have got application money minus application money needed. Say for example, you have received 1 lakh, but needed is only 60,000. So excess is 40,000. This is excess, which will be adjusted against the equity share allotment. Clear everybody? But check out again, say for example, equity share allotment is only 30,000. Then automatically 10,000 will be again adjusted against the first call. Clear everybody? So now your journal entry will be equity share application account debtor, bank account debtor to equity share application, and equity share application account debtor totally you have to close to equity share capital account only with application money, and remaining you have to check out to which stages you are transferring the same, either to equity share allotment or to equity share first call or second call or your final call. Pakka everybody? That is the end of your first part. Issue of shares, forfeiture of shares, reissue of shares. Clear everybody? So just have a span of 2 to 3 minutes, and then we are going to start the concept of rights issue and bonus issue. So in this context, the important is about, of course, you will be getting forfeiture, and of course, you will be getting reissue, and of course, you will be getting pro rata allotment. Pro rata allotment is not at all difficult. Just follow this format. You will be getting it very easily. If at all application money is perfectly all right, then start your table with allotment money. Allotment money received, allotment money needed. Excess which will be adjusted against the calls money, first call or second call. Be careful. Let's start. Okay. Take care. And moving on to the next concept, that's all about rights issue. My dear children, there kinds of public offers are two. Number one, IPO. Number two, FPO. What is IPO? What is FPO? No, it's not further. It's follow on public offer. But generally people will tell it is further public offer, and which is like common language, but something like it is follow on public offer. Follow on. What do you mean by follow on? Already initial is done, and you just following that same, you are having another public offer. So which is called a follow on public offer. And now moving on to the next thing, listen very, very carefully. Now companies in need of money. Company wants rupees 10 lakhs. Company has decided to get this 10 lakhs only through capital, but not through loans. If company has decided to get through loans, it can go for bank loans, or it can go for debentures, bonds, etc. and etc. But this time company has decided to get the money only from the capital, share capital. Now, what are the options that are available for the company? Number 1, FPO. Number 2, rights issue. What is public offer, sir? First of all, public offer to the large public, we are offering at once. Whoever wants, they can apply, they can subscribe. But coming to the concept of rights, rights issue will be given only to the existing equity shareholders. Rights issue will be given only to the existing equity shareholders, and take care, it will be given only to the existing equity shareholders at a discounted market price or at a concessional price. My dear children, at the top notch, I told you something like issue of shares either at face value, premium or discount. That is different. That is discount from the face value. Say if the share is rupees 10, would like to issue at a discount of rupees 2 and would like to get only rupees 8. This is issue of shares at a discount. But here, not discount, it is discounted market price. See, say for example, market price is trading at rupees 80. But we have issued, say for example, only for rupees 70, which is obviously a kind of tempting offer. So, your aim is to issue shares only to whom? Existing equity shareholders. So you have given an offer like to existing equity shareholders. Hey, you all equity shareholders, if you want, you can purchase and subscribe a share with the company where I am giving you each and every share at rupees 80. Then nobody shows interest, because if they want, they will go to the market and they will purchase the share at rupees 80. What point is there to purchase from you? No, nothing. So it has to be made a kind of attractive offer, a lucrative offer, a tempting offer, for which it has to give it at a discounted market price, or which is commonly called as concessional price. Clear, everybody? In this context, now we are going to learn two things. Number 1, which is for company. Number 2, which is for shareholders. Sir, who is giving rights to? Company is giving rights to shareholders at free of cost. Yes, company had given rights, not right shares. Right is given to shareholders at free of cost. Now I have given you a right. Hey, take right. What can I do with that right, sir? You are having 3 options. If you want, you can subscribe. If you want, you can renounce. If you want, you can ignore. Subscribing is nothing but purchasing. Renouncing is nothing but selling. Ignore in the sense ignored. Neither subscribe nor renounce is nothing but ignored. Technical words are subscribing and renouncing, which is like purchase and sale. Sir, what will we purchase? You will purchase a right share. What will we sell? You will sell a right. Not share, said right. Company had given you a right. Now you are holding a right. If you want, come to the company and subscribe and purchase for a right share by paying issue price. By paying which price? Which is nothing but rights price. In our example, what is the share price, market price, amma? What is the offer price, amma? 70. Am I correct or wrong? So you come to the company, pay rupees 70 and take a right share. Pakka. And now coming to the second option, renouncing. Sir, what company had given you? Right. Now are you holding right or right share? Right. So what can you sell? Right. You cannot sell right share because you did not subscribe yet. Logic clear, huh? Company had given me a right. I am holding a right. If I want, I can convert this right into right share by going to the company and by paying the rights price. Second option. If I don't want, I can sell this right to an outsider. I can sell this right to an outsider. At what price, sir? At value of a right. At what price, amma? Value of a right. Then what is value of a right, sir? Value of a right is nothing but cum rights price minus theoretical x rights price. What is value of a right, amma? Cum rights price minus theoretical x rights price. Cum rights price will be given in the question. Theoretical x right price, you have to find it. See, don't see that theoretical x right price is a formula. It is an average price. Theoretical ex-right price is nothing but an average price. Say for example, listen very, very carefully. Originally you are having 100 equity shares trading at a price of rupees 120. Now company had given an offer like 1:2. What is the offer? So how many shares that do each and every one will get? 50 equity shares. Now offered this at rupees 90. Okay. Theoretical ex-right price is nothing but average price 100 into 120 plus 50 into 90 divided by 100 plus 50. That is what your theoretical ex-rights price. But they will logically put it into a formula. And that formula is nothing but original number of shares. That is like number of shares trading on cum rights prices multiplied by cum rights price. Getting my point, everybody? How many original number of shares are there? Cum rights price, how much is given? 120. Clear, everybody? Plus right shares into rights price. How many are right shares? What is rights price? Whole divided by total number of shares including the right shares. That is like 100 plus 50. So if you see that, it is like a very common sense note like average price. 100 into 120 plus 50 into 90 divided by 100 plus 50. How much it comes to? 110. 110 per share, which is nothing but theoretical ex-rights price. Pakka? Hey, respond understood. So tell me how to compute theoretical ex-right price. Dash into dash plus dash into dash by dash plus dash. See? Original number of shares multiplied by cum rights price. Yes, you can use market price, but better to use cum rights price because that market price is what? Cum rights price plus right shares multiplied by rights price divided by original shares plus right shares. Yes, you can write this formula, nothing great. And as it is not needed to write the same formula what is given here. What is given? Nothing is given. Then it is super. But generally your teachers will be telling you a formula, but you can comfortably use this terminology, nothing great. Original shares multiplied by cum rights price plus right shares multiplied by right price divided by original shares plus right shares. Hey, in this I would like to tell you a catch. Listen very, very, very carefully. Value of a right is equal to dash minus dash. Cum rights price minus X rights price. What is cum rights price? 120. What is the X rights price you have computed? 110. How much you have got? Per share. No, it's per share. Because value of a right is equal to 120 minus 110 is equal to 10 per share. Clear, everybody? Because how many shares you have considered here? Hey, in this price, 120 is the price of one share. Correct or wrong? 110 is the price of one share. So 120 minus 10 is equal to 10 for one share. Clear? Hey, but take care. What is the rights ratio given? It means that for every 2 shares, 1 is the right. Hey, what is the meaning of 1:2? For every 2 shares, 1 is the right. Which means that, my dear children, value of a right is equal to 10 per share. But in our ratio, 2 shares includes 1 right. Correct or wrong? So 10 per share multiplied by 2 shares is equal to rupees 20 for 2 shares. Yes or no? That is nothing but rupees 20 per right. Logic clear? That is what value of a right. Now a shareholder can renounce his share, his right at value of a right, which is 20 per right. Clear, everybody? Pakka? So take care. I'm just concluding the same. How many options that are there to a shareholder? What is the option number 1? Subscribe. Very, very simple. Shareholder is having dash. That right is converted into right share by subscribing at which price? Rights price. Part 1 is completed. Part 2. What is part 2? Renouncing right or right share. Right. At what price? Value of a right. At what price? Value of a right is equal to dash minus dash. Cum rights price minus X rights price. If you have done this, you will get value of a right per share. Clear, everybody? Then you will be multiply it with number of shares, then you will be getting value of a right per right. So here you are selling right as share. So you have to sell it at value of a right per right. Say for example, you have got something like this. Value of a right is equal to cum rights price minus x rights price, which is nothing but 110 minus 70. So how much you have got? 40 rupees is per share. Now given that right ratio is equal to 1:3. So 40 per share multiplied by 3 shares, then you will be getting 120 for 3 shares, which is nothing but 120 per right. Perfect, everybody. Yes, you are having all those concepts. Just this one problem is counting for all those things. Pakka, everybody. So that is a concept which is something like your rights in the books of shareholder. But rights issue is done by whom? Company. Correct or wrong? So what is the entry you have to write in the company's books of accounts? Listen, at the time of subscribing you will be getting an entry, but whenever a shareholder has renounced, you will not get an entry in the books of company. Will you admit or not? Because company had given a right to you. You are selling it to another person. If you are selling it to another person, you are receiving the amount and you are paying the amount. Then write the journal entry either in your books or in their books. Getting my point, everybody? Company had given a right to A is selling his right to B. So write an entry in the books of A and write an entry in the books of B. That part is not at all necessary for the company. So then what do you need for the company, sir? If A is coming to the company and if A is subscribing, company is getting the money. If A has renounced his right to B, now who is holding the right? B. Now B will come to the company and he will subscribe. So anyways, company is not at all under the loss. Either A will come to the company. If not A, then automatically B will be coming to the company. And at any cost, company is getting the final amount. So what is the entry? Of course, cash 2, equity share capital, yes, and finally 2, securities premium. Say for example, in our example, we have taught something like rights were done somewhere at 90, right? 120, 90, I guess. This example, amma. 90, sir. You have computed kada. So you have given each and every share at rupees 90. You got 90. Face value 10. So securities premium is nothing but 80. Perfect, everybody. That's the end of the concept of rights issue. So rights issue, take care. You are having only 3 things to find out. Number 1, theoretical X rights price. Theoretical X right price is nothing but original shares multiplied by cum rights price plus right shares multiplied by rights price divided by original shares plus right shares. And remember, if you did not remember this formula, nothing great at all. Take original shares. One price will be given in the company. Multiply it with that price. Clear? One price will be given for sure. Multiply it with that price. And you can identify what are right shares and you can identify what is the right price. Divided by total number of shares, which is nothing but an average price. And value of a right is equal to cum right price minus theoretical X rights price multiplied by number of shares. Pakka, everybody. And finally, entry in the books of company like bank account debtor 2, equity share capital account 2, securities premium account. There ends with rights issue. So till now the main concepts that were covered. Number 1, yes, main concepts I'm telling from the examination point of view. Forfeiture of shares plus reissue of shares, again with pro rata allotment. Be careful with the table of pro rata allotment. Of course, I told pro rata allotment table only one part, but that one part counts a lot. Application money received, application money needed, excess adjusted. If application is absolutely equal, start from allotment. Allotment money received, allotment money needed, excess adjusted towards calls. Clear, everybody? So that is what your pro rata allotment. And for pro rata allotment, for different classes, open different tables. I mean different columns. Clear, everybody? Don't put all the shares just in one column. For different what is it called, pro rata allotments, open different columns. That is what the first one. And second one, coming to rights issue. Rights issue, you have to be careful at theoretical X rights price, and then you have to be careful at value of a right. Clear, everybody? this or the main concept. Just get ready. We are going to start with the next concept. That's all about bonus issue. Next concept is all about bonus issue. Remember, there are two kinds of bonus issues. Number one, fully paid up bonus shares. No, it should be something like conversion of partly paid up into fully paid up. You cannot tell it as partly paid up shares. You have to tell partly paid up into fully paid up. You cannot tell partly paid up. Next one. So coming to fully paid up bonus shares, listen very, very carefully. Shares, fully paid up bonus shares can be given only to fully paid up equity shares. Listen, likewise, rights issue can be given only to the existing equity shareholders at a discounted market price. Bonus issue is also will be given only to the existing equity shareholders at free of cost. What is the journal entry we will be writing? Bank account debtor to equity share capital. Can I tell like this or not? Yes or no? If no, what is the entry you will tell? Normally I will be writing an entry. Normally, in the sense, it's a general issue. For a general issue, you will be writing something like bank account debtor to equity share capital account. But now you are not getting dash. Cash, bank, okay, cash or bank, you are not getting the same, and hence instead of that you have to use reserves and surplus. What you have to use? That is nothing but your bonus issue. For bonus issue, dash is used. Reserves and surplus. There are two kinds of bonus shares. What are those two kinds of bonus shares? Fully paid up bonus shares, conversion of partly paid up into fully paid up. What do you mean by fully paid up bonus share? Company will be giving a total share as a bonus to you. What do you mean by conversion of partly paid up into fully paid up? Already company might be having some existing number of shares which are partly called and partly paid up, and hence company would like to convert those partly called and partly paid up into fully paid up. Say for example, company is having 1 lakh equity shares at the rate rupees 10 face value, but only rupees 8 paid up. So how much is the unpaid amount now? Since it is uncalled, so company is telling to all the shareholders, you all shareholders no need to worry. Whatever the 2 rupees unpaid and uncalled amount is there, now we are declaring it as a bonus. So you shareholders no need to pay the amount. We being company directly giving it to you as a bonus. Clear everybody? This is the first part. And second part, say for example, company is having 1 lakh equity shares at the rate rupees 10 each, fully paid up. Company is telling, hey, you all shareholders, we are giving you some extra shares. No need to pay any amount, which is totally free of cost. Clear everybody? Here you are having a ratio for sure. Here you may not have a ratio. Clear everybody? Here why you will not be having ratio in the sense, for each and every share 2 rupees is paid up. Right, but you can find a ratio here. For every rupees 8 paid up, 2 is the bonus. Correct or wrong? So the ratio is nothing but 2:8. But no need of ratio at this stage. That is what I am telling. You can find a ratio, but that ratio is not at all needed. Respond clear? But coming to this stage, you need a ratio for sure. Company is telling something like, you all shareholders, we are giving you bonus shares in the ratio 1:4. What do you mean by 1:4? For every 4 shares, 1 is the bonus. So something like 1 lakh into 1/4, which is nothing but 25,000 equity shares. So 25,000 equity shares given at free of cost. Ready? So 25,000 given at free of cost. What is the face value given? 10. So where company is issuing 2,50,000 bonus size. Clear everybody? So rupees 2,50,000. Now my next point, listen very, very carefully again everybody. Say for example, there are 1 lakh equity shares at the rate rupees 10 each, rupees 8 paid up. Company would like to issue the shares in the ratio 2:5 bonus ratio to issue fully paid up bonus shares. Tell me how many shares company will be issuing? How many? 1 lakh into 2 by 5, which comes to an amount of, which comes to a number of shares of, if you tell that it is exactly wrong. There's one more catch here, you need to find that. So I already told you that fully paid up shares can be issued only for a fully paid up equity shares. Here, first of all, there are equity shares which are partly paid up. So now what to do, sir? Company has to make this partly paid up into fully paid up. So it can go for double bonus. It can go for double bonus. Likewise, company is telling, hey, you all shareholders, you have to pay still rupees 2. We are declaring that as a bonus. So now shares are converted into fully paid up. Partly paid up are converted into fully paid up through bonus. Now they are fully paid up. Now company can issue 2:5, as you said, 40,000 equity shares towards fully paid up bonus shares. Clear, everybody? But generally this will not happen. Then what will happen, sir? Company will be making a final call. Company will be making a something like bank account debtor to equity share final call account. Before that you have to capitalize like equity share final call account debtor to equity share capital account. After making the final call, then company will be issuing fully paid up bonus shares on those shares. Clear, everybody? Either part 1 double bonus, conversion of partly paid up into fully paid up, then issue of fully paid up shares. But generally this is not possible. Generally what will happen, even if they want, they can issue in this style, but in all your problematic part you have to consider that company had made a final call and then company had issued a bonus. Okay, everybody? So that is the concept of fully paid up and partly paid up bonus shares. But biggest question is all about, you need to remember, sir, for the purpose of bonus, dash or utilized? Which reserves and surplus are to be utilized? But before that, let's write the journal entries, okay? Sir, normally, for a normal public issue, tell me the journal entry. Bank account debtor to equity share capital account. Will you admit or not? But instead of that one, you have to use dash. So what would be your final journal entry? Reserves and surplus account debtor to equity share capital account. Will you admit or not? Hey, but just answer me, my dear children. Is it yes, sir? Question adagala inka. Hey, but answer me. Is it possible? Is it possible to declare the bonus and to issue the bonus on the same dates? Ardham kaleda. Company is declaring now on the same date. Is it possible to the company to issue the shares on the same date? Inka ardham kaleda. Something like company is declaring, I will give you bonus, promised. Now the next step is all about company has to issue the bonus kada. So company is issuing number of shares now. Promised on one day that I will give you bonus, declaration, and now issue of shares. Two things will happen on one day generally or different dates. Of course different dates. So first of all, I have promised you that I will give you bonus shares. So at that time I will be passing an entry like reserves and surplus account debtor to bonus to equity shareholders account. What is the entry? Account debtor to bonus to equity shareholders account, and the next entry will be at the time of issue. Bonus to equity shareholders account debtor to equity share capital account. A first entry is at the time of declaration. Second entry is at the time of issue. What is the first entry? Reserves and surplus account debtor to bonus to equity shareholders account. Bonus to equity shareholders account debtor to equity share. But if you want, you can just skip off that bonus too. You can directly write reserves and surplus to equity shareholders to equity share capital. Clear, everybody? And next one, listen carefully. You can write the journal entries for conversion of partly paid up into fully paid up in various ways. But at the end, you have to get a journal entry like reserves and surplus are utilized to equity share capital is issued and hence it has to be credited. Did you get what I told? I'll just show you 2 to 3 styles, or just I'll show you 1 to 2 styles. Listen. Normally, you have to capitalize first. Am I correct or wrong? So what is a capitalization journal entry? Equity share final call account debtor to equity share capital account. Next, you are not going to get cash. You have to utilize reserves and surplus account debtor to equity share final call account. So check out, you will get a combined entry like reserves and surplus account debtor to equity share capital account. This is first style. But if you want, you can write another style also. How, sir? I have promised to all my equity shareholders that I will be giving bonus to them. Next, still I have to make a final call. First of all, I would like to capitalize the same. Equity share final call account debtor to equity share capital account. I will not get any cash now. I am giving the same as bonus to them. So bonus to equity shareholders account debtor, I am giving bonus for first call. So to equity share final call or first call. Did you get my point? Now check out again. Bonus debit, bonus credit cancel. Equity share final call, credit debit cancel. Final journal entry reserves and surplus to equity share capital. Understood? Hey, if you want, you can write one more style also. Reserves and surplus account debtor to equity share final call account. Getting my point, everybody? Equity share final call account debtor to bonus to equity shareholders account. Bonus to equity shareholders account debtor to equity share capital account. Check out, cancel, cancel, finally the same. So my point, you can write it any way. అదేమి ఇదే ఇట్లనే బై హార్ట్ చేసి రాయాలి అన్న ఎలిమెంట్ అయితే ఏం లేదు. యూ కెన్ రైట్ హౌ ఎవర్ యూ వాంట్. దిస్ నథింగ్ రాంగ్ ఇన్ దట్. You will be allotted and awarded with full marks for sure. Clear, everybody? So for conversion of partly paid up into fully paid up, what I suggest, these are the simple journal entries. Like this, first you capitalize. Instead of cash, you will be using the word reserves and surplus. That's the best thing. But if you want, you can choose any of these things also. Clear, everybody? So that is a journal entry for conversion of partly paid up into fully paid up. See here, declaration and issue for fully paid up. Conversion of partly paid up into fully paid up, you have to capitalize, then you have to issue the shares through reserves and surplus. Now, biggest question, what sort of reserves and surplus that I have to use? That is the biggest question. What sort of reserves and surplus that I have to use? So that is our next discussion. Listen very, very carefully. What are the two types of bonus shares that we are having? Fully paid up, conversion of partly paid up into, or you can also tell partly paid up into fully paid up, but you are not supposed to tell partly paid up bonus shares. Anyways, let me proceed. So fully paid up bonus shares, what are the reserves and surplus that we can use? Listen, what is the first reserve? Free reserves. Inka? No, listen, first reserve is CRR, capital redemption reserve. Next reserve is securities premium, and finally you have to use free reserves. And coming to the right side portion, you have to use only free reserves. Sir, why, sir? Securities premium has to be utilized as per section 52 of Companies Act 2013. So as per that, one point is very, very clear. Securities premium can be utilized only for the purpose of fully paid up bonus shares. So securities premium cannot be used for this purpose. It can be used only for the purpose of fully paid up bonus share. Even CRR has to be utilized only for the purpose of fully paid up bonus shares. Yes, CRR has to be utilized only for the purpose of fully paid up bonus shares, remember. And finally, free reserves. Free reserves can be used for any purpose. So accordingly, it can be used either for fully paid up shares or conversion of partly paid up into fully paid up shares. There's no problem in that at all. So now coming to free reserves, what is the list of free reserves you are having, sir? Yes, you can use P&L account, general reserve, reserve fund. These three things you can use, or even also you are having another word like revenue reserve. P&L account, revenue reserve, general reserve, reserve fund, all these things you can use. And now listen very, very carefully. There are some other reserves where you can consider as free. Number one, capital reserve realized in cash. No, revaluation reserve never will become a free reserve. So check it. What is the first one? Capital reserve realized in cash. That is very important, remember, okay? Because you will be having something like capital reserve, total 1 lakh. Out of which he will tell something like 20,000 is through revaluation. Did you get my point? Hey, what is the entry for revaluation upward? రీవాల్యుయేషన్ అప్వర్డ్ అంటే ఈ కాన్సెప్ట్ కి సంబంధించింది కాదు. యూ షుడ్ నాట్ థింక్ ఫ్రమ్ దిస్ పాయింట్. ఎనీవేస్, వాట్ ఈస్ ద జర్నల్ ఎంట్రీ? Asset account debtor to revaluation reserve account. Sir, will you admit that if you are doing upward revaluation, it's a kind of capital profit or not for you? Yes or no? Already we have discussed that 1 lakh asset is sold for 1,20,000 is a capital profit. So in the same way, asset is upward revalued, which is like a capital profit. Clear? Remember, revaluation reserve is a capital profit. What is it? Which reserve is a capital profit? Revaluation reserve is a capital profit. Clear? But is it realized in cash or not realized in cash? Not realized in cash, because you are telling the entry like asset account debtor to revaluation reserve account. So revaluation reserve did not realize the cash. So you should not use that. So you have to use or you should not use. So you should not use that. Pakka. Hey, what you should not use? Revaluation reserve. So what is capital reserve given here? Out of which 20,000 is through revaluation reserve. In the sense, is this 20,000 realized in cash or not realized in cash? Which implies that remaining 80,000 is realized in cash. So capital reserve only realized in cash has to be used for the purpose of bonus. Clear everybody? So P&L account, general reserve, reserve fund, revaluation, revenue reserve. Topaz fellow. Because these 4 reserves you can use for the purpose of bonus. But capital reserve you have to use only if it is realized in cash. Given something like capital reserve 1 lakh, 40,000 is due to amalgamation. Listen. Capital reserve 1 lakh, 20,000 due to revaluation, 40,000 due to amalgamation. Remaining how much is there? 60, 40. Say 30,000 is due to forfeiture of share. Is due to reissue of shares, and remaining 10,000 due to sale of fixed asset. Clear everybody? This is the styles of capital reserve given. Now tell me how much amount you can use for the purpose of bonus issue. Answer: 20,000 due to revaluation. Yes or no? No, this cannot be utilized because revaluation reserve is not realized in cash. 40,000 due to amalgamation. నీకు తెలియదని ఏం లేదు, నీకు తెలియదు కాబట్టి నాట్ రిలీజ్డ్ ఇన్ క్యాష్. అండర్స్టూడా? అమాల్గమేషన్, యు నో రైట్? మీనింగ్ ఆఫ్ అమాల్గమేషన్. వాట్ ఈస్ మీనింగ్ ఆఫ్ అమాల్గమేషన్? 2 companies joining together into a single company. So for that thing, capital reserve is there. It is not due to cash. It is due to purchasing or selling the company, not for cash. So realized in cash or not realized in cash? 30,000 is due to reissue of shares. There we have done 6 rupees example okati chesam gurtunda. That 6 rupees is a part of forfeited shares ega. Forfeited shares ante paid up ega. So which implies that this 30,000 due to reissue of shares is obviously realized in cash, and 10,000 due to sale of fixed asset. Yes, because you are selling, you are getting the cash, and hence it is realized in cash. So how much amount is realized in cash? So 40,000 capital reserve can be used for the purpose of bonus. Pakka. Now listen very carefully. I am telling you 3 reserves. Investment allowance reserve. Getting my point everybody? Development rebate reserve. And there's one more reserve. No, workman compensation fund. That discussion is at last. These 3 reserves. What are these 3 reserves? Investment allowance reserve, development rebate reserve, and finally workman compensation fund. Even though these 3 are specific reserves, hey, listen carefully, even though these 3 are specific reserves, company can make some portion as a free, company can make some portion as specific. If I tell a reserve like debenture redemption reserve, only for specific purpose debentures, joint life policy reserve, only for the purpose of joint life policy. Getting my point everybody? Like this, there are always specific reserves, but I'm telling these 3 reserves are combination of free and specific. Investment allowance reserve. Amma cheppandi ma, what are those 3 reserves? Investment allowance reserve, development rebate reserve, workmen compensation fund. These three reserves includes free and specific. Which portion can be used? Free. Clear everybody? Yes, he will be giving in the question workmen compensation fund 1 lakh, out of which 30,000 is free. Clear? Better at that time first you have to use workmen compensation fund rather than the full free reserves. Logic clear? Now moving on to the next thing, last and final, dividend equalization fund. See, listen very carefully. Dividend equalization fund is exclusively for the purpose of dividend. Yes, exclusively for the purpose of dividend, but it is a free reserve. It is a free reserve. So as far as we know that free reserve is a reserve which can be used for any purpose. Correct or wrong? But you are telling dividend equalization fund can be used only for the purpose of dividend. And you are telling that it is a free reserve. How, sir? We did not understand. As per Companies Act 2013, free reserves are those reserves from which you can distribute the dividend without any restrictions. As per Companies Act 2013, free reserves are those reserves where you can distribute the dividend freely without any restrictions. So dividend equalization fund can be freely utilized for the purpose of distribution of dividend without any restrictions. So dividend equalization fund is a free reserve. Logic clear? Pakka everybody? So now even though dividend equalization fund is a free reserve, it can be used only for the purpose of specific. Clear everybody? So can we use the same for bonus or not? Generally no. Exception yes, as a last option. Inka ye reserves levu anukuna time lone use cheyali. You can use general answer for dividend equalization fund. Can dividend equalization fund be used for bonus issue? No. Exception. You can use as if it is a last option. Clear everybody? So finally I am concluding. Just check out here everybody. Sir, you can use CRR, securities premium and free reserves for the purpose of fully paid up bonus shares, but for the purpose of partly to fully you can utilize only free reserves. But coming to free reserves, what are the list? General reserve, reserve fund, revenue reserve, P&L account, or you can also have a word surplus. This is discussion number 1. Discussion number 2, workmen compensation fund, development rebate reserve, investment allowance reserve. Discussion number 3, dividend equalization fund. So now I'm telling you the order. For fully paid up bonus shares, let us pick the order like first you have to use CRR. If no CRR or if CRR is completed, securities premium. If no securities premium or if securities premium is completed, you have to use free reserves. కొంచెం ఫాస్ట్గానే ఉంటుంది, నేను ఆల్రెడీ చెప్పాను, బికాస్ చాలా కవర్ చేయాలి. ప్లీజ్ ఫాలో. ఓకే, నౌ కమింగ్ టు ఫ్రీ రిజర్వ్స్. అగైన్ యూ ఆర్ హ్యావింగ్ ద లిస్ట్. Out of these many lists, what we have to use first, sir? First these things. If at all in the question he told that workmen compensation fund, development rebate reserve and investment allowance reserve, some portion is free, then you have to use first this thing. And next you have to use capital reserve realized in cash. Better to use the second as this option. Clear everybody? And next, third, general reserve, reserve fund, revenue reserve. And fourth, P&L account or surplus. And finally fifth, dividend equalization fund, of course as a last option. Clear everybody? But even though this order is changed, it is okay. But if this order is changed, not okay. In the sense, among free reserves you can change the order, not a very big deal. But coming to specific free reserves, you cannot change the order. Also remember 1 and 2 ante workmen compensation fund, development rebate reserve, investment allowance reserve, if given in adjustments, better to use those things first, because he would like to test you on that aspect. And capital reserve realized in cash. And third, all these things if changed, it is okay. Generally we will ignore this one. But at the end of the day, even though the order is changed, to some extent it is okay. But if this order is changed, it is not okay, and you will not be awarded with the fullest marks. Okay, that's the end of bonus issue. So take care. Where did you go? Fine. So third part we have completed is all about bonus issue. Two parts you are having: fully paid up okati, conversion of partly paid up to fully paid up. In this context, you have to remember one thing, that fully paid up bonus share cannot be issued for a partly paid up existing equity shares. First of all, it has to be made into fully paid up. Understood, everybody? And next, be careful about reserves and surplus. That's it. Just get ready for the next topic. Buyback. To the next topic, buyback. Okay, listen to the next concept, buyback. Sir, buyback is very, very simple. Likewise, company had issued already its shares to the public. Those shares are being again bought back. So it's very, very simple. See, if your market share is rupees 120, if company would like to give you a tempting offer like rights issue, then it has to be given at less than 120. But now company has decided to buy the shares back from you. So company has to give a tempting offer to put more than 120. So if company told, I'm about to buy back the shares, just sell me, the price is 120. Obviously, nobody will be ready to sell first of all. If they would like to sell, they can sell it in the open market also. But if company would like to grab that opportunity, company has to declare obviously more than this 120. So company is putting a price something like 150. Clear everybody? So that's the point. So please take care. So buyback. So how much maximum number of shares that a company can buy back? Of course, as per section 16(9) of Companies Act 2013. But before buying back the shares, it has to do one thing. Remember, my dear children, if at all in a company, if the capital is getting redeemed, first of all, company has to match the capital requirement. Or your teachers may tell you in a language like fill the capital gap or match the capital requirement, that concept. Now, sir, generally capital will be redeemed only in two situations. Number one, redemption of preference shares. Number two, buyback of securities. At this time, you have to fill the capital gap or match the capital requirement. So fill the capital gap, your language. And while filling the capital gap, it can be in two options. Either in the way of fresh issue and in the second way of CRR. Clear everybody? Hey, also take care because simultaneously some portion of redemption of preference shares will be completed here itself. Because you need to get a clear-cut comparison between redemption of preference shares and buyback, otherwise you cannot be able to do. Fresh issue. What is a fresh issue for the purpose of redemption of preference shares? If the preference shares are getting redeemed, whatever the face value of preference shares is getting redeemed, that has to be matched either with fresh issue or with CRR. While going for fresh issue, a company can go either to issue preference shares or to issue equity shares. But coming to buyback of securities, fresh issues includes only equity shares, but not preference shares. Clear everybody? Which is exactly wrong. Only preference shares but not equity shares. Take care with one thing, my dear children. Buyback of securities in the sense you are buying back equity shares. Redemption of preference shares in the sense you are redeeming preference shares. If you are redeeming preference shares, you can issue either preference shares or you can issue either equity shares. That is permitted. As per section 55, redemption of preference shares. But as per section 69, buyback of securities, if you have decided to buy back the securities, you can issue only preference shares as fresh issue. You cannot issue equity again. Clear? Because as simple as such, hey, buying back the equity share, issuing the equity share. Hey, what point is there in that? You are buying back the equity share and you are issuing the equity share. Then why to buy back, sir? That is a trash. And hence, for buying back the equity share, you cannot issue equity share. You can issue only. But you may ask me a doubt. Sir, then what point is there? Redemption of preference shares and issue of preference share. Did you get my question? You are redeeming a preference share and you are issuing a preference share again. Then why to redeem, sir? And why the concept is not there here? If you are redeeming a preference share, then you have to issue equity kada. Sir, మీకు నా లాజిక్ అర్థమవుతుందా? ఈక్విటీని బైబ్యాక్ చేస్తే ఈక్విటీ ఇష్యూ చేయడంలో పాసిబిలిటీ లేదు కాబట్టి మిమ్మల్ని మేము ప్రిఫరెన్స్ మాత్రమే ఇష్యూ చేయండి అని చెప్తున్నాం. మరి రిడమ్షన్ ఆఫ్ ప్రిఫరెన్స్ షేర్కి వచ్చినప్పుడు ప్రిఫరెన్స్ షేర్ని నువ్వు రిడీమ్ చేసి మళ్ళీ ప్రిఫరెన్స్ షేర్స్ని ఇష్యూ చేయడంలో అర్థం ఏమిటి? వాట్స్ ద పాయింట్ ఇన్ రిడమ్షన్ ఆఫ్ ప్రిఫరెన్స్ షేర్స్ అండ్ ఇష్యూయింగ్ ద ప్రిఫరెన్స్ షేర్ అగైన్? క్యాన్ ఎనీబడి? No, that's okay. One of the points, as like one of our friends said, is rate. Rate may be differ, but still the major reason is all about redemption is in a time frame. Maximum 20 years. More than that, it cannot do it. So it is mandatory to redeem preference shares. So it is not your wish to redeem. Since the time frame is completed, you are redeeming. But equity is not like that. It is a decision of the board of directors to redeem the, to buy back the equity shares. Understood, everybody? So remember, what is the concept? If a capital is redeemed, you have to fill the capital gap. Capital can be redeemed in two ways: redemption of preference shares, buyback of securities. Redemption of preference shares, you can go either for fresh issue and CRR, but while going with that, fresh issue includes both preference shares and equity shares. Whereas coming to CRR, you can use any of the free reserves. Any of the free reserves. Any of the free reserves. What is the order we have discussed for bonus? The same will come here. Clear, everybody? So first slot, workman compensation fund, development rebate reserve, investment allowance reserve, and second slot is capital reserve realized in cash, and third slot is general reserve, reserve fund, and revenue reserve, and fourth slot is nothing but P&L account. At last, if no option, then dividend equalization fund. Perfect, everybody? And coming to CRR at the time of buyback of securities, remember, for the purpose of section 69 of Companies Act 2013, that is like buyback of securities, remember, my dear children, very, 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 very important note, that securities premium has to be considered as a free reserve. What is that? Has to be considered as a, for the purpose of buyback of securities only. So CRR can be created either from securities premium and then from free reserves. Understood? Yes, it can be created either from securities premium or from free reserves. So whatever the free reserves, the same order will be continued. But before free reserves, first of all, you have to utilize securities premium. Pakka. That is a whole concept. Check out for fresh issue, for preference shares, preference or equity. But for buyback of securities, fresh issue, only preference. Redemption of preference shares, CRR, only free reserves. But buyback of securities, CRR, both securities premium and free reserves. Concept clear? Now moving on to the next thing. So after the capital is, before the capital is redeemed or before buying back the securities, you have to match the capital requirement. That can be done, or you can fill the capital gap either through these journal entries. But biggest question, how much? Very, very simple. Nominal value or face value, or nominal value or face value of buyback of equity shares. You should not consider the redemption premium. You have to consider only the face value. Or you can also tell that nominal value or face value of preference shares which are due for redemption. So you need to consider only which value? Face value. But you should not consider premium on redemption. Clear with point number 1? Now the next point, maximum buyback. Maximum number of buyback. List of the following three tests you are having. Number 1, shares outstanding test. Number 2, resource test. Number 3, debt is to equity test or debt is to equity ratio. Shares outstanding test, what is that, sir? Maximum number of shares that can be bought back is equal to 25% of outstanding equity shares. Clear, everybody? And coming to resource test, maximum resources that can be utilized is equal to 25% of paid up share capital plus free reserves. Of course, it is including securities premium. Don't forget that one. And now maximum number is equal to maximum resources divided by buyback price. Clear, everybody? Because at the end of the day, you want maximum number. You are telling that I can utilize 1 lakh resources, sir. But how many shares, sir? 1 lakh resources divided by 150 rupees is our buyback price. Then 1 lakh by 150. Concept clear? And moving on to the next thing, debt is to equity test. After buyback, that is not before buyback, that is after buyback, you have to maintain a ratio of 2:1. Sir, after buyback 2:1 in the sense what I have to do, sir? Check out what are the maximum resources that you can utilize. For that one, you have to check out how much is the debt you are having. So check out debt. Sir, say for example, the debt is 1000 crores. How much is the debt? 1000 crores. Check out how much is the present equity. Say the present equity is 700 crores. What is the ratio that you have to maintain? 2:1. Which is nothing but, can I tell something like debt is to equity implies 2:1 and equity is equal to half of debt? Yes or no? So equity is equal to half of debt. So how much equity I have to maintain? Half of 1000 crores, which comes to 500 crores. But how much present equity I am having? 700 crores. How much future equity I have to maintain? 500 crores. So how much I can utilize? 200 crores. But take care, this 200 crores has to be utilized not only for the purpose of buyback price, but also for the purpose of CRR. Because you have to create CRR kada. So 200 crores divided by CRR. CRR, for CRR, what you have to transfer? Face value or nominal value. Say for example, that is 10 rupees. Plus buyback price. In our example, that is nothing but 150. So how much ever number you will get, that number has to be considered. Pakka everybody? So take care. So I'm just telling you, I mean overall I'm telling you with respect to maximum number of buyback. Maximum number of buyback. What is the first one? Shares outstanding test, which is equal to 25% of outstanding equity shares. That is very, very important. And moving on to the next thing, resource test. Resource test is equal to 25% of paid up share capital plus free reserves plus securities premium whole divided by buyback price. And last and final, debt is to equity, you have to maintain 2:1, which implies that equity is equal to half of debt. So how to find it, sir? Check out something like, let me write like this: present equity minus minimum equity to be maintained, that is half of debt, whole divided by CRR, that is nothing but face value plus buyback price. Perfect everybody? If you have taken this one, you will get the final answer directly. Understood? So now moving on to the next thing. Listen very, very carefully. Last and final concept, journal entries. So coming to journal entries, very, very simple. Check out. Sir, you are buying back. Am I correct or wrong? You are cancelling the equity share capital. So equity share capital account debtor to equity share buyback account. And at the time of payment, equity share buyback account debtor to cash or bank account. But listen, how much equity share capital you will cancel? Always face value, sir. That is nothing but, say for example, rupees 10. To equity share buyback, how much you have to pay, sir? Total buyback price I have to pay, sir, which is 150. Then what about remaining 140 that has to be debited, sir? That is nothing but premium on buyback. What is that called as? Premium on buyback. So of course you have to pay 150, and finally this premium on buyback has to be closed and transferred either with securities premium or any of the free reserves to premium on buyback account. Pakka everybody? Sure. Take care, securities premium cannot be used for the purpose of premium on redemption of preference shares. Securities premium cannot be used for the purpose of premium on redemption of preference shares. Of course, it can be used. How and why? We will deal it in that topic. But ippadi varaku comparison cheptunna. Clear everybody? And next one. Say for example, your equity share capital face value is something like 10 rupees. Okay. 2. Equity share buyback. Your market price of your equity share is only 8 rupees. What is market price? You have offered 9 rupees. Automatically 1 rupees is to be credited, and which has to be transferred to capital reserve. Which has to be transferred to capital reserve. Pakka everybody? And equity share buyback account debtor to cash or bank account 9 rupees. Understood? Now one more thing you have to understand. If capital reserve on account of buyback, can it be utilized for the purpose of bonus or not? Yes, listen carefully, check out and answer. Sir, I told you for bonus issue you can use free reserves. Cheppali. In free reserves you are having one of the reserves like capital reserve realized in cash. So now my question is all about, can you utilize this capital reserve arising on account of buyback for the purpose of bonus? Yes or no? No. Why? Because not realized in cash, ma. You have to use such a kind of capital reserve which is realized in. But here this capital reserve is not realized in cash, and hence you cannot utilize. That is the end of your topic buyback. So topic number 4, buyback of securities. What is more important? Maximum number of equity shares that can be bought back, 3 tests you are having. And also take care something like free reserves includes securities premium. And of course here you have to take care about journal entries. That's quite common in everything. Rights issue 1 journal entry, nothing great. Clear everybody? Yes, without any wastage of time, immediately I'll start one more topic and I'll complete, that is sweat equity shares. Okay, so coming to the next concept, sweat equity shares. Point number 1, can a share be issued at discount? Answer, no. Exception, it can be issued as per section 53 at the time of providing intellectual property rights or at the time of providing any sort of intangible assets to the company. Say for example, an employee is there. Employee had used all his knowledge and he had found one software. Clear everybody? That software was actually purchased by the company. The software was actually purchased by the company. In this context, company had given some equity shares to the employee as an additional bonus, in the form of discount. Clear everybody? Say what is the face value in all our examples? 10. Issued at a discount of rupees 4 and it is asking only rupees 6 to pay. Then what is the entry you have to write, sir? Very, very simple. Bank account debtor. How much we are getting, sir? 6 rupees. But what is the equity share capital I have to credit, sir? 10 rupees. What about the difference, sir? 4 rupees. That has to be debited to intellectual property rights. That has to be debited to intellectual property rights, because it is the sweat of the employee, it is the knowledge of the employee, it is the excellence of the employee, it is the motion of the employee, and hence you have to consider your employee, and it is something like you are purchasing the intangible asset of the employee. వాడు బుర్రవాడి చేసిన దాన్ని నువ్వు కొనుక్కుంటున్నట్టు. Clear everybody? Anyway, you are purchasing that software account debtor to cash or bank. That is one slot. We are not at all considering that slot. We are speaking about this one. Or company can give another offer to the employee. Something like, I will issue 2 lakh shares. I have to purchase your software at 80,000 rupees. How much? 80,000. But you employee, I'll give you such an offer where I will issue my shares at a discount of 80,000. Logic clear, huh? Employee had made a software. So 2 options: purchasing the software account debtor to cash or bank account, paying the amount to the employee. In addition to that, company is giving some shares to that employee at a discounted price. That has to be debited to intellectual property rights. Now I'm telling you second kind of example. Employee had made a software. Employee had prepared a software and company is purchasing that by paying 80,000. But instead of giving cash, company told, I will issue shares at a discount. So what company is telling? I will issue totally 2 lakh face value shares to you at a discount of 80,000. So you have to pay me remaining 1,20,000. So bank account debtor 1,20,000, IPRs, intellectual property rights account debtor 80,000, to equity share capital account 2 lakhs. Clear everybody? If at all company had given shares for discount to any other people like employees or any other people or directors, then you can debit the same as compensation expense. You can debit the same as compensation expense. Like say for example, if the company is purchasing the shares from the employee for the purpose of one intellectual property right, then you will be debiting intellectual property rights. But for any other purpose, if the company had given shares at a discount to any other person as per Companies Act 2013, then it will be debited to compensation expense. Is the logic clear? So now company is issuing the shares as per section 53 only. Getting my point? As per Companies Act section 53, company is issuing the shares at discount. But it is not issuing the shares at a discount for the employees for purchasing of something. For some other purpose it has issued. So bank account debtor 1,20,000, to equity share capital account 2 lakhs, balance 80,000 will be debited directly to compensation expense. Understood everybody? If it is for the purpose of getting some intangible asset, you have to debit intellectual property rights. If company is purchasing one intangible asset, it has to debit intellectual property rights. If it is for any other purpose, you have to debit compensation expense. Understood everybody? That is the end of your sweat equity shares. Very, very simple concept. So point number 5, sweat equity shares. If it is for intangible assets or others, if it is intangible asset, you have to use the word IPRs, intellectual property rights. If it is for others, you have to use compensation expense. Understood everybody? And Esops ఇప్పుడు పక్కకి వెళ్ళిపోయింది ఖచ్చితంగా. And we have to be on our track, and we are going to complete redemption of preference shares and issue and redemption of debentures. Clear everybody? And of course redemption of preference shares చాలా వరకు అయిపోయింది. ఇది అయిన తర్వాత I'll bring Esops again. అంటే అయిన దాన్ని టార్గెట్ ప్రకారం అది వదిలేసి మళ్ళీ అది లాస్ట్లో చెప్తా ఉంటాను. గెటింగ్ మై పాయింట్ ఎవ్రీబడి? సో ఇప్పుడు Esops ప్రెసెంట్ మనకి లేట్ నడుస్తుంది. ఇన్ ద నెక్స్ట్ సెషన్, ఇఫ్ ఆఫ్టర్ కంప్లీషన్ ఆఫ్ దీస్ 2 things, ఐ విల్ బి గోయింగ్ విత్ Esops. Clear everybody? So get ready. The next topic, redemption of preference shares, which is very, very easy. Also we have completed the same already. While telling buyback, comparisons were done, so nothing great. We can complete just within a span of 10 to 15 minutes. So even in redemption of preference shares also, company is redeeming the capital. So whenever company is redeeming the capital, first of all it has to fill the capital gap. So again it can fill the capital gap either through fresh issue or through CRR. Fresh issue in the sense it will become only preference share capital or equity share capital, anything is permitted. But coming to CRR, only free reserves are permitted. To tell you one more thing, my dear children, consider only face values, okay? Don't consider securities premium if the issue is there. I mean to tell, if 1 lakh preference shares are redeemed at rupees 100, then you have to raise 100 lakhs share capital. If at all the company had decided to issue equity shares at the rate rupees 10 plus 10, face value is 10 and securities premium is 10, don't think that 100 lakhs divided by 20 enough of issuing 50 lakh shares. Then what happens? Bank account debtor 50 lakhs into 20, which comes to 100 lakhs, to equity share capital account 50 lakhs into 10. ఇంకో 1000 రావాలా? 50 lakhs into 10, 500 lakhs అంతే కదా? I've done some mistake. ఇది ఎంత? 50 lakhs 0 0 10,000. Just wait. 1 lakh into 100, 100 lakhs divided by 20. How many shares this will become? 5 lakhs, huh? Okay, 5 lakhs. So 5 lakhs into 20. మీరు చెప్తుంది అదే నాకు అర్థం అవ్వాలి కదా. 5 lakhs into 20, which is like 100 lakhs. And to equity shares, something like 5 lakhs into 10, which comes to 50 lakhs. To securities premium, again 5 lakhs multiplied by 10, which comes to 50 lakhs. If you observe, how much we need to match? 100 lakhs. But how much share capital is matched? Only 50 lakhs. So whatever if securities premium is there under issues, you should not consider that securities premium. So to check number of shares, 100 lakhs divided by only face value, that is 10, which comes to 10 lakh shares are to be issued. Clear everybody? Don't consider securities premium. Be careful. And yes, preference, equity, free reserves, and that is what your portion of filling the capital gap. And very, very important, if your company is section 133 company, you cannot utilize securities premium for the purpose of premium on redemption of preference shares. I told you at the time of telling buyback, securities premium can be used for the purpose of buyback, but it cannot be used for the purpose of redemption of preference shares. Point here is that if your company is section 133 company, you will be provided in the question, if at all section 133 is applicable to your company, you cannot use securities premium for the purpose of premium on redemption of preference shares. If your company is not a section 133 company, you can use securities premium for the purpose of premium on redemption of preference shares. If nothing is given, it is deemed assumption that you can use securities premium for the purpose of premium on redemption of preference shares with the extent of CMA is considered. If CA is considered, this is the deemed assumption. But if CMA is considered, this is the deemed assumption. Clear everybody? So it is something like, let us start straight away with the journal entries. So you have to match the capital requirement or fill the capital gap. So first entry, bank account debtor. Sir, also I am telling the entries for buyback at this stage. I mean to tell two things will be co-calculated. Already buyback, I told you one set of entries. Did you remember? But free reserves to CRR, that will be taught here. So take care, bank account debtor to equity share capital account or preference share capital account for the purpose of fresh issue. If premium is there, you write the entry, but don't consider in the computation of number of preference shares to be issued. Did you get my point? So as per our example, if the shares are issued at 10 plus 10, total amount needed is 100 lakhs divided by 20 is wrong. 100 lakhs divided by 10 is correct. So you have to issue 10 lakhs multiplied by 20, which comes to 200 lakhs. 10 lakhs multiplied by 10 face value, which comes to 100 lakhs. 10 lakhs multiplied by 10, which comes to 100 lakhs. Clear everybody? I am not telling that securities premium should not be accounted. Securities premium will be accounted, but it is not considered for the purpose of computation of number of shares. For the computation of number of shares, don't consider, but for writing the entry, consider. Clear everybody? So this is what your first journal entry will be. Next, match the CRR like fresh free reserves. Same, whatever the list we have taught before, all the same free reserves will come. Free reserves account debtor to CRR account. Remember, whatever this created CRR can be used only for one purpose, that is issue of fully paid up bonus shares. Fully paid up bonus shares, not for conversion of partly paid up into fully paid up. So these are the two entries which are quite common either for buyback or for redemption of preference shares. Next, we have already taught the buyback entry separately, like equity share capital to equity share buyback to choose capital reserve if profit, if loss, something like premium on buyback. Did you remember? So now here also the same logic, but in a different style. Percentage preference share capital account debtor to preference share holders account. This is always to be cancelled at face value, say 100. But you have promised that you will be repaying along with the premium 100 plus 10. Automatically it will become 10, which will be debited to premium on redemption of preference shares. Now to close this premium on redemption of preference shares, if your company is not a section 133 company, you can use securities premium. But if your company is a section 133 company, you cannot use securities premium. So securities premium or free reserves account debtor to premium on redemption of preference shares account. Then you can ask me, what is section 133 company? Section 133 company is the company to which accounting standards are Ind AS, rendu. Both accounting standards and Ind AS will be made applicable. So deemed assumption is something like in CA I am speaking like deemed assumption section 133 company if nothing is mentioned. But coming to CMA, sir, any options mark enduku? Because I would like to aware, apart from that nothing great, but coming to our examinations we will consider that our company is not a section 133 company, and accordingly you can use securities premium. Clear everybody? If you so feel confused, utilize securities premium, write a note, assumed that it is not a section 133 company. Understood everybody? Hey, if given in the question that it is a section 133 company, you should not write that assumption again. Understood? Take care. So that is what your point is all about preference shares. And next, this preference share holders must be paid. So preference shares holders account debtor to cash or bank account, 110 rupees. Clear everybody? Redemption at discount is generally not possible. Only redemption at premium is possible. Whereas equity shares is linked with market price. Equity shares is linked with market price and buyback price is decided by considering the market. But here market will not be considered. Just we will be checking the face values all the time. Reason being, it is a common assumption that equity shares will be actively traded in the market, but preference shares will not be actively traded in the market. I would like to tell something like, if it is equity share capital, then you will be having equity share capital, premium on buyback, to equity share buyback, to capital reserve also. If you have paid lesser price, if you have paid more price, premium on buyback. But here paying lesser price itself is not possible until now. Clear everybody? That is the end of your topic, redemption of preferences, which is very, very simple topic. So take care. Redemption of preference shares. First of all, you have to match the capital requirement. Even in buyback also you have to match the capital requirement. Remember, matching the capital requirement and passing the journal entries. Clear everybody? So while matching the capital requirement, please check out face value versus face value. I mean to tell, redeemed face value should match the issue face value. Securities premium will not be considered. Clear everybody? My dear children, will be asking you a question. Just tell me the answer. Say for example, company would like to redeem rupees 1 lakh preference share capital. For that purpose, company is telling that it will issue 40,000 debentures, 20,000 equity shares, and 10,000 preference shares, 40, 20, 60, 70 and 30,000 CRR. Clear everybody? Hey, respond understood. Tell me, possible or not possible? Yes or no? No. Why? I already told you fresh issue includes only dash and dash. So it is not possible. Clear everybody? Say company has decided rupees 40,000 to collect in the form of securities premium. Now, answer. No, because premium is not a fresh issue. Fresh issue includes only dash and dash. Equity share capital, preference share capital, not premium. Capital is different from premium. Debenture is not considered. Pakka. That is the end of redemption of preference shares. Very, very simple. Clear everybody? So now moving on to the next thing. Issue and redemption of debentures. Sir, coming to issue of debentures, very, very light. I mean to tell, you are having the whole issue concepts, but it is very light. And we are going to consider redemption more. So anyways, first of all, let me tell you the issue journal entries. See, at the time of issuing, again same, you will be having debenture application, debenture allotment, debenture calls, but generally we will be stopping it at application itself. I mean allotment itself. Generally debenture calls will not be there. Clear everybody? Anyways, so cash or bank account debtor to percentage debentures application account, percentage debentures application account debtor to percentage debentures account. Clear everybody? And next, at the time of capitalization for allotment, percentage debentures allotment account debtor to percentage debentures account. Next, get the cash, cash or bank account debtor to percentage debentures allotment account. Understood? This is first lot. And if at all you are having premium, then you will be putting it in securities premium. Nothing great at all in that. So even debenture premium will also be considered as securities premium. No need to think that only share premium will be under securities premium. Debentures premium can also be credited to securities premium. Understood everybody? So now in this situation, you are totally having 9 cases. Issue and redemption. Issue at par, redemption at par. Issue at par, redemption at premium. Issue at par, redemption at discount. In the same way, issue at discount, par, discount, premium, discount, discount, and next issue at premium, par, premium, 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 discount. Clear everybody? So totally you will get 9 cases, but out of which this case will get automatically eliminated. Clear everybody? Reason being, I already told you that redemption of discount is practically not possible. So now what would be the journal entry shall we write, sir? Listen, I am telling the journal entry for all the 2 multiplied by 3, 6 cases at a time. For all the 6 cases, I am telling you a journal entry, single journal entry, check out carefully. Cash or bank account debtor with the issue price to percentage debentures account with the face value. Issue at par, par is over. If it is issued at a premium, then you will be writing like to securities premium account if at premium. My dear children, a debenture can be issued at discount. And hence, whatever the portion of issue of discount is there, that discount will be debited. Say for example, 10 rupees, you have issued only for rupees 9. And that rupees 1 will be debited to discount on issue of debentures. If premium is there, it will be credited. If discount is there, it will be debited. Clear everybody? And last but not least, if at all the debenture is redeemed at a premium. Sir, if the debenture is redeemed at premium, we will be creating it at premium at the end of the year. No. It is very clearly taught for debentures that if the debentures are redeemed at premium, at the time of issue itself, you have to pass another journal entry that it is your loss on issue of debentures. Sir, how it will become loss on issue of debentures if it is redeemed at premium point at the end of the debentures period? Even though you redeem the debentures at premium at the end of life period, that will be considered as your issue time loss. Reason being, at the time of issue itself, you know that very clearly and you are going to state it in the prospectus. So by the time when you issue the debenture, automatically you will be incurring the loss. And that loss has to be written off in the future years in SLM method, straight line method. Of course, if the debentures are redeemed at annual lots, if the whatever are there, if the debentures are redeemed in installments or if the debentures are redeemed in annual lots, annual drawings, every year some portion of debentures are redeemed. At that time, loss on issue of debentures or discount on issue of debentures have to be written off with sum of years of digits method. Clear, everybody? Of course, the concept is not there for you, but I'm just telling that it will be written off in that method. So take care. Now the entry will be this loss on issue of debentures has to be linked with premium on redemption of debentures account. Clear, everybody? All the 6 cases journal entry, just check out. You're getting cash. 2% debentures. This will be always at face value. This will be always at issue price. If issued at premium, 2 securities premium. If issued at discount on issue of debentures account debtor. Now, if redeemed at premium, you will get 2 more points. Loss on issue of debentures account debtor to premium on redemption of debentures account. Understood, everybody? If issued at premium is not there, then cancel this. Clear? I mean to tell, if issued at par, cancel this one and this one. You will get the entry. Sir, issued at par and redemption of premium is also not there. Cancel this and this. You will get the journal entry. Clear? This is a single journal entry which is working out for all the 6 cases. You check out what is the case and write the journal entry. Pakka, everybody? Sure. Now the next point, this DOID and LOID, discount on issue of debentures and loss on issue of debentures, have to be written off to P&L account. Something like P&L account debtor to discount on issue of debentures account and to loss on issue of debentures account. Under which method, sir? Option number 1, SLM method. If the debentures are redeemed after some X number of years. If the debentures are redeemed in annual lots or each and every year, then you have to follow sum of years of digits method. Understood, everybody? That is a whole concept, but this is not at all there for you. Okay, now that is a concept of issue and redemption of debentures on a bare portions. Now we are going to discuss some things about this redemption of debentures. Shall I continue? Sir, as per Companies Act 2013, it is as simple as such and as clear as such. If you are having a debentures, which are non-convertible, because if the debentures are convertible into shares, then automatically no need of having cash outflow. Am I correct or wrong? Because in future debentures will be converted into shares. But if at all you are having dash debentures, non-convertible debentures, then in future you have to pay cash. Am I correct or wrong? Money outflow will be there. If in future you are having money outflow, arranging those huge resources at one point may be difficult. Say for example, you have issued 10 lakhs debentures and you have to redeem this 10 lakh after 5 years. After 5 years, arranging 10 lakhs might be difficult. And hence Companies Act 2013 is asking you to maintain DRR and DRI. Debenture Redemption Reserve and Debenture Redemption Investment. How much DRR has to be maintained, sir? At 10%. How much DRI has to be maintained, sir? At 15%. Clear, everybody? So how much debentures you have issued, Amma? 10 lakhs. So 10 lakhs multiplied by how much percent? 10%. How much it will become? 1 lakh. You have to maintain DRR. Clear, everybody? And how much DRI has to be maintained? 10 lakhs multiplied by 15%, which comes to 1,50,000. Understood, everybody? This much DRI has to be maintained. Pakka. Now, at the time of redemption of debentures, listen very carefully, at the time of redemption of debentures, point number 1, sell the DRI. Sell debenture redemption investment. Sir, how much DRI you have maintained here? 1,50,000. But how much you have to redeem? 10 lakhs. So, how if you sold, how much you will get, amma? On an average, 1,50,000. Still, how much is needed for you? 8,50,000. For this one, you have to arrange the resources. How to arrange the resources, sir? You can take your existing cash or even you can sell your investments. Clear, everybody? If you have any other investments, you can sell the investments. You have to arrange the cash. Somehow arrange the cash. Point number 3, then pass the due entry. Finally, point number 4, pass the payment entry. Clear, everybody? These are the things you have to do for redemption of debentures at the time of redemption of debentures. Clear? Sir, initially you have written this entry like issue and redemption of debentures. This is our generalized thing. But now we are learning about the pure law. As per Companies Act 2013, you have to maintain DRR at the rate 10%, DRI at the rate 15%. So 10 lakhs into 10% is 1 lakh, 10 lakhs into 15% is 1,50,000. Of course, maintenance of this DRR and DRI is not applicable to each and every company. It is applicable only to some companies, but that concept is not there for you. Getting my point, everybody? In CA, that concept is there, but that concept is not there for us. But for us, still a lot more is there. Up to this, clear? So, before redemption of debentures, what is the first step that you have to do? Sell the DRI. Step 2, what you have to do? Arrange the resources. Step 3, what you have to do? Pass the due entry. Finally, pass the payment entry. Understood, everybody? In this context, at any point of time, if you have to give the interest, you give the interest. So, what is the journal entry for interest on debentures, amma? Interest on debentures account debtor to cash or bank account. Closes interest on debentures and transfer to P&L account. So, P&L account debtor to, there ends the matter. Pakka. Now, sell the DRI. First of all, let us maintain DRR. Sir, create DRR. Debenture redemption reserve is a reserve. Am I correct or wrong? That will be created through reserve can be created through profits. So what is the journal entry? P&L account debtor to DRR account 10 lakhs multiplied by 10% which comes to an amount of 1 lakh. Clear, everybody? Next, DRI. You have to invest. Am I correct or wrong? So DRI account debtor to cash or bank account which comes to 1,50,000. Clear, everybody? And you just before these two things you may have an entry like issue of debentures. So cash or bank account debtor to percentage debentures account. Understood? If issued at premium to securities premium. If issued at discount on issue of debentures account. Understood? And next one, remember, as per Companies Act 2013, it is not asking you to create loss on issue of debentures and premium on redemption of debentures at the time of issue. Sir, నేను ఏం చెప్పానో అర్థమైందా? Generalized గా మాట్లాడేటప్పుడు you are having an entry like loss on issue of debentures to premium on redemption of debentures. But as per Companies Act 2013, it did not ask you to create loss on issue of debentures to premium on redemption of debentures. So as far as speaking about Companies Act 2013, that concept will not be there. Now start. What is that? First you have to sell the DRL. DRI you have to sell. What is the entry? Cash or bank account debtor to DRI account which is 1,50,000. You get the cash and profit or loss will be transferred to P&L account. And next one, arrange the resources. You take the bank account and get ready, or if you are selling any other thing, just get ready. Clear, everybody? Or sometimes due to shortage of funds, company can take loan, or due to shortage of funds, company can issue shares. Arrange the resources. Whatever is given in the question, you write the entry for the same. Next is all about due entry. Percentage debentures account debtor to debenture holders account. This will become face value. Redemption at discount is generally not possible, I told you. So generally you have to pay face value. Sir, if you are paying extra price, then automatically the 2 rupees will be debited to premium on redemption of debentures. Understood, everybody? Now finally, pay to these people. Debenture holders account debtor to cash or bank account. Either 100 or 1 or 2 as per the issue. And finally, premium on redemption of debentures has to be closed for sure. Because as per Companies Act 2013, you are not creating loss on issue of debentures. So this premium on redemption of debentures has to be closed either with the securities premium or with any other free reserves. Again the same, if it is section 133 company, then you cannot use securities premium, but if it is not a section 133 company, you can use securities premium. Understood everybody? That is as per Companies Act 2013. Till now what I taught you. Number 1, generalized versions of issue of debentures and redemption of debentures. Under redemption of debentures. Number 2, as per Companies Act 2013. Understood everybody? Number 3, redemption out of profits. Redemption out of hey, one more thing I have forgotten. Last but not least, whatever this DRR is there, it will be closed and transferred to general reserve. Understood everybody? That is the 5th one you have to do. Likewise 4 things, and finally 5th one, close DRR and transfer it to general reserve. Understood? There ends with second concept. And third one, redemption out of profits. Sir, what do you mean by redemption out of profits, sir? You have to create entire 10 lakhs for the purpose of redemption of debentures. So as per Companies Act, you are creating something like 10 lakhs into 10%. Only how much you are creating? 1 lakh. But if the question is given something like the company had redeemed the debentures out of profits, then you have to create entire 10 lakhs. Understood? Given in the question, company carried on redemption out of profits and already existing DRR is equal to 6 lakhs. Shall I continue now? Sir, how much debentures you have to redeem? 10 lakhs. Company has decided to redeem the debentures as per Companies Act of profits. Profits in the sense how much DRR you have to maintain? Entire 10 lakhs. Amma ardhamautunda. Companies Act 2013 only limit. But if you are redeeming out of profits, total face value. How much is the face value? 10 lakhs. So how much DRR is there? 6 lakhs. Clear everybody? Still how much DRR is required? Create that. P&L account debtor to DRR account. 6 lakhs. Understood everybody? And the 4 lakhs. 4 lakhs. Clear? Now in the question, he will be telling you about the investment. If given, you pass the entry. If not given, don't pass the entry. Clear? And finally redeem the debentures. If investments are there, then sell the investments. If investments are not there, forget about the investments. Understood? That is what redemption out of profits. Sir, generalized versions lo una difference enti. Premium on redemption of debentures has to be created at the time of issue itself. As per Companies Act 2013, no need to create loss on issue of debentures and premium on redemption of debentures. Point number 2, you have to maintain DRR and DRI as per the limits. Next one, redemption out of profits. Forget about DRI. If given, you follow. If not given in the question, you forget. Redemption out of profits in the sense, how much ever debentures you have to redeem, that much DRR you have to maintain. As per the question, how much DRR they are having, but how much you have to redeem. So still how much you have to create? 4 lakhs. All the remaining are common. Clear everybody? అంటే ఒక్కొక్క దాంట్లో ఏం జరుగుతుందో మీరు తెలుసుకుంటే క్వశ్చన్ బట్టి ఆన్సర్ చేసేస్తారు. Now moving on to the next thing, redemption out of capital. What is the next concept, amma? Redemption out of capital. Again same, if about DRI is given in the question, you follow that. If DRI is not given, you can ignore that. Understood? But point here that you need to note, no need to maintain DRR at all. Because it is redemption out of capital. Directly your borrowed capital will be redeemed. No need to maintain DRR at all. Understood everybody? And last but not least, sinking fund method. What is this one, sir? Every year, one sinking fund factor will be given to you in the question. And so one value will be given to you in the question. Every year you have to maintain a fund. What is that, sir? P&L account debtor to sinking fund account. After that, you have to invest. Sinking fund investment account debtor to cash or bank account. After that, you will get interest. Cash or bank account debtor to interest on sinking fund investment account. Sir, normally interest will be closed and transferred to P&L account. But here you are having sinking fund. So close this and transfer only to sinking fund. So interest on sinking fund investment account debtor to sinking fund account. Clear everybody? And at the time of redemption, sell the sinking fund investments. Sinking fund investment account debtor to cash or bank account. Profit or loss will be transferred to P&L account. Understood? And finally, paying interest is quite common. Paying interest on debentures is quite common. Issue of debentures is quite common. Redemption of debentures is quite common. Sir, what is the intention behind the sinking fund, sir? Sir, redemption of profits. If the redemption is carried on through profits, you are maintaining DRR total 10 lakhs. Sinking fund concept is all about your sinking fund should be 10 lakhs. Your sinking fund investment also should be 10 lakhs. Understood everybody? Because at the end of the year, taking that much amount might be difficult, and hence every year deposit 2 lakhs, 2 lakhs, 2 lakhs, 2 lakhs. So that at the end of 5 years, it will become 10 lakhs for you. Understood everybody? Then how much amount is to be deposited, sir? That will be given in the question. Yes, that will be given in the question. Understood everybody? So logic clear? Till now what I taught for redemption of debentures will be putting under one head. So within the next 10 to 15 minutes at any cost, we have to complete redemption of debentures and we have to start with the next concept, underwriting. Listen very carefully. First one, generalized versions, issue and redemption. In this, the point you have to remember, loss on issue of debentures account debtor to premium on redemption of debentures. As per Companies Act 2013, you have to maintain dash and dash. DRR and at the rate how much percent? At the rate how much percent? Perfect. Clear everybody? Next, redemption out of profits. What you have to check out? DRR is equal to face value of debentures. Next, redemption out of capital. No need to maintain DRR. No need to maintain DRI. Clear everybody? And next, sinking fund. First of all, you have to transfer to sinking fund. What is the entry? P&L account debtor to sinking fund. Then you have to invest. What is the journal entry? Sinking fund investment account debtor to cash or bank. You will get interest. What is the entry? Interest account, cash or bank account debtor to interest on sinking fund investment account. Is this nominal account or not? Close and transfer to sinking fund. So interest on sinking fund investment account debtor to sinking fund sinking fund account. And finally, sell the sinking fund. Sinking fund investment to cash or bank. Profit or loss will be transferred, and redemption of debentures entries are common. Issue of debentures entries are common. Paying interest on debentures is common. Respond everybody, clear? That is a concept of all your issue and redemption of debentures. But out of all these things, this concept is frequently tested for you. Redemption at profits. So you have to check out whether the total DRR is equal to face value of debentures or not. And in the question, he is also giving information about DRI. Likewise, some portion is invested. So you have to write the entry for that also. At the time of redemption, if investment is there, first you have to sell the investment. Don't forget that one. That will not be told in the question specifically, but you have to remember that. Understood everybody? Now, more than this, the next topic is very, very important. That is purchase of own debentures. Just check out one point. I told you something like loss on issue of debentures and discount on issue of debentures will be either redeemed in what is it called, straight line method or any other sum of years of digits method. Here they have chosen ratio of this one. Just check out. See, totally this company is redeeming 25,000 every year. Okay. Total issued debentures are 1 lakh and 25,000 is redeeming every year. So face value of debentures as on first year ending you are having 1 lakh. By the second year ending you will be redeeming 25,000 and the balance is only 75. Third year ending you will be redeeming 25, balance is 50 and finally 25. This one clear? Next one, they are checking the period of usage. Of course, in a year how many months you will be having? But say for example, if the redemption is happened something on 1/1/2021, then this will become 9 months. Understood everybody? And product is nothing but total value of debentures multiplied by number of months used. Clear? So after that one, you will be having one ratio. This part is divided into one ratio, and that is a point of redemption of your discount. Understood? Either discount on issue of debentures or premium on, discount on issue of debentures or loss on issue of debentures will be written off in this part. or straight away if you want, you can also follow sum of years of digits method. Yes, you can follow even that method very comfortably. There's nothing wrong in that. Understood everybody? If you have taken sum of years of digits method, you will be getting something like total years including that year. Likewise, in the first year, you will be having totally 4 years. Am I correct or wrong? 4 years divided by sigma n. Yes or no? So multiplied by how many years remaining, you will be just multiplying with number of years remaining. Clear? So that is what you will be getting, something like 4 plus 3 plus 2 plus 1, which becomes 10 if I was not wrong. Ante kada? Then your amount will, your ratio will become 4 by 10 is to 3 by 10 is to 2 by 10 is to 1 by 10. Straight away you will get 4 is to 3 is to 2 is to 1. నేను మీకు చెప్పా గుర్తుందా, మీకు సమ్ ఆఫ్ ఇయర్స్ ఆఫ్ డిజిట్స్ మెథడ్ లేదు అని. వాళ్ళు ఇంత పెద్దగా చేస్తున్నారు బై యూజింగ్ ది ప్రోడక్ట్ మెథడ్. బట్ ఇఫ్ యూ వాంట్ ఆల్టర్నేటివ్లీ యూ కెన్ ఆల్సో ఫాలో సమ్ ఆఫ్ ఇయర్స్ ఆఫ్ డిజిట్స్ మెథడ్. బట్ దిస్ విల్ నాట్ వర్క్ అవుట్. This will not work out if at all the period of usage is different and if at all the redemption is different. Every year 1 lakh, 1 lakh, 1 lakh redeemed, it will be working out. 1 year 1 lakh redeemed, another year 2 lakh redeemed, then sum of years of digits will not work out. 1 year did not redeem, another year they are redeeming. Getting my point everybody? Even that case sum of years of digits will not work out. Sum of years of digits will be working out only when equal portions of redemption is done every year. Every year not redeemed, sir, then this method will not work out. Not equal portion, sir, then this method will not work out. Understood everybody? Fine. That is the whole concept of your redemption of debentures. And now moving on to the next part, that is redemption of own debentures. Shall I start now? Purchase of own debentures and redemption of own debentures. Okay. Sir, if you are purchasing the own debentures, if you are purchasing your own debentures, it is as simple as such buying back your equity shares. Getting my point everybody? If at all a company had bought back its equity shares, we will call it as buyback of equity shares. If at all company has decided to buy back its debentures, we will call it as purchase of own debentures. Understood everybody? After purchasing these debentures, company is having two options. Option number 1, cancel immediately or hold. Understood? Inka clear ga maatladte reissue. What's the first one? Cancel immediately or reissue, or you can hold. Now next one, if you cancel immediately, that debenture itself is cancelled. If you reissue, it is similar to share itself. Once again it is reissued in the market. And next one, if you held, if you are holding it as investment, and again you can cancel at a later point of time, or you can also sold it at a later point of time. Understood? Likewise, purchase of own debentures. Point number 1, if you want, you can cancel immediately, or if you want, you can sell. Sell is nothing but reissue. More than that, if you want, you can also hold. And after holding, at some point of time, you can cancel, or at some point of time, you can sell. Pakka? Now check out the journal entries. First one, at the time of purchasing your own debentures, listen very, very carefully. Own debentures account debtor, clear? Yes or no? To cash or bank account. Understood? Because you are purchasing your own debentures and hence you are paying the cash amount for that one. Next one, sir, you would like to cancel it immediately. Sir, you are purchasing, say for example, at 98 and you would like to cancel your debentures. 10% debentures account debtor to own debentures account. This is 98, but the face value will always be 100 and the 2 rupees will be transferred to capital reserve account. Why? Because it is a capital profit. So now, say for example, you are purchasing this at 102. Automatically this is 100, but this is 102. So whatever the 2 is there, it is nothing but loss. It will be transferred to P&L account. Understood everybody? This is purchase of own debentures and cancelled immediately. Understood? Next one, purchase of own debentures entry will not change. It is quite common all the time. But if you have ready to invest the same, I mean to tell, if you are ready to hold the same, sir, can you purchase your own shares? No, you cannot purchase your own shares. That terminology is buyback of securities. If you are thinking in that notion, it is correct. But if a question you have got, can a company purchase its own shares? No. That literal concept is nothing but buyback of securities. If you would like to write yes, again you have to write yes, but it has to cancel immediately. Because after buying back, that share will be cancelled. Clear? Now next style of question, something like, can a company invest in its own shares? Can a company invest in its own shares? Na shares lo nene invest cheyacha? No. Because after buying back, you are cancelling it immediately kada. Hey, what is the entry you are writing? Equity share capital account debtor to equity share buyback account debtor to cash or bank. Where is the concept of investment? That is not there. Can a company buy back its own securities or not? Amma cheppandama. Yes, provided can it hold as an investment or for cancellation? Cancellation, pakka. Can a company invest in its own debentures or not? Yes, a company can purchase debentures. Either it can cancel or it can hold. Hold is nothing but investment. Understood everybody? If at all you have decided to cancel immediately, you will be writing own debentures to cash or bank. But if you have decided to invest in your own debentures, then ODI. Own debentures investment account debtor to cash or bank account. Or if you want, you can use another word like investment in own debentures account debtor. Clear everybody? So now at the time of interest. At the time of interest. Listen very, very carefully. Say for example, totally 100 debentures are there in the market. But you have purchased 20 debentures and outside 80 debentures are there. If these 20 debentures are cancelled, obviously no problem. But if these 20 debentures are not cancelled, then this could be your journal entry. Interest on debentures account debtor, strictly speaking, you have to pay for entire 100 debentures. But how much to cash or bank you have to pay? Only for 80 debentures. Remaining 20 debentures, no need to pay any cash because you yourself is holding the debenture and hence it can be directly transferred to interest on own debentures account. Understood? So you just compute the numbers and interest on debentures has to be paid for the old debentures to cash or bank for 80 debentures, 20 since you are holding to interest on own debentures account. This will be closed and transferred to P&L like P&L account debtor to interest on debentures account. Even this will be closed and transferred to P&L, interest on own debentures account debtor to P&L account. This will become your income. This will become your expense. Understood everybody? But say for example, if company has cancelled these immediately, then you should not write it as own debentures investment. It will become own debentures and interest will be paid only on the 80 debentures. Then this lot will not be there. So respond clearer. So, and if company has decided to sell the investment in future, then it will become own debenture investment is getting cancelled. Am I correct or wrong? So cash or bank account debtor to own debentures investment account, profit or loss will be transferred to P&L account. Or if company has decided to cancel the same, then automatically percentage debentures account debtor to own debentures investment account. Clear? Maybe little bit clumsy. I don't know and I hope it is clear. Sure? So ఒక్కసారి మొత్తం అంతా చెప్పేస్తున్నా with respect to own debentures. Check out. With respect to own debentures account debtor to cash or bank account and you will be cancelling it immediately. Percentage debentures account debtor to own debentures account. If you are paying short to capital reserve, if you are paying extra, which is nothing but transfer to P&L account. Clear everybody? Sir, premium on redemption of debentures should not be used here. Premium on redemption has to be used only when the debentures are redeemed. But here you are purchasing. So you should not use that word. Clear everybody? Next, if you wish to hold the debentures, then you will not get this entry. And you will be getting own debentures investment account debtor to cash or bank account. In this context, if you are paying an entry, interest, then interest account debtor to cash or bank account. If you have purchased if you have to pay for 100 debentures and say if 20 were cancelled, then you have to pay interest only for 80 debentures. But if at all the 20 were not cancelled and if you held those as your own investment, then it will become to interest on own debentures investment account. This will be closed and transferred to P&L. This will be closed and transferred to P&L. But this will become an expense. This will become an income. Understood? Okay. This context is also over. Now moving on to the next concept. So if you would like to cancel own debenture investment now, again two options. Number one, if you want you can cancel. Number two, if you want you can sell. If you are selling, now you are getting cash or bank account or to own debentures investment. Say for example, you have purchased it for 98, but you are selling it for 101. So automatically you are having some profit. Am I correct or wrong? That profit will be credited to P&L account. Clear? Or if you are having loss, just reverse, that is like debiting P&L. But if you have cancelled now, then the entry will become percentage debentures account debtor to own debentures investment account. Because if you are cancelling, debentures will be cancelled. If you have sold, you will get the cash. See, the last concept is as simple as such. If you sell, cash or bank account debtor to own debentures investment, profit or loss will be transferred to P&L. If you cancel, percentage debentures account debtor to own debentures investment, if any balancing figure is there, it will be either transferred to capital reserve or P&L. Because capital reserve, I use the word capital profit. Correct or wrong? But at the time of selling investment, it is normal profit only. Understood? That is the whole concept of redemption of debentures. Jagrata, chala concepts cover chesam, and I know I have told it a bit faster. Redemption of debentures, likewise initially generalized versions were covered, where loss on issue of debentures is there and the premium on redemption of debentures is there. And also next we have covered as per Companies Act 2013. Next, redemption out of profits. In the sense you have to maintain debenture face value is equal to DRR. Next, redemption out of capital. No need to maintain DRR at all. And next, sinking fund. Of course, this method may not be asked for you. Most important method is all about redemption out of profits and then purchase of own debentures. At the time of purchase of own debentures, take more care, because if you want, you can either cancel immediately or you can hold. After holding, again you can cancel in future or you can sell. Understood? Yes, you are having all these concepts. And that is the end of your redemption of debentures. So, okay, the next concept, underwriting. Likewise, we have initially discussed that in the concept of issue of shares, you have to check out the concept for minimum subscription. Am I correct or wrong? Say for example, a company is going for an issue of 1 lakh equity shares to public. Okay, but company is newly established. So many of the public may not be having trust on the company. As a trust sangati pakkan bedte, first of all, public may not be knowing about that company itself. Okay, and hence we will be considering one underwriter. Underwriter is a person who takes the responsibility for subscription of the shares. Who is issuing the shares? Company. But company will be issuing the shares on behalf of the underwriter. So underwriter is a person who takes the responsibility or who takes the risk of unsubscribed shares. But more than the risk of unsubscribed shares, he takes the responsibility for subscription of the shares. Hope you have got my point. So if his responsibility at the end is still pending, then he has to bear that risk. Understood? So now, so that is the concept of underwriter. Say for example, company has issued 1 lakh equity shares. We have appointed an underwriter. So as per underwriter, he had made 80,000 equity shares to subscribe by the public. Still how many shares are pending? 20,000. This have to be borne by the underwriter. Understood everybody? And in this context, you have to learn two things. I mean, you have to learn many things. Number one is all about full underwriting and number two is all about partial underwriting. Full underwriting in the sense total issue is underwritten. Partial underwriting in the sense only part of the issue is underwritten and part of the issue is not underwritten. So say for example, company is having its own name in the market. So underwriter was appointed just only for 40%. So his responsibility is only for 40,000 equity shares. Understood everybody? And if you're directly applying to the company, you can also allot with some shares. So full underwriting, the total issue is underwritten. Partial underwriting in the sense only one part of the issue is underwritten. Understood everybody? And this full underwriting is also called as complete underwriting. Understood? And next is all about single underwriting and multiple underwriting. Most of the cases you will get multiple underwriting only. Single underwriting in the sense only one single underwriter will be appointed. Multiple underwriting in the sense more than one person will be appointed. and firm underwriting and regular underwriting. See, the concept of firm underwriting is actually important. Say if 1 lakh equity shares are allotted. Okay, why this firm underwriting is given? Say for example, I was appointed as an underwriter of that company. Okay, and I am telling to all the general public that, hey, you all general public, that company is a good company. Even though it is new, I am underwriting that one. Getting my point, everybody? Likewise, banks can act as underwriter. Say for example, SBI is underwriting for that company. Even though that company is new, SBI is old to everyone. Trust on SBI is more. So on looking the SBI underwriter, public are applying to the company. Understood, everybody? So say for example, I am a famous underwriter and company had appointed me as an underwriter. So I am issuing the shares to all the general public. Okay. But if in this course of action, if myself I am subscribing for some of the shares of that company, do the trust in the public will increase or not? That is a concept of firm underwriting. So firm underwriting in the sense, initially itself underwriter is having an obligation that he has to subscribe for some X number of shares of the company. So if 1 lakh equity shares are issued, initially underwriter will be entering into such a kind of agreement that he is responsible for 10,000 equity shares. 10,000 equity shares. Understood, everybody? And now, say for example, how many remaining number of shares are there? 90,000 equity shares are there. Underwriter's responsibility is to make the subscription of this 90,000 equity shares. Pakka. Hey, now the biggest point that you need to understand is all about, if at all out of 90,000, if at all only 80,000 subscriptions were made, still how many are there? 5,000. Understood? So again, this 5,000 is the responsibility of underwriter. So totally he has to subscribe for how many shares now? 15,000. Clear, everybody? Whenever there is no abatement. Whenever there is no abatement. Clear? Cancellation emi ledu. No additional benefits were given. Then underwriter need to subscribe for 15,000 shares. But if abatement is given, then how many shares do the underwriter needs to subscribe? 10,000 shares. Clear, everybody? I'll tell you in another style, just check out. Say for example, this comes to 15,000. How many shares it comes to? 15,000. So if at all underwriter, sir, strictly speaking, towards firm underwriting, he has to subscribe for 10,000 equity shares. And these 15,000 shares are something like unsubscribed shares. So he needs to subscribe for 15,000 equity shares. On a whole, it comes to 25,000 equity shares. But at the time of entering into the agreement, underwriter told they have agreed that there will be abatement. So whenever these 15,000 shares were subscribed by the underwriter, automatically this 10,000 is met. Correct or wrong? So here underwriter can tell that 10,000 is my firm underwriting, remaining 5,000 I have subscribed. Then what about remaining 10,000? I don't bother. Because underwriter is responsible for those shares which are unsubscribed along with firm underwriting with a clause of abatement. Understood? That word is very important, with a clause of abatement. If abatement is there, whichever is higher shall be considered, not the total. If abatement is not there, total shares will be considered. Understood, everybody? Of course, I'll be discussing abatement point once again. You will be having one problem. At that problem, I'll be discussing. And the next concept is all about marked applications and unmarked applications. What do you mean by marked applications? Those applications which are bearing the stamp of the underwriter, and unmarked applications in the sense those applications which did not bear the stamp of any underwriter. Understood, everybody? So there will be public who may be generally applying directly to the public, which are called as unmarked application. There will be public who have applied to the company through the underwriter, which are called as marked applications. Understood, everybody? Sir, unmarked applications credit will be taken by the underwriters. Unmarked applications credit will be taken by the underwriters. Say for example, there are three underwriters like X, Y and Z. Say X responsibility 10,000, Y responsibility 20,000, Z responsibility 15,000. Now minus marked applications. Say for example, this is 8,000, this is 12,000 and this is 12,000. So how many are still pending? 2,000, 8,000, 3,000. These are pending. Clear everybody? But X has to bear for 2,000, Y has to bear for 8,000, Z has to bear for 3,000. These people are actually ready. 2 plus 8, 10 plus 3, 13,000 shares. Sir, we are very sorry. We are unable to subscribe for the entire issue. 13,000 is still pending. We are ready to subscribe for the shares. But immediately company told, no need. I am having some applications, unmarked applications are there. Many of the public trusted me directly. They have applied directly to me. How many, sir? 10,000, sir. Now you can take the credit of this 10,000 equity shares. In which ratio? That depends. It might be either in gross liability ratio or gross liability less marked application ratio. Understood everybody? It might be either in gross liability ratio or it might be either in gross liability less marked application ratio. Which ratio we have to use, sir? If given in the question, follow that. If not given in the question, your assumption. Generally gross liability will be considered. Clear? But there are many questions even your board material where gross liability less marked applications were also followed. If at all asked in the question very specifically that unmarked applications have to be taken credit only with the gross liability less marked application, you have to follow the same. Respond understood? Now very important, check out. Say for example 10,000, 10,000, 20,000, 15,000. Okay, check out very carefully. 12,000, 8,000, 12,000. Tell me how much? Negative 2,000, 12,000, 3,000. Understood everybody? So strictly speaking, how many shares do they have to subscribe again? 13,000. Will you admit or not? Because X had got some excess applications. Understood? Now this excess credit whatever is there shall be enjoyed by Y and Z always in gross liability ratio. This is very important. This will never be in gross liability minus marked applications. Understood everybody? This will be always enjoyed in gross liability ratio. So distribute this 2,000 to Y and Z in the ratio 20,000 is to 15,000. That is nothing but 5, 4 is to 3. 4 is to 3 ratio. Understood everybody? So after the giving of credit with these two items, then you can check out for unmarked applications. Unmarked applications can be given either under gross liability ratio or gross liability less marked applications ratio. It will be dependent. Sir, while giving the credit of marked applications, you have to give only for gross liability ratio. But unmarked applications can be either in gross liability or gross liability minus marked applications. Understood everybody? Okay. So, and if any firm underwriting are there, you have to again understand whether this firm underwriting is considered as marked applications or unmarked applications. If firm underwriting is treated as marked application, you can directly add to the respective underwriters. If firm underwriting is treated as unmarked applications, you can distribute the same along with unmarked application either under gross liability ratio or gross liability minus marked applications ratio. Understood everybody? Just check out. Again say 10,000, 15,000, 12,000. Understood everybody? Say for example, firm underwriting. In addition to this, firm underwriting is included in 10, 15 and 12. How much is that, sir? 2,000, 2,000, 3,000. Clear? Balance how much is there? 8,000, 13,000, 10,000. This is the responsibility. Okay, 9,000. This is the responsibility. Now, minus, you just have to deduct the marked applications. Clear everybody? So say for example marked applications are 4,000, 10,000, 9,000. So automatically it will become 4,000, 3,000, nil. Clear everybody? Say for example you are having unmarked applications also. Unmarked applications are 2,000. Clear? Now at this stage you be careful. How the firm underwriting are treated as? If the firm underwriting are treated as marked applications, you forget that. and whatever these 2000 unmarked applications are there, distribute to X and Y either under gross liability ratio or gross liability less marked applications ratio. Clear? Say for example, let us assume you have got something like 900 and 1100. For example, clear? And then you have got something like 3100, 1900. Clear? At this stage, directly add the firm underwriting. 2000, 2000, 3000. Where it will become 5100, 3900, 3000. Understood? Pakka? Hey, but my dear children, at this stage you be careful. If firm underwriting, just wait. Let me take some other color. If firm underwriting is treated as unmarked applications, then along with this 2000 plus 2 plus 2 plus 3, 5, 6, 7. So totally 2000 plus 7000. Understood? And then finally firm underwriting will be added for sure. Clear? That is the whole concept of your underwriting. So please be careful. You have to check out how the firm underwriting is treated as. If the firm underwriting is treated as marked applications, then you will be deducting respectively and adding respectively. If it is treated as unmarked applications, then you have to distribute this 2 plus 2 plus 3 in the ratio, either in gross liability or in gross liability less marked applications. And always please be careful, Amma. You will be asked with the questions of firm underwriting only. Understood, everybody? So just check out. We'll be showing you the different things here. And one more thing, underwriters will be having some commissions for sure for the work done. So if it is shares, maximum commission will be 5%. If it is debentures, maximum commission will be 2.5%. Very important on issue price, but not on the face value. Dividend will be paid on the paid up value. Dividend will be declared on the paid up value. If there is a clause in articles of association, then it will be paid on the face value. But underwriting commission will be on the issue. Generally, commission will not exceed that price, but less than that is quite possible. So just check out. In the main question itself, you will be asked, unmarked applications are apportioned on gross liability ratio. Hope you are able to see. And unmarked applications are apportioned in the ratio gross liability less marked applications. So this one and this one, which will be in the ratio 80:80:40. If it is gross liability less marked applications, if it is under gross liability, then it is obviously 16:12:12. Okay. So if you check out 12:12, 36:36 equal. And if you check out this one, 80 and 80, 48:48 equal. అంటే మీకు రేషియోని ప్రూవ్ చేస్తున్నా, నేను కంప్యూటేషన్ని ప్రూవ్ చేయట్లేదు, రేషియోని ప్రూవ్ చేస్తున్నా. అండ్ నెక్స్ట్ వన్, దిస్ ఇస్ quite common. Adjustment of surplus is there. If you check out, see, if you check this one, you will confuse for sure. Because what happened, initially, marked application, even though he is having some credit, okay, he had distributed this credit only after deducting the unmarked applications. Clear? But here if you check out, first he had adjusted the credit of marked applications and then finally gone with unmarked applications. There is nothing great in this. It is as simple as such. Sir, credit of marked applications will be given only in which ratio? Gross liability. And also for your kind information, unmarked applications were also distributed in gross liability ratio. Understood? And hence he has done this, and finally credit is given in gross liability ratio. But here what happened, this should be given only in gross liability ratio kada. So first this was done, and finally unmarked applications were deducted in gross liability minus marked applications. Understood? So in order to avoid all such confusions, why to deduct, when to deduct, I told you very clearly that, check out, you take the number of shares, that is like total issue or total number of shares, okay, minus marked applications. Immediately you give the credit every time. First instance you give the credit every time. Understood? In which ratio? Then you will be getting one ratio. Then you deduct unmarked application. Unmarked application, it will be very simple. If you treat it as gross liability ratio, initial will come. If it is gross liability less marked application, revised ratio will come. Understood everybody? I mean to tell, you can do the credit of marked applications first and then you can distribute unmarked applications. There will be nothing wrong in that. అంటే ఒక్కొక్క సమ్ని ఒక్కొక్కలా చేయకుండా అన్ని సమ్స్ లో కూడా ఇఫ్ యూ హ్యావ్ క్రెడిట్ ఆఫ్ మార్క్డ్ అప్లికేషన్స్ ఫస్ట్ డిస్ట్రిబ్యూట్ ద క్రెడిట్ ఆఫ్ మార్క్డ్ అప్లికేషన్స్ అండ్ దెన్ గో విత్ అన్మార్క్డ్ అప్లికేషన్స్. అండర్స్టూడ్? ఓకే. నెక్స్ట్, yes, firm underwriting with alternative treatment and adjustment of surplus. If you check out, so this is the gross liability after deducting the firm underwriting, and finally this firm underwriting will be added. Clear everybody? How to add this firm underwriting? While adding this firm underwriting, it can be added directly if it is marked applications. If it is unmarked applications, then you distribute either in gross liability or gross liability less marked applications. Understood? Something like in the example previously I told you, this one. If you want, you can just distribute unmarked applications and wait. At last, you are adding this firm underwriting. Am I correct or wrong? You are adding directly. Check out, whatever is deducted 2 to 3 is added directly. Firm underwriting or treated as marked applications. If you treat firm underwriting or treated as unmarked applications, then you add the same in one specific ratio. Understood everybody? Assume that you have received. Actually, you have to treat that firm underwriting is received. How much is firm underwriting received? 2 plus 2 plus 3, which is nothing but 7,000. So totally this will be distributed in one specific ratio. Understood? So it is as simple as such, nothing great at all. Okay. Here firm underwriting is treated as marked applications. Even here also firm underwriting is treated as unmarked applications, and hence if you check out gross liability 6,000, 2,500, 1,500, just wait, I'll be showing you the difference. Firm underwriting are treated as unmarked applications. If you check out now, I told you to add this 2,000 plus 7,000. Did you remember? So look the logic. Total unmarked applications are, check out the question now. Total subscriptions were 7,100 and the forms includes the following. So 7,100 minus 1,000 minus 2,500. నన్ను చూస్తే ఏమొస్తుంది? ఎంతమ్మా? Balance. This 3,600 will become your unmarked applications. And check out how many firm underwriting are there. 1,300 plus 800. 2,100. So totally, if firm underwriting is treated as unmarked application, then 2,100 will be added to that unmarked application and totally 5,700 will be distributed. Clear everybody? So that might become this total, whatever. And next, coming to here unmarked applications, it will be distributed only for the remaining portions. Understood? కానీ ఇక్కడ unmarked applications చాలా తక్కువ ఉన్నాయి. We might have missed some things. Total 10,000. Following underwriting took which invited applications while X, Y and Z. In addition, there are firm underwritings. Subscriptions included 7,100. So 3,600 unmarked applications were distributed in gross liability. How much you have got? 3,600 in the ratio 12:5:3. Okay. 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 And finally he had added firm underwriting. And here since he had treated it as unmarked applications, okay, fine. balance were considered. So sir, ee question ki nenu cheppina question ki difference undi, because nenu cheppina question lo I had initially given you the gross liability, and here in this question he had given, in addition to this one, this is the firm underwriting. Hope you have got my point. So my computation will be different and this computation will be different for sure, because initially I taught you that one, and a firm underwriting is included in that, and here in addition to the above figures firm underwriting is given, and he is considering only the net gross liability finally. Okay, so and moreover here firm underwriting got treated as unmarked application, so directly it was done, and if firm underwriting got treated as marked applications, then how much is the firm underwriting for us? 2100. So if you can check out this one, total application received are 7100. Okay, and 2100, there is 2100, this one. Okay, and 3600 is the total amount, I mean total number of shares. So 1800, 2300 and 1500 total data. Yes, marked applications 1000, 2000, 500. Okay, and firm underwriting so treated as marked applications, so 800, 300 and 1000. So total marked applications were considered 1800 plus 2300 plus 1500. Sorry to confuse, my example is different, this example is different. In this example I am telling you how to compute. See, if at all the firm underwriting is treated as unmarked applications, you can do it just like normally, and at last you can add firm underwriting. There ends the matter. If firm underwriting is treated as marked applications, then treat this firm underwriting along with the marked applications that were received. Clear? And then automatically 18 plus 2300 plus 1500, where you will be getting 5600, and totally 7500 minus 5600, you will be getting 1500 unmarked applications. Clear? Sir, coming to underwriting, there will be deemed assumptions chala untai. So firm underwriting, I'm just giving you the final conclusion. Sorry to put you in different styles of confusion. So let me tell you the final conclusion. Firm underwriting can be treated as unmarked applications. Firm underwriting can be treated as marked applications. Find the gross liability initially. Gross liability in the sense after firm underwriting. Do the problem normally, likewise till now what we have taught, do it normally, and at last add firm underwriting. There ends the matter. But if at all these were treated as marked applications, then first check out the gross liability, that is after firm underwriting. This is point number 1. Now for marked applications received, add firm underwriting. Clear everybody? Then you deduct unmarked applications, that is like do normally, and finally at last add firm underwriting actuals. In the sense whatever is as per their agreement, you will be adding the firm underwriting at last. Understood everybody? So firm underwriting is given under a credit, either under marked applications or under unmarked applications. My dear children, nenu cheppina example totally different, because in my example I told you firm underwriting is treated as marked applications, firm underwriting is treated as unmarked applications. That is not the questions we are discussing. As per this question, firm underwriting had given a credit under marked applications or given a credit under unmarked applications. Clear? So as per your questions, you will not be having the treatment. Okvela treatment ani ichina credit e tiskuntunnaru ante ide. Clear? This is what the finality. So find the gross liability, that is after firm underwriting, and you just do the problem normally. At last add firm underwriting to the final figures. If firm underwriting got treated as unmarked applications. If the firm underwriting got treated as marked applications, then you find the firm gross liability after firm underwriting, and then the marked applications plus firm underwriting, because firm underwriting is treated as marked applications, and then you will be deducting unmarked applications, and finally you will be getting firm underwriting. Understood everybody? So here and here difference ekkada ostundi ante difference in the count of unmarked applications. Am I correct or wrong? Here unmarked applications may be 5,000 including firm underwriting, but here unmarked applications might be only 2,000 because firm underwriting, the remaining 3,000 were treated as marked applications. Understood everybody? Take care, between these two things difference will be getting only in one situation. That situation is about count of unmarked applications. Initially count of unmarked applications may be including the firm underwriting also, okay, whereas afterwards, that is in the second slot, this firm underwriting is treated as marked application, so marked application count will increase. So unmarked applications, here it will be more, unmarked applications, here it will be less. Marked applications, here it will be less. Marked application, here it will be more, because marked application includes firm underwriting. Here unmarked application includes firm underwriting. I hope the final is clear to each and everyone. And ee statements avi cheppin tarvata inkoncham clear vachindi anukuntunna, but I'm literally sorry to confuse you. Meekunna syllabus prakaram aithe this is the finality. Okay everybody, that is the concept of your underwriting. Abatement I told you, did you remember? See, no abatement is allowed for firm underwriting. Abatement is allowed for firm underwriting. Just check out this one. See, net liability under the contract is something like deficit 2,400. First of all, just you look at the question very carefully. Abatement provided, abatement allowed, and if no abatement is allowed, then what is the situation? Check out, totally 20,000 shares where 60% is underwritten. So 20,000 into 60%, something like 12,000. And next firm underwriting is 1,600. Okay. Company received 13,600 shares. Clear? So now check out. Out of 30,600 applications, 8,000 were marked applications. So what is the gross liability now? Initially 12,000. Correct or wrong? Minus 8,000 are marked applications. Of course, yes. And also you might have checked out that firm underwriting. If you deduct firm underwriting 1,600, then the balance will be 2,400, which will be your liability. Correct or wrong? And now, if you check out number of unsubscribed shares, 20,000 are the total shares and 13,600 are the total shares received by the company. And total number of shares is 6,400 shares. Clear? Two slots you have to find out. Be careful. Total number of shares offered minus total number of shares subscribed will be giving you unsubscribed shares. So totally 20,000 shares are there. Minus 13,600 applications were received, include both marked and unmarked. And totally unsubscribed shares are 6,400. Keep it aside. Now come to the second part. Likewise, underwriter's liability is only 12,000. Minus 8,000 is like marked applications. And also if nothing is mentioned, firm underwriting will be treated as marked applications, and hence minus another 1,600. And finally his liability will be only 2,400. Understood everybody? So now finally check out, if at all when no abatement is there, when no abatement is allowed, then net liability under the underwriting contract, that is 2,400 plus firm underwriting 1,600 he has to bear for the entire 4,000 shares. Understood? Whenever abatement is allowed, then 2,400 shares or 1,600 shares, whichever is higher. What is 2,400 shares? Total deficit of underwriter. And 1600 shares is nothing but firm underwriting. So whichever is higher, 2400 shares, which is nothing but if he is subscribing for that 2400 shares, since the abatement is allowed, some cancellation is allowed, some relaxation is there, automatically it seems that 1600 is subscribed. Clear? So then what about the remaining 1600? He is least bothered about that. Why he is least bothered about that, sir? Because abatement is allowed as per your contract. నువ్వు రాసుకున్న కాంట్రాక్ట్లో అబేట్మెంట్ ఉంటే ట్రీట్మెంట్ ఇలాగే ఉంటుంది. క్లియర్ ఎవ్రీబడి? బట్ దిస్ ఇస్ ఆబ్వియస్లీ సి కేటగిరీ క్వశ్చన్, అంటే దిస్ ఇస్ నాట్ దాట్ అన్ ఇంపార్టెంట్ క్వశ్చన్. బట్ యూ జస్ట్ రిమెంబర్ ఓన్లీ వన్ థింగ్, వెన్ అబేట్మెంట్ ఈస్ దేర్, విచ్ ఎవర్ ఈస్ హయ్యర్. If abatement is not there, you have to bear the total liability. Clear everybody? That is 2400, and next is firm underwriting 1600. Pakka? That's it. So in the entire concept of your underwriting, just take care. Two things you have to be careful. Number one, first give the credit of marked applications all the time. Forget about your solutions, forget about your printed solutions given in material in different problems in different styles. First you give the credit of unmarked applications, then you can give the credit of first you give the credit of marked applications, always in which ratio? Gross liability ratio. And then give the credit of unmarked applications either in gross liability ratio or gross liability minus marked application ratio. That is of your choice. If nothing is mentioned, this is the better pick. Clear everybody? And second point, whenever this firm underwriting is there, please be careful in this situation. If firm underwriting is treated as unmarked applications or marked applications, you have to check out. If firm underwriting is treated as marked applications, then marked applications count will increase. And if firm underwriting is treated as unmarked applications count will increase. And at last, you just have to add firm underwriting as per the contract. Understood everybody? After this one, you do the counts normally. You have to find how many are marked applications, how many are unmarked applications. And in that case, marked applications will be more. In this case, unmarked applications will be more. Marked applications will be deducted on an actual basis. Unmarked applications will be deducted either on gross liability or gross liability minus marked application basis. And after doing all the problem, at last you have to add firm underwriting. That's it. Understood everybody? And last but not least, about abatement. If abatement is allowed, then firm underwriting or finally net liability, whichever is higher. If no abatement is there, firm underwriting and net liability, you have to add those two things. Pakka? That is the final concept of your next one, underwriting. Okay. So in underwriting, things you have to take care. Credit of marked applications okati, and firm underwriting okati. Credit of marked application first, always in gross liability ratio, then unmarked applications either in gross liability or gross liability minus marked applications. Firm underwriting kuda two things you are having, either if treated as marked applications, if treated as unmarked applications, then the count, respective count will increase. After this one, you have to check out unmarked applications which is less, marked applications which will be less. Ante kada? Because if firm is treated as unmarked will be more, marked will be less. If firm is treated as marked will be more, unmarked will be less. Now after finding the count, find count and then do the problem normally. Last what you have to do, add firm underwriting. And third concept is abatement, not that important, but if abatement is yes, then net liability or firm underwriting, whichever is higher. If no, then net liability plus firm underwriting. That is the end of your underwriting. Just there ends with this concept. So this is over. And preparation of financial statements. Don't feel that the topic is very, very difficult or something like that. Fill the format, fill the format. Yes, what you heard is correct. Learn the format, fill the format, and you just fill the format. Apart from that, nothing great is needed. Okay. So even in your main examination, be sure about the heads. Sir, okkate chapta gurtu pettukondi. Nobody is perfect in writing the answers, especially when you are a student. It's not possible. So if at all you are attempting more than 70% of your paper or more than 80%, it is a good thing. Best enti ante attempting 100 marks may not be possible to each and everyone. Attempting 80 marks and 90 marks is a good thing. That too in a lengthy questions like preparation of financial statements, if you have attempted up to 70% or 60%, it's a good thing. Ante you should not feel like I am unable to do that problem. Meeku paper anta undi. Paper lo oka question choice lo poga inkoka question you are just able to solve only 70% or 60%. It's a good pick. And you should not drown yourselves. You should not demotivate yourselves. Just pull up your confidence. Anyways, let me start with the same. Preparation of financial statements. A lengthy point. I'll admit that it is of course lengthy. So you'll be having both balance sheet and P&L account. So first let me complete with balance sheet. And then let me go with P&L account. Just formats, nothing more than that. And then I will be telling you about how to treat DTA and DTL. Okay. Coming to DTA and DTL, he will be giving income tax rate. And from that you need to find current tax or provision for tax. And you have to compare accounting profit. In the question he will be giving income tax profit and income tax rate. From that you have to find current tax or provision for tax. And then as per accounts you have computed that and you have to find the tax. You have to compare these two things. I will tell you it in a very simplest way. Finally you'll feel DTA and DTL is also easy for sure. But first let me start the same. Just give me 1 minute, okay? With preparation of financial statements, form of balance sheet. But before that one, just what includes in financial statements? Balance sheet, P&L account, yes, statement of balance sheet or statement of profit and loss account. Next, cash flow statement, statement of changes in equity, and finally notes to accounts. These are all the inclusions that we are having. Clear? Now listen very carefully. You are having cash flow statement as a separate chapter. You are having form of balance sheet. You are having form of P&L account. You are also having statement of changes in equity. Yes, you are even having statement of changes in equity also. And finally notes to accounts. So let me start with the first one, that is all about balance sheet. So coming to form of balance sheet, Roman number 1, equity and liabilities. What is Roman number 1, Amma? Equity and liabilities. Under equity and liabilities, the first one, shareholders funds. Under shareholders funds, share capital, B, reserves and surplus. Of course, you are having money received against share warrants, but no need to consider that one because in no problem you are going to get that. And also you are having one more thing, something like share application money received but pending allotment. Even that is also not required for problematics, and hence even I am not covering that one also. So straight away would like to start with the second one. That's all about non-current liabilities. What is the second one, Amma? Non-current liabilities. Under non-current liabilities, LDOL, LDOL. Yes, long-term borrowings, deferred tax liabilities, other non-current liabilities, long-term provisions. Yes, LDOL. And next one, current liabilities. And current liabilities, it is all about STOS, where you are going to get short-term borrowings, trade payables, other current liabilities, short-term provisions. Clear, everybody? Let me go with the deep discussions of each and everything. First one, share capital. Coming to share capital, what you have to show? You have to show authorized share capital separately, and you have to show issued, subscribed and paid up capital separately. What will be taken to the balance sheet? That is issued, subscribed and paid up capital, but not authorized share capital. Authorized share capital is just for informative section. Now coming to issued, subscribed and paid up capital, you will be having some X number of shares. Say for example 1 lakh equity shares of rupees 10 each, comma, I also put the paid up portion, whether fully paid up or partly paid up, that number you will be having, right? So you just put that number and you will be getting the total amount. And next one, number of preference shares, percentage of rupees something 100 each, comma paid up, and you will be getting the total amount. And this is the total paid up portion. What is it? Total paid up portion. Hey, morning I've told you one example with Forfeiture. Did you remember? 4 shares were not reissued. On 4 shares, 4 rupees is paid portion. So 4 multiplied by 4 is nothing but 16, which is nothing but balance of Forfeiture amount. What is that called as? Balance of Forfeiture account or amount. So add Forfeiture of shares which are not reissued. Forfeiture of shares which are not reissued, because if at all the shares are reissued, it will be transferred either to capital reserve or it will be set off against the loss on reissue. Did you remember? For loss on reissue and capital reserve, this forfeiture of shares portion is accounting. So forfeiture which is not reissued will be coming here. And this is the final total where you have to transfer it to share capital. Understood everybody? So everybody, what is note number 1? Share capital. Sir, participate. What is note number 1? Share capital. Share capital includes dash and dash. Authorized share capital, issued, subscribed and paid up capital. Which capital is only information? Which capital will be taken? For issued, subscribed and paid up, you have to add a dash. Forfeiture of shares which are not reissued. Clear everybody? Forfeiture of shares which are not reissued. Pakka. There ends with note number 1. And next is all about reserves and surplus. Coming to reserves and surplus, whatever kind of reserves you are having, take all those reserves. Whatever kind of reserves you are having, take all those reserves. Sir, if it ends with the reserve, then it is a reserve. If it is end with a fund, it is a reserve. Sinking fund is a reserve. Dividend equalization fund is a reserve. Clear everybody? If it is ending with reserve, it is obviously reserve. Like development rebate reserve, general reserve. Okay. Of course, reserve fund is also reserve. There will be some items which is not ending with reserve or fund, even though those are reserves. Number 1, securities premium. Number 2, employee stock options outstanding. And finally, number 3, P&L account. Understood everybody? So in reserves and surplus, what do you get? All the reserves, all the funds, securities premium, employee stock options outstanding, P&L account. P&L account is nothing but profit. Even if loss, it will be coming under reserves and surplus itself, but it will be shown as a negative figure. Clear? If profit, it will be shown normally. If loss, it will be shown in a negative figure. Pakka everybody? So that is what about reserves and surplus. So now, statement of changes in equity, which is not given separately, but it is a form of note 1 and note 2. What you will be doing? Take equity share capital. Take preference share capital. Likewise, opening some number. I'm speaking about number. Getting my point everybody? Add. Further issue. If any is there, it will be added. Minus. If any buyback is there, it will be deducted. And then you will be putting closing. Clear everybody? Yes, you are perfectly having these statements. This statement is literally nothing but statement of changes in equity. This statement is nothing but statement of changes in equity. Even preference shares, take the opening, add, issue, minus, redemption of preference shares, finally you will be getting closing. Perfect everybody? Next, coming to reserves and surplus, take all the reserves. Likewise, whatever reserves you are having, you can take all those reserves like P&L account, capital reserve, capital redemption reserve, debenture redemption reserve, general reserve. Take every reserve and put opening. Add current year transfers or current year additions. Minus utilizations. If any things were utilized, it will be deducted. Understood everybody? And finally, you are going to get closing. These two things are nothing but, sir, this one and this one together called as statement of changes in equity. These two things are called as statement of changes in equity. Pakka everybody? There ends with statement of changes in equity. And now moving on to the next one, that is all about non-current liabilities, long-term borrowings. You will be hardly having only these two things. Generally, you will not have these two things. Long-term borrowings. As you all people know what is long-term borrowings. Likewise, all the debentures, loans. Getting my point, everybody? But company is having some liability which is nothing but a loan, and that loan is to be repaid greater than or equal to 12 months. Greater than or equal to 12 months. That we will be calling it as long-term borrowings. Of course, in this connection, you are having operating cycle, and also you are having current liabilities, and you are having non-current liabilities, current assets and non-current assets. This all discussion I am going to do in Ind AS number 1. This discussion I am doing in Ind AS number 1, which is presentation of financial statements. Anyways, so coming to long-term borrowings, which has to be repaid more than or equal to, more than 12 months. If it is less than or equal to 12 months, short-term borrowings. Clear, everybody? It must be a loan. If it is greater than 12 months, long-term, less than or equal to 12 months, short-term borrowings. And one more thing I have forgotten to tell you here, fund. If that fund is exclusively for outsiders, likewise provident fund, pension fund, gratuity fund. Getting my point, everybody? This will be treated as long-term provisions. This will be treated as long-term provisions. If there is a fund, generally fund is equal to dash. Yes. Generally fund is equal to dash. Reserves. I told you. Sinking fund, debenture redemption fund, investment allowance fund. Clear, Fund is equal to dash. Afternoon first period AC గట్టిగా వేసారు పొట్ట నిండా తిన్నామని పడుకుంటూ పోకూడదు. Topaz fellows. Fund is equal to dash. Reserves. But take care, if at all that fund is exclusively for the purpose of outsiders like pension fund, provident fund, gratuity fund, these are exclusively created for the purpose of employees. These are not for the purpose of owners. Funds created for owners will be coming under reserves. Funds created for outsiders will be coming under long-term provisions. Pakka. Okay. And yes, for tax liability, my discussion will be at last of this concept. And next one, trade payables. Trade payables is nothing but creditors. So whatever the creditors, if the period is given less than equal to 12 months, 0 to 6 months, 6 to 12 months, if at all the period is given less than 1 year, 1 to 2 years, 2 to 3 years, you put it here. Clear, everybody? And moving on to the next thing, other current liabilities. Other is very simple. Whatever does not fit under any other category will be coming here. You are having good discussion with this one. And short-term provisions. Short-term provisions are nothing but provisions which are created, but those will be utilized within 12 months. Likewise, provision for tax is the best example. What is that one? Provision for tax. Also provision for repairs and renewals. Provision for warranty. All these things will come here. Respond clear? Now another discussion is with other current liabilities. Check out. Coming to other current liabilities, you are having many things. Likewise, outstanding expense. Yes, outstanding expense is a liability and it is under other. Also, income received in advance. See, if it is income receivable, it will become your asset. But income received in advance, already received, which is your liability, it will be under other current liabilities. Did you remember if 1 lakh shares are issued, you got 1,20,000. How many shares you can allot? 1 lakh. How many you have to refund? So, application money due for refund. Hey, I am telling due for refund, not application money pending allotment. Application money pending allotment is a separate head. We are not speaking about that one. Now for 1 lakh shares allotted, still 20,000 are pending. That has to be refunded. So that will be coming here. Clear, everybody? And next about the declared dividend. If at all any dividend is declared before the completion of the financial year. Any dividend if it is declared before the completion of the financial year, that will be under other current liabilities. Of course, we are having a tax discussion and dividend discussion after at the end of this balance sheet. Clear, everybody? And next concept is about unclaimed dividend or unclaimed interest. Likewise, company has to give the dividend, declare the dividend. It is giving to all the shareholder, but one particular shareholder did not provide his address properly, did not provide his contact numbers properly, did not provide his bank details properly. Company is ready to give, but shareholder is not ready to take. So it is called as unclaimed dividend. If the same is with debenture holders, we will call it as unclaimed interest. Understood, everybody? In the same way, you are having unclaimed redemption of preference shares, unclaimed redemption of debentures. What is that, sir? So all the debentures are redeemed. So everybody I have paid, but one particular shareholder did not provide the details properly and hence I was unable to pay him properly, which is nothing but unclaimed redemption of preferences and unclaimed redemption of debentures. Even it will be coming under other current liabilities. So other current liabilities is not small, it is too vast. It is vast. So ఇప్పుడు మమ్మల్ని ఏం చేయమంటారు సార్? You just identify Esops. Is it loan or not? If it is a loan less than or equal to 12 months, it comes under short-term borrowings. If it is a creditor for less than or equal to 12 months, it comes under trade payables. If it is a provision, then it will be coming under short-term provisions if it is less than or equal to 12 months. Whatever does not fit under this category and whatever is others will be coming under this category. Clear everybody? Like that you filter. And next one, if at all you are having a creditor which is to be repayable after 3 years. Creditor repayable after 3 years. Long term or short term? Long term and immediate ki mind should strike out. LDOL. Is it long term borrowing? Is creditor borrowing? No. Is it deferred tax? No. Is it provision? No. It comes under other non-current liabilities. Others ఎలా ఫైండ్ చేయాలో అర్థమైందా? So you have to take more care. Now tell me gratuity fund. Gratuity fund is for the purpose of employees. So it comes under long-term provisions. Understood everybody? Sinking fund. That is reserves. Sinking fund is under reserves. Pension fund. Long-term provisions. Clear? Provision for repairs and renewals. Short-term provisions. Provision for warranty. Cheppali. Short-term provisions. Provision for bad debt. It will not come like that. Since it is asset-related provision, it should be deducted from the asset. So provision for bad debt has to be deducted from debtor. Provision for depreciation has to be deducted from fixed asset. Logic clear? Pakka. That is the end of total liabilities. So share capital, you will be having authorized, just information, issued, subscribed and paid up. For this one you have to add forfeiture of shares which are reissued or not reissued. Not reissued because reissued already accounting treatment done. So this total will be transferred to balance sheet. Reserves and surplus. Reserve fund. And next P&L account, securities premium, Esops, employee stock options outstanding. Even if it is loss, it will be shown under reserves and surplus, but it will be shown as a negative balance. Pakka. Even if it is loss, it will be under the same category, but it will be just shown as a negative balance. Pakka everybody. And moving on to the next thing, now coming to long term or non-current. Just remember the code I told you. LDOL. Long term borrowings, deferred tax liabilities, other non-current liabilities, long-term provisions. Forgot about tax for some while. Now you have to check out. If it is less than or equal to 12 months, current. Current in the sense Esops. If it is more than 12 months, it comes under long-term, which is LDOL. Now if it is borrowing, more than 12 months, long-term, less than or equal to 12 months, short-term. If it is creditor, more than 12 months, long-term under other non-current liabilities. Clear? If it is less than or equal to 12 months, trade payables. And if it is provision, check out if it is greater than 12 months, long-term provision, less than 12 months, it comes under short-term provisions. Provided that provision is not related to asset. If there is a provision that is related to asset, it has to be deducted from the asset. Sir, ఖచ్చితంగా ఫాస్ట్ గానే ఉంటుంది. మీరు చాలా ఫాస్ట్ గా ఫాలో అవ్వాలి. If at all there is a provision which is relating to asset, it has to be deducted from the asset. If at all there is a provision which is for greater than 12 months, long-term provision, less than or equal to 12 months, short-term provisions. And coming to funds for outsiders, gratuity fund, pension fund, provident fund, these are to be treated as long-term provisions. Ante, if it is provision, you can identify easily. But pairlo provision leduga. Clear? So you get employee stock options outstanding is also reserves. Pakka. That's the end of liabilities. And let me start with assets. Very, very simple. Coming to assets, yes, first one is all about non-current assets. Under non-current assets, under first one, you are having 4 things, A, B, C, D, which is nothing but PPE, intangible asset, capital work in progress, intangible assets under development. Clear everybody? So take care. Inka strict ga aithe non-current assets lo first one you are having something like fixed assets. In that 1, 2, 3, 4. Okay. Likewise, Roman number 1. What is Roman number 1? Roman number 1. Bonda. Equity and liabilities is Roman number 1. Clear? Now our discussion is with Roman number 2. What is Roman number 2? Assets. Under Roman number 2, first one, non-current assets. Under non-current assets, A. Under A, 4 bits are there. There is no name for A, okay? There is no name for A. So what are the 4 things? PPE, property, plant and equipment, which is nothing but tangible fixed assets. Intangible assets, as you all people know, and capital work in progress, PPE under development. Likewise, if it is a finished building, we will call it as a tangible asset. If it is a building under construction, we will call it as a capital work in progress. Clear, everybody? And finally, intangible assets under development. See, if it is a tangible asset under construction, capital work in progress. If it is intangible asset under development, we will call it as intangible assets under development. Anyways, for the examination, you will not need with these 2 things, but these 2 are important. So now how to go with this thing, sir? Sir, PPE and intangible assets, you have to show the reconciliation. Likewise, you will be showing, what is this called? Yes, first pick out the opening balance. Add, if any purchases. Minus, if any sales. Add, if any revaluation upward. Minus, if any revaluation downward. Minus depreciation. And finally, you will get closing balance. Pakka. Sir, take care if it is cost price. Then this will become provision for depreciation. Yes or no? Because if provision is there, asset will be shown at cost price. And finally, you will be getting closing balance. Pakka. This is what the concept of PPE. And also the same concept is applicable for intangible assets. But in intangible assets, generally there will be no concepts of revaluation. And it is not called as depreciation. We will call it as amortization. Okay, now, that is all with respect to your non-current assets. So tell me, under non-current assets, how many bits are there? But what are important for exam? 2. What is the first one? PPE. What is the second one? Intangible assets. You have to reconcile how the opening balance had become the closing balance. Like opening balance, add purchases minus sales, add revaluation upward minus revaluation downward minus depreciation. If asset is shown at cost price, then depreciation will become provision for depreciation, and finally you will be left with closing balance. Pakka. That's it. And if it is intangible assets, there will be no depreciation. Instead of that, you will be having amortization. And next one, listen carefully. That's something like B, non-current investments. C, long-term loans and advances. D, E, deferred tax asset, other non-current assets. Very, very simple. Sir, if at all company is having, and 1 second, let me also deal with the second slot, that is second one, current assets. Under current assets, your order ITC S. So first one, short-term investments. Next one, inventory. Next one, trade receivables, cash and cash equivalents, short-term loans and advances, other current assets. Again same, picking others are very, very easy. So you just check out whether it is becoming all the things or not. If any other thing is not came, then you will be going it under others. So now let me start with the first one, non-current investments. Coming to non-current investments. Sir, company is having investments. Am I correct or wrong? Investment in shares, investment in debentures, or investment in some other companies, something like that. If the investment is greater than 12 months, it will be coming under non-current investment. If the investment is less than or equal to 12 months, it will be coming under short-term investments. You have to again show what is the opening balance, if add any new investments or purchase, minus if any investments are sold, and finally you will be putting the closing balance. And next one, if at all, sir, company had taken a loan, we will call it as borrowing. Company had taken a loan, we will call it as borrowing. If company had given a loan, we will call it as loans and advances, which is your asset. If company took a loan, borrowing, liability. If company given a loan, loans and advance, asset. So long-term loans and advances. If company had given a loan and the repayment by the outsider will be done more than 12 months. If company had given a loan to the outsider and if he repays within 12 months, then we will be calling it as short-term loans and advances. Deferred tax asset, our discussion will be at last. And other, as just I already told you, if it is not under any other category, it will be coming here. Now coming to inventory. As you all people know, closing stock. Okay, whether the stock is in the form of finished good, work in progress, stores and spares, loose tools, whatever kind will be coming here. And trade receivables, which is nothing but debtors and bills receivable. Bills payable will be under trade payables. Bills receivable will be under trade creditors. And trade receivables. And next, cash and cash equivalents. Whatever cash in hand, cash at bank, and any other things will be coming under cash and cash equivalents. Next, other current assets. Whatever is not fitting under any of the categories will be coming under other current assets. Pakka? Okay. So, now the next discussion. Listen. How to open the notes to accounts. First, while solving the problem, you just go through the question. After going through the question, you identify the head first. Getting my point, everybody? I'm telling how to solve the problem. You just go through the question. After going through the question, you just mark which head is this one. Write the head there. And now start the solution by filling the format. First, you forget about everything and start. Roman number 1, equity and liability. First one, share capital. Second one, reserves and surplus. Of course, shareholders funds. A, share capital. B, reserves and surplus. Second one, non-current liabilities. Now check out in the question. Okay. So if at all there is any long-term borrowings, write long-term borrowings. So long-term borrowings are not there, sir. Then you can skip it off. Clear, everybody? Sir, long-term borrowings is there, but only one is there, sir. No need to open note. You can put within brackets 9% debentures. Understood? For share capital, always note number 1. For reserves and surplus, always note number 2. 1 and 2 notes will never change. So now from the third note, remember, listen carefully. If there is an item, open. If there is no item, skip it off. If there is only one item, you can directly write. If there is more than one, you have to open. Notes to accounts. Clear? Likewise, you are having deferred tax liability. Yes, then put it. If it is not there, don't write it at all. You can directly go. Current liabilities. Sir, current liabilities, short-term borrowings, not there, sir. Then skip it off, not needed. Trade payables, yes, we are having. Sir, this time not 1, 2 we are having. Creditors, bills payable. Then open another note number 3. Understood, everybody? Like this, you just need to proceed. Of course, in each and every problem, just go through the adjustments properly. Especially with the material that was provided to you with respect to the examination questions. Be careful. నేనేం చెప్పానో అర్థమైందా? మనకి ఇచ్చిన మెటీరియల్లో రిఫరెన్సెస్ ఇస్తారు కదా, రిఫరెన్సెస్ లో చెక్అవుట్ ఫస్ట్ ఆఫ్ ఆల్ వెదర్ ఇట్ ఈస్ యువర్ ఎగ్జామినేషన్ క్వశ్చన్ ఆర్ నాట్. ఇఫ్ ఇట్ ఈస్ ఎగ్జామినేషన్ క్వశ్చన్, యూ ప్రిపేర్ ఇట్ ఫస్ట్. If it is other than examination question, you prepare it at last after the completion of all the chapter. తీసేసుకున్న తప్పలేదు. Did you get my point? So it's best option. Likewise, the questions, check out whether is it your examination question or not. If it is your examination question, prepare. Otherwise, prepare it at last. Shall I proceed further? So that is the end of your balance sheet. Now let me go with P&L account. Format of P&L account is also very, very simple. So let me start. Roman number 1, revenue from operations. Roman number 2, other income. Roman number 3, total income. Okay. So if at all sales minus sales returns, like that 2 elements are there, open a note. Say note number 3, open that. Sir, if it is not there, just write within brackets directly sales. If you are having sale of goods and rendering of services, 2 things are there. More than one is there. So open a note. Otherwise it is not needed. Hey, hope you are listening. And next one, coming to other income, whatever income you are having, interest received, rent received, commission received, like this, any other income is there, then you have to open other income, otherwise you can skip it off. And Roman number 3 is nothing but total income, that is Roman number 1 plus Roman number 2. These 2 things will come here. And now Roman number 4, which is very, very important, expenses. Under expenses, first one, A, B and C are relating to trading accounts. Trading account, first one, cost of raw materials consumed. Second one, purchase of stock in trade. Third one, change in inventories. Clear, everybody? So now, sir, what is raw material consumed? You all will be knowing this one very greatly. Also, you might have done in costing also. Like opening raw material plus purchase of raw material minus closing raw material. That will be this one. A business concern can purchase raw material, then it will be in this one. But a business concern can also purchase the stock, kada? If it is purchasing a finished good, it will be under purchase of stock in trade. Now coming to change in inventory, generally you are having 3 things. One is finished good, another work in progress, another raw material. But raw material no need to do here. Why? Because already opening minus closing, it was already done here. So raw material, no need to do. So change in inventories of only dash and dash. Finished good and work in progress. Remember, not closing minus opening, it is opening minus closing. Even if opening minus closing is negative, you have to put here like that. Understood everybody? So ABC are relating to dash account, trading account. Remember, very, very simple. Raw material purchases. Cost of raw materials consumed, purchase of stock in trade, changes inventory of dash and dash. Finished good and work in progress, you will not get raw material because raw material is already done in point number A. Pakka. So there ends with A, B, C. Now D, E, F, O. F, D, E, F, D, O. Employee benefit expenses, finance cost, depreciation and amortization, other expenses. Clear everybody? Simple to remember the order also. F, D. Okay. Employee benefit expenses, all the salaries, wages, bonus, gratuity, whatever you are paying to employees will be coming under employee benefit expenses. Finance cost, if the interest paid is there, interest expense will be coming under finance cost. Depreciation on tangible asset and amortization on intangible assets will be under depreciation and amortization. And finally, other expenses. Whatever does not fit under any of the category will be coming here. Printing and stationery, telephone expenses, telegram expenses, coolage, firewood. Getting my point, everybody? But remember, if there is production expenses, that was given in the question. Production expenses, where this will be booked. Production expenses will not come under other expenses. Production expenses will be under cost of raw materials consumed. Special ga highlight chesindi anduku. Production expenses will be coming under cost of raw materials consumed. Understood everybody? Hey, listen carefully and answer me. Closing provision 10,000, where it will be shown? Closing provision for bad debts. Less from debtors. If closing provision 10,000 is there, it has to be deducted from debtors. Clear with this point? Provision created 10,000 will be create Joseph. Perfect answer, other expenses. Because if provision is created, first of all in P&L account, it must be shown kada. Sir, is the logic clear? If provision is created, then it will be shown under other expenses. If the provision is reversed, okay, then it will be shown as a separate item. But generally reverse provision meeku adagadu, kachchitanga creation of provision will be there, which is like other expenses. If reverse provision is there, you can comfortably book it under other income. Of course, it is not 100% correct because it will become an exceptional item. Sorry, creation of provision ardhamaindiga? Creation of provision, where it will be booked? Other expenses. If it is a closing provision, it has to be deducted from debtors. These two things are clear kada? Now, after all the completion of this one, you will get profit or loss before exceptional and extraordinary items. Hope you know this one. Likewise, if the fire occurred, then it is a loss which has to be shown separately. Okay. If any profit or loss on sale of assets are there, then it is an exceptional item which has to be shown separately. Sir, how to know ordinary item, extraordinary item and exceptional item? If it is relating to your business, then it will become ordinary. If it is not at all relating to your business, but your business gets affected, then it is extraordinary. Earthquake occurred, not related to our business, but our business affected. Cyclone occurred, not related to our business, but our business affected. Fire accident, not related to business activities, but our business gets affected. All these are nothing but extraordinary. Salary paid, related to business, ordinary. Purchases, related to business, ordinary. Sales, related to business, ordinary. Getting my point, everybody? Hey, now listen very, very carefully. Stock manipulated by the storekeeper. Is it relating to business or not? Yes, because storekeeper will be in the business. Stock is also in the business. So it is an ordinary. But it will not a regular item. Then what is that, sir? Exceptional. Clear? Three things I told you. Related to business, regularly occurring, like salaries, purchases, printing, pay, all those things, general items. Relating to business, but occurs only once and while, like cash manipulated by the cashier, stock manipulated by the storekeeper. Getting my point, everybody? Profit or loss on sale of asset. Sale of asset, is it common in the business? No, but it is related to the business or not? So it is ordinary but exceptional. not at all related to your business, but your business gets affected, is nothing but extraordinary. So these two items must be shown separately. So after the completion of these two things, profit or loss before exceptional and extraordinary items, then you can book exceptional items. Then you will be getting profit or loss before extraordinary items. You are having extraordinary but no exceptional. Even though you are having profit or loss on sale of asset, it was booked under other income. నేను ఏం చెప్తానో అర్థమవుతుందా? We are having profit or loss on sale of asset, but it was not shown under exceptional head. It was shown under other income. That is the reason I told you, if provision for bad debt is created, other expense, reversed, other income. Strict గా మాట్లాడితే అది exceptional item, but we are not having that much depth. So it was directly taken to the other income. Clear everybody? So, and profit or loss before extraordinary items and tax, then you have to book extraordinary items, then profit before tax, your favorite item, tax expense, and finally you will get profit after tax. Coming to tax expense, you are having current tax, deferred tax. Deferred tax might be asset or liability, that is, it might be either added or it might be deducted. This discussion is a bit depth, more discussion, so I ask you to listen carefully. Clear everybody? And for your kind information, that is the end of your preparation of financial statements. Formats were totally completed. Be careful. మొత్తం అంతా ఎక్కడ ఉంటుంది తెలుసా? నువ్వు నీకు ఇచ్చిన క్వశ్చన్ తర్వాత ప్రాపర్గా హెడ్స్ క్లాసిఫై చేసి, if you have started the problem and if you have posted all the things, you'll automatically get half of the marks. అంటే నువ్వేం చేయక్కర్లే, జస్ట్ పోస్టింగ్స్ చేయడం వల్ల ప్రాపర్ హెడ్ క్లాసిఫై చేసి పోస్ట్ చేస్తే పక్కా హాఫ్ ఆఫ్ ది మార్క్స్ వస్తాయి. ఆ హెడ్స్ ఓపెన్ చేసి రిలవెంట్ నోట్స్ టు అకౌంట్స్ లో కరెక్ట్ పోస్టింగ్స్ ఉండి అమౌంట్స్ కరెక్ట్ గా ట్రాన్స్ఫర్ చేస్తే యూ విల్ గెట్ అనదర్ హాఫ్ మార్క్స్. ఓకే, ఇంకెట్టొచ్చి అక్కడున్న అడ్జస్ట్మెంట్స్ ని మీరు అలా అడ్జస్ట్ చేస్తున్నారు అన్నది ఫైనల్. అది నేను చెప్పలేను, ఇచ్చే క్వశ్చన్ బట్టి నువ్వు జాగ్రత్తగా చూసుకో. దానికి నేను మీకు ఇచ్చే సజెషన్ ఏంటంటే, ఎగ్జామినేషన్ క్వశ్చన్స్ అన్నీ కూడా ఫస్ట్ ప్రిపేర్ అయిపోయి తర్వాత స్టడీ మెటీరియల్ రిఫరెన్సెస్, కాంపెడియం రిఫరెన్సెస్, వర్క్ బుక్ రిఫరెన్సెస్, ఆర్టీపీ రిఫరెన్సెస్, ఎంటీపీ రిఫరెన్సెస్ ప్రిపేర్ అవ్వండి. ఓకే, సరే. ఇప్పుడు జాగ్రత్తగా వినండి. వి ఆర్ ఎట్ ట్యాక్స్ పార్ట్. But before that, would like to tell dividend. I'll close this just within 3 minutes and then we'll go for tax. Proposed dividend will not be recognized in books of accounts at all. Okay, proposed dividend will not be recognized in books of accounts. If you want, you can show it in note 2, reserves and surplus after total. Ante you'll be putting note 2, reserves and surplus, general reserve, P&L account, say loss, then minus. Ante kada, securities premium. Like this you'll get total. Correct or wrong? After this, if you want, you can show proposed dividend. Just information. Likewise, how? In share capital head, authorized share capital is information. Here, proposed dividend will become information. Clear? So point number 1, proposed dividend, will it be recognized or not recognized? Not recognized, but if you want, you can disclose in which note? Note number 2, that is reserves and surplus. Pakka. Next one, declare dividend after balance sheet date. Declare dividend after balance sheet date will not be considered. Clear everybody? You can just ignore. Again same, if you want, you can show it under note to reserves and surplus. Disclose ante. Finally, declare dividend before balance sheet date. Okay, if it is paid, no need to consider, because if it is paid, not a liability kada. If it is not paid, it will be shown under other current liabilities. 3 things. Proposed dividend, recognize or don't recognize? Don't recognize, just disclose in note to reserves and surplus. Declare dividend after the balance sheet date. Declare dividend after the balance sheet date. Ignore, it will not be considered. Declare dividend before the balance sheet date. It will be considered and shown under the head other current liabilities. Understood everybody? Now coming to your favorite item, that is tax. Listen very, very carefully. Simple. Yes, It is very, very simple. Listen carefully. You had already computed profit or loss before tax. Am I correct or wrong? Say your profit before tax is 1 lakh. Given in the question that profit as per income tax purposes is 1,20,000. Tax rate given at 30%. I'm telling you in a simplest way. Just check out. Sir, as per accounts, sir, do you need to normally tell me, do you need the expense as per accounts or as per tax? Do you need expense as per accounts or as per tax? As per accounts, because you are preparing books of accounts. Simple logic. What are you preparing? Books of accounts. So you need expense as per accounts. Clear everybody? So as per books of accounts, 1 lakh into 30%. 30,000. Clear everybody? This is needed. This is needed. Remember, accounts tax is needed. But how much you have to pay? 36,000 you have to pay as per tax. So 1,20,000 multiplied by 30%, that is 36,000. This is to be payable. Clear everybody? So this is called as provision for tax or current tax. This is called as provision for tax or current tax. So check out, I'm writing tax expense, current tax 36,000. Clear everybody? Hey, but how much you want? So outer column should be 30,000. Remember, okay? So balancing figure is 6,000. Am I correct or wrong? This will become deferred tax. Pakka? Sure. That will become deferred tax. So just let me take one more example. Hey, still I'm pending with asset or liability here. That I'll tell you. But first you concentrate on DT. Say for example, profit before tax. Given like we have computed, we got 2,40,000. Given as per income tax purposes, like 3 lakhs. Tax rate say 20%. Okay, so now profit before tax 2,40,000, tax expense. I already asked you to take the outer column. Correct or wrong? How much is the outer column? Outer column as per tax or as per accounts? As per accounts. Remember that one. That is 2,40,000 multiplied by 20%. 40. Clear everybody? Now you have to pay tax as per income tax. That is called as CT, inner column. 3 lakhs into 20%. So balancing figure minus 12,000, which is nothing but DT. Understood everybody? Pakka? Okay. So if it is quite opposite, then it will become add DT. Ante kada. Say for example, current tax comes to 40,000. Then 8,000 will be balancing figure, add DT anta appudu. Pakka everybody? Remember, and you think with common sense first. Come into this case. How much you have to pay? Accounts prakaram 30,000. How much you are paying? Hey, you are paying extra. If you are paying extra, that is nothing but prepaid, which is your asset. So minus DT. Minus DT is nothing but DTA. Minus DT is nothing but DTA. If you are adding DT, it is nothing but DTL. Clear everybody? So to give you a very small notes, just check out this one. Tax expense. CT. Current tax. This will be as per which records? Tax records. Outer column will become as per which records? Accounting records. Add DTL. Balancing figure. Balancing figure, or you may get DTA, which is to be deducted. There ends with your matter. Clear everybody? ఇంతకు మించి మీకు ఎగ్జామ్లో అడిగే ప్రసక్తే లేదమ్మా. Because you are not having accounting standard number 22. Do you have accounting 22? AS 22. Group 1 లో ఉందా? So anyways, as far as this one, ఉందా group 1 లో లేదా? Accounting for taxes on income. ఉందా? సరే. As far as this point is concerned, as far as this chapter is concerned, this is what the hard item that you will get. Okay. More than this, you will be learning in accounting standard number 22. So already nina marathon ainattundiga. Okay. Anyways, idaithe okay kada meeku? ఇంతకు మించి ఇంకా ప్రిపరేషన్ ఆఫ్ ఫినాన్షియల్ స్టేట్మెంట్స్ లో మీకు అడగడు. ట్యాక్స్ అడ్జస్ట్మెంట్స్ ఇచ్చేసి ప్రిపరేషన్ ఆఫ్ ఫినాన్షియల్ స్టేట్మెంట్స్ అయితే అడగడమ్మా. మాక్సిమం ప్రిపరేషన్ ఆఫ్ ఫినాన్షియల్ స్టేట్మెంట్స్ ఇస్ లిమిటెడ్ ఓన్లీ టు దిస్ వన్. సో ట్యాక్స్ ఎక్స్పెన్స్ ఇస్ ఈక్వల్ టు either డాష్ ప్లస్ డాష్ ఆర్ డాష్ మైనస్ డాష్. కరెంట్ ట్యాక్స్ ప్లస్ డిటిఎల్, లేదు అంటే కరెంట్ ట్యాక్స్ మైనస్ డిటిఏ. outer column will be as per which records? Accounting records. CT will be as per which records? tax records. Balancing figure, if you have to add DTL, if you have to deduct DTA. Pakka everybody? That is the finality of your preparation of financial statements. So, chapter number 9, preparation of financial statements. Important things, balance sheet format, P&L account format, and tax items. Dividend, 3 things. Proposed dividend, ignore. Just disclose in notes to accounts. Declared after, totally ignore. If needed, that is your choice, you can show in note 2. Declared before, you have to show it. Yes, in other current liabilities. Pakka. With the next chapter, that is about cash flow statement. And coming to cash flow statement, sir, only 2 things. Direct method, indirect method. But take more care, because generally you will be questioned with indirect method, operating activities. Generally you will be questioned with indirect method, cash flows from operating activities. That is what your general style of question is all about. So first of all, let's go with direct method. Sir, there are 3 kinds of activities: operating activities, investing activities, and financing activities. What are operating activities? Those activities which are relating to due course of business, principal revenue generating activities, plus all the activities that are related to principal revenue generating activities. What do you mean by principal revenue generating activities? Sales. So whatever items that are directly connected to sales are also under operating activities. And coming to investing activities, activities relating to acquisition and disposal of fixed assets and investments. And finally, financing activities, those activities which causes the composition, which causes the changes in composition of capital funds. Capital funds might be either borrowed funds or even owned funds also. I mean to tell all about owned capital or borrowed capital, equity share capital, preference share capital, or debentures, bonds, loans, etc. Clear everybody? Fine. So this is the point that you need to take care. And yes, simply in the examination, if at all that item is relating to good, that will become operating activity. If that is relating to fixed assets, then that will become investing activities or investments. And if it is relating to capital, whether it is borrowed capital or owned capital, it will become financing activities. Now, if it direct method, if at all cash book is given or cash account is given, then you can simply identify what are operating activities, investing activities, and financing activities. Just you segregate everything and you put it under one statement. There ends the job. Something like cash flows from operating activities, all the inflows will be added, all the outflows will be deducted. Same investing activities, same style, and financing activities, same style. Now the biggest point that you need to take care about, number 1, tax paid will have to be shown separately. Tax paid will have to be shown separately. Remember that one. What do you mean by showing separately? Cash flows from operating activities before tax and then minus tax paid. Then you will be getting finally cash flows from operating activities after tax. Before this one, my dear children, if any extraordinary activities, likewise fire accident occurred, stock damaged, getting my point everybody, all those things are also to be shown separately. So if it is cash flows from operating activities, tax paid and extraordinary items will be shown separately. Coming to investing activities, extraordinary items have to be shown separately. Financing activities, there will be no extraordinary items at all. Operating activities, what are extraordinary items? Hardly you will get only one thing. Likewise, loss of stock due to fire accident or insurance claim received. Clear? These 2 things. And hardly you may get one more thing, that is exceptional item, cash manipulated through cashier. Okay. And finally, investing activities, you will be getting extraordinary items like loss of asset in accident or insurance claim received on account of loss of asset. These 2 things hardly you'll get. Clear everybody? And these are nothing but cash flows from operating activities and cash flows from investing activities. And finally, financing. You will be getting one final figures. Am I correct or wrong? And then you will be putting part 4. That's all about reconciliation. How to reconcile? As simple. Consider opening cash and cash equivalents. add. You have to add cash flows during the year. Cash flows during the year is nothing but operating activities plus investing activities plus financing activities. Already you will be finding the net figures. Those net figures will be obviously added here, and finally you will be getting closing balance of cash and cash equivalents. Understood, everybody? So in this connection, what is cash equivalent you must know. So in this connection, cash equivalent is nothing but cash equivalent will be in the form of investments, and period should be less than or equal to 3 months, and risk must be negligible, and it must be easily convertible into cash. Unnaya kaadu untai. So now, say for example, if it is equity share is trading in the market. Risk higher, lesser? High. So you cannot consider it as cash equivalent at all, because it should be having a negligible risk. Cash equivalent should have negligible risk. Even though a company invests in equity share for for less than or equal to 3 months, it will never become a cash equivalent. Why? Because the risk of equity share will be always higher. Then what will be generally including in this cash equivalent, sir? All the money market securities, like a certificate of deposits, commercial papers, 91 days T-bills, treasury bills. Idea unnaya? All these things will be generally included in cash equivalents. Understood, everybody? That is what your direct method. So operating activities, investing activities, financing activities, opening cash plus cash flows during the year, closing cash. Pakka. Now one more point that you need to take care is all about for operating activities you have to show tax paid and extraordinary items separately. For investing items activities you have to show extraordinary items separately. Extraordinary items cash received, extraordinary items cash paid. That is nothing but inflows or outflows. What is capital gains tax? Which activity? Capital gains tax. Asaladi ఏ activity first? Operating, investing, financing. Investing, because capital gains tax is a tax which is paid on sale of asset. Correct or wrong? TDS on interest paid. Financing, because interest paid is financing. TDS on interest received. Investing, because interest received is investing activity. Clear, everybody? Now capital gains tax paid, which activity? Investing. Will it be shown separately or not? Yes or no? No, not needed. Check out. Only for operating activity tax paid has to be shown separately. Investing activity tax paid is not to be shown separately, not required at all. Understood? కావాలని ఈ క్వశ్చన్ అడుగుతుంది అందుకే. Because if it is under operating activity tax paid, it has to be shown separately. But if it is investing activity tax paid, no need to show separately. Under investing activity, only extraordinary items have to be shown separately. Pakka. That said, capital gains tax is not an extraordinary item. Reason being, sale of asset is a normal item. So if you have sold the asset, you may get profit. So paying profit is also, paying tax on the profit is also normal. Clear? Okay. So if at all cash book is given, your job is very, very easy. Because you can just pick the activities and everything will be completed. But the main problem is all about if cash book is not given, P&L account is given and balance sheet is given and asking to prepare under direct method. If given and asked to prepare under indirect, somehow we can manage. But given and asking you to prepare under direct method. At this time, you have to convert each and everything into cash. Likewise, if you check out P&L account, you may have sales. But it is a combination of dash plus dash, cash plus credit. But you want only cash sales, and out of credit sales, amount paid by the debtors. Correct or wrong? So you need only cash sales and amount paid by debtors. Sir, if no cash sales are there, then ignore this one. Find out amount received from debtors. How to find amount received from debtors? Along with this credit sales or along with this sales, you have to take relevant information from the balance sheet. Clear? So if at all P&L account balance sheet are given and asking you to prepare under the method, which method? Then you have to convert each and every item into cash. Hey, convert each and every item into cash. Pakka? While converting each and every item into cash, you just need to check out what item in P&L account is linking with what item in the balance sheet. Likewise, sales will be linked with debtors. Purchases will be linked with creditors. Wages will have to be linked with outstanding wages and prepaid wages. Clear? Expenses have to be linked with outstanding expenses and prepaid expenses. Hope the concept is clear for you. So like this, you have to co-calculate and you have to prepare. So say for example, ultimately you have prepared debtors account. Yes, you are having opening balance. Yes, you are having closing balance. Yes, you are having even credit sales. Automatically you will get a balancing figure. That is nothing but amount received from debtors. This is needed for cash flow statement but not any other things. Clear everybody? This is how you have to do. And say for example, if you are having wages. In P&L account you are having wages incurred. But you want wages paid. So say for example, wages incurred in the P&L account is given 100. And say for example that wages current year outstanding is equal to 10. Current year outstanding includes this one, correct or wrong? Outstanding in the sense not yet paid kada. You just need to deduct that one. Non-profit organization gurtunda. In non-profit organization, while you have to prepare receipts and payments account when income and expenditure is given. Reverse things you have to do. So salary, normally salary paid, add current year outstanding minus last year outstanding, add last year prepaid minus current year prepaid. Then you will be getting salary incurred. But now you are having this one in P&L account. You want to find this one for your cash flow statement. So these things will have to be reversed. Plus, minus, plus, minus. Pakka with the logic. So if given cash book, prepare cash flow statement perfectly you can prepare, but if given P&L account and balance sheet and asking you to prepare cash flow statement, you have to pick the relevant items of P&L account and relevant items of balance sheet and you have to link and you have to prepare either this statement or the account. Either debtors account, creditors account, fixed asset account. Yes, you may need to prepare fixed asset account also. Say for example, profit or loss is given in your P&L account and you are having fixed asset opening balance and closing balance. If you prepare fixed asset account, then you will be getting the final answer. Because if you prepare fixed asset account, opening balance, closing balance, by depreciation, even it will be given. Profit is given, say for example, if profit is given, it will be at the debit side of the account. Credit side in P&L account, debit side in fixed asset account. Then you will be getting balancing figure here. That is what cash received from the sale of fixed asset. Like this, you have to prepare each and every account. So cash flow statement is more or less linked to your accounting from accounts from incomplete records or single entry system. Because preparation of accounts is quite common. Understood? This is direct method. But coming to the next one, indirect method. See, indirect, for whether it is direct method or indirect method, investing activities no change, financing activities no change. Change will always be there only with operating activities. Operating activities under direct method will be directly prepared from cash flow statement or cash book. I'm sorry, from cash book. But operating activities under indirect method will be prepared from P&L account with relevant balance sheet information. Understood everybody? Sir, direct method lo, if at all P&L account and balance sheet information are given, then you have to convert relevant P&L account item plus relevant balance sheet item and convert each and every item into cash. But if it is indirect method, you have to follow eliminating procedure. What do you mean by eliminating procedure, sir? Take net profit before tax. Net profit before tax. And you have to add all the non-cash expenses. Because non-cash expense is nothing but depreciation. Depreciation is non-cash. Am I correct or wrong? If you take out depreciation, overall net profit will increase. And if any non-cash income is there, it has to be deducted. Clear? And also you have to adjust non-operating items. Because P&L account is a combination of all the items. I'll tell you, wait. Point number 1. P&L account is a combination of cash and non-cash items. But you want only cash flows from operating activities. So eliminate all the non-cash items by adding non-cash expenses, by deducting non-cash incomes. Normally expense will be deducted. But we are eliminating. We don't want that expense. So expense is added. And you were left only with which items? Cash items. But again, these items are the combination of operating, investing, financing. You want only which activities? Operating, because I already told you that investing and financing activities will not change either under direct method or indirect method. Under indirect method only changes about cash flows only from operating activities, and cash flows from operating activities, cash flows will be from operating, investing and financing. So in cash flows from operating activities, you want only operating, you don't want investing and financing, so eliminate these two things. Sir, what we are having in P&L account, sir? Sir, generally only these items will be there in your P&L account. Interest paid, you don't want that item, correct or wrong? So interest paid or interest expense has to be eliminated by adding. Investment income, either dividend received or rent received or what is it called? Interest received, dividend received, rent received. Only three things you will be having. All these things will be eliminated by deducting. Commission received is an operating, so you should not adjust it at all. Investing activity, you will get only these three things. Number one, rent received minus, interest received minus, dividend received minus. Apart from these things, you will get profit on sale of asset minus. If you have got any loss on sale of asset, even that is also investing activity, so you don't need that, so it will be added. And coming to financing, you are having only one thing, interest expense, that will have to be add back. Clear everybody? Sir, please don't adjust dividend received in this lot. Sorry, dividend received will be adjusted. Dividend paid will not be adjusted in this lot. Why? Because you are taking net profit before tax. Before tax in the sense, tax itself is not deducted, kada. If tax itself is not deducted, how will you deduct dividend? Clear? Because profit before tax minus tax, you will get profit after tax, then you will be deducting dividend. But you are at profit before tax. If you have taken profit after dividend, even this also will be added. But you have taken profit before tax. Understood everybody? And hence dividend paid will not be adjusted. Shall I proceed further? And now you will be finally left with some operating activities. But the biggest problem is here, because total sales is included. Total purchase is included, total wage is included, total salaries is included, but you want only cash items, correct or wrong? For these things you have to adjust working capital adjustments. Hope you have remembered working capital adjustment. Listen, current assets cash, there will be inverse relation. Current liabilities cash, there will be direct relation. In the sense, increase in current assets minus. Inverse kada? Increase in current asset aithe minus. Decrease in current assets, add. Increase in current liabilities, add. Decrease in current liabilities, minus. Check out current liabilities cash, direct relation. Current assets cash, inverse relation. After completion of all these things, you will be getting cash flows from operating activities before tax. Finally, minus tax paid will be considered, and finally you are going to get cash flows from operating activities after tax. Understood? That is the end. Yes, but in this connection, you please be careful. Point number one, bad debts. Will it be adjusted or not under indirect method? First of all, will you adjust depreciation? Since it is a non-cash item, it will be adjusted by adding. Bad debts? Yes, it's a non-cash. Will you adjust or not? No, it should not be adjusted. Why, sir? Because you are adjusting debtors. Opening minus closing. Correct or wrong? Debtors, you will be adjusting something like closing minus opening or opening minus closing. So bad debt will automatically get adjusted in your working capital adjustments. Clear? Discount allowed. First of all, do you know that bad debts is a non-cash expense? Discount allowed cash or non-cash? Non-cash. Yes, even it is expense. Will it be adjusted or not? No, because it will automatically get adjusted. Yella adjust avutundi annadi nenu ippudu cheppalenu, because it may take around half an hour discussion to prove that. It takes half an hour discussion to prove it for sure. So remember that it is already adjusted and no need to adjust. Discount received? No. Why? Because creditors is adjusted. Loss on sale of asset. Yes, you have to adjust. Loss on sale of asset, even though it's an investing or non-cash item, it has to be adjusted. మీకు వచ్చే డౌట్ సార్ మాకు తెలిసింది ఒకటే, like if it is non-cash expense we will add, if it is non-cash income we will deduct. Now you are telling some of the expenses are not to be considered even though it is non-cash. How can we remember that one, sir? Very simple. If at all your non-cash items are relating to operating activities, no need to adjust. They will automatically gets adjusted when you done working capital adjustments. If your non-cash items are relating to other activities like investing or financing, then you have to adjust. Depreciation is relating to fixed asset, non-cash fixed asset, in the sense investing. Correct or wrong? So you have to adjust that one. Other activities, non-cash, depreciation, adjust. But bad debts not needed. In debtors it will be adjusted. Discount allowed not needed. Debtors opening and closing it will be adjusted. Discount received not needed. Creditors opening and closing it will be adjusted. Pakka everybody. నేను ఇది స్పెసిఫిక్ గా చెప్పడానికి రీజన్ ఏంటంటే ఇన్ యువర్ వన్ ఆఫ్ ది ప్రాబ్లమ్స్ దేర్ ఇస్ అ బ్యాడ్ డెట్ and there will be confusion to the students like whether bad debt is it to be adjusted or not. No, it will not be considered because debtors opening and closing it will be adjusted. Pakka everybody. And the next concept is all about amortization. How to consider amortization, sir? Sir, listen, in many of the cases your cash flow statement will not tally because of this small item, goodwill. Opening given 60,000, say closing given 48,000. Okay, how much is the opening? How much is the closing? How much is decreased? That 12,000 is nothing but amortization, which is similar to depreciation. If you are adding back your depreciation, you also add back this amortization. So even amortization has to be added back in your cash flow statements under operating activities. Pakka everybody. And last and final two things would like to tell. Number one, provision for tax account or tax payable account. Number two, dividend payable account or dividend declared account. Sir, I'm not covering the portion of provision for depreciation and asset. This you will be anyway learning in your accounts from incomplete records. So I can't spare time on this one. So straight away I'm going with the provision for tax. Listen very, very carefully. Sir, provision for tax asset or liability? Liability. So it is having brought down balance at credit side and carried down balance at debit side. If no other information is given, last year tax will be paid in the current year tax will be created in the current year. Last year tax is paid in the current year closing is created in the current year. What do you mean by this one, sir? Say for example, you are having opening balance of 1 lakh and closing balance of 90,000. You cannot take balancing figure 10,000 paid. That is wrong. Clear? So how much is paid, amma? 1 lakh to cash or bank. And this 90,000 is created from P&L account. So by P&L account. Hey, there you are not considering in operating activities. First you are considering net profit before tax. Am I correct or wrong? There before tax. Before tax is nothing but you have to add back this provision for tax. How much you have to add? 90,000. Because this is paid kada. 90,000 you have to add to find a net profit before tax. Clear? 1 lakh is nothing but at last you have to show separately minus tax paid. There you will be booking it at 1 lakh. Understood? Okay, so that is what your provision for tax. Say for example, given in the question something like this, 1 lakh 90,000. Given in the question that paid 85,000. So to cash or bank 85,000. Whatever the balancing figure here you have got, that we will be treating it as created. Understood? If created is given, this will become your balancing figure. If created, say for example, created is 85,000, sir, then this will become your balancing figure. So final notch, just check out. Opening, closing. If no information is there, opening is paid in the current year, closing is created in the current year. If some information is there, to cash or bank is given, sir, then by P&L account will become balancing figure. Say if by P&L account is given, sir, to cash or bank will become balancing figure. Pakka. And finally, if it is dividend declared account, same logic will be extended. If nothing is given, opening will be paid and closing is declared antam. Clear? Instead of the word created, you will be using the word declared. Okay, everybody. But if given declared portion, payment will become balancing figure, or if given payment portion, declared will become balancing figure. Understood, everybody? You may be asking me why this one, because dividend paid is which activity? Dividend paid, financing activity. You need to deduct there. And dividend declared, yes, you need even dividend declared to find net profit before tax. Because what you will be having in general, net profit before tax minus tax. You will be having profit after tax minus dividend. And finally profit after dividend. You will be having this one. From this it should become this kada. In the sense, dividend declared has to be added. Pakka. That's it with indirect method. And still I left two things. You just need to revise those things. Number one is all about fixed assets relating to provision for depreciation. And number two, change in reserves and surplus. I mean to tell change in reserves and surplus. If general reserve opening 1 lakh and closing 1,20,000 is there, increase of reserve 20,000 is there. That is nothing but appropriation. Strictly speaking, it has to be added at this point. These two things I left out, but you just revise those. You can understand. Clear, everybody? So cash flow statement, point number 10. Direct method, indirect method. Take care. Non-cash activities relating to operating activities not to be adjusted. Covered almost all the things, like provision for tax is covered, declared dividend is covered, even when cash book is given, how to do covered, even when cash book is not given, P&L account and balance sheet are given, how to do is covered, but these two things were specifically uncovered. You have to revise. అంటే ప్రతి టాపిక్ లో అన్కవర్డ్ ఖచ్చితంగా ఉంటాయి, కానీ ఈ టాపిక్ లో ఇది ఖచ్చితంగా రివైజ్ చేయాలి. మిగిలిన టాపిక్స్ లో అన్కవర్డ్ అంటే చిన్న చిన్న పాయింట్స్ ఉంటాయి, బట్ ఈ టాపిక్ లో ఇది అన్కవర్డ్, బట్ కొన్ని ప్రాబ్లమ్స్ లో ఇవే ఎక్కువ కౌంట్ చేస్తూ ఉంటాయి. సో ఫిక్స్డ్ అసెట్స్ and provision for depreciation, because I did not explain this concept even though it is covered in many of the problems. Reason being, what is it called? It may take around 15 minutes to explain just only that concept. And coming to reserves and surplus, strictly speaking, appropriations, yes, I did not cover even that one also. Okay, so just extend your concentration on these two things. Just within the next 2 to 3 minutes, we are going to start banking companies. Start with banking companies. We can complete very easily and also within less time. Concept is all about performing assets and non-performing assets. So take care. If at all, if it is not a non-performing asset, it will become performing asset. Other than non-performing assets will become performing assets. Clear, everybody? Then what is a non-performing assets? 90 days relaxation period is given. Even though either interest or principal or both or overdue, that word is very important, overdue, for a period more than 90 days, then it will be treated as non-performing assets. What do you mean by overdue? What do you mean by not due? What do you mean by due? As simple as such, on due date it will become due. Before due date it is not due. After due date it is overdue. So say for example, if 30th September is the date where the banker is asking the lender to pay the amount, on that date will become due. Before date will not become due. After that date it will become overdue. So from this date you have to count a period of 90 days. After counting the period of 90 days, if you are such, if you have paid within this 90 days, then you will be treated as a performing asset. And even you did not pay within this 90 days, after this 90th day, you will be called as a non-performing asset and you are something like a doubtful asset. Clear, everybody? So, you have to first classify whether it is performing or non-performing. And if it is performing asset, interest will be normally done and it will be done on accrual basis. If it is non-performing asset, then interest will be done, booked in the books of accounts on cash basis. In the sense, only when you have received, you will be booking, otherwise you will not be booking. Clear, everybody? Intaki, what you need to check out, sir? Due. How many days, sir? 90 days. What do you have to check, sir? Both things. Either interest or principal or both. You have to check out either two things or both. Clear, everybody? Not just interest. So if you are classified as performing asset, accrual basis. If you are classified as non-performing asset, cash basis. Pakka? Okay. So now Say for example, you have to pay 10,000. Your due is something like 75th day. You will be treated as performing or non-performing. So you are very good. And hence immediately I am booking the entry. Like if you paid cash or bank account debtor to interest, but you are not paying, am I correct or wrong? Hey, responder. You are not paying, so I am debiting to interest receivable account debtor to interest account 10,000. Clear everybody? What is the entry I am booking? Interest receivable account debtor to interest account. I am booking something like 10,000. Pakka. And moving on to the next thing. Say for example, you have to pay 10,000 and you are at 95th day due. Performing or non-performing? Then immediately I am writing a one entry. Immediately I am writing one entry that interest receivable. Who has to pay me? Customer. Correct or wrong? Here also interest receivable is nothing but customer has to pay me, so customer account will be debited. So here also I will be writing like customer account debtor to not interest, I will transfer it to interest suspense. Because you are the biggest doubt to me. Clear? See, if you are treated as performing, entry will be customer account debtor to interest account. If you have received cash or bank account debtor to customer account, and this interest will be ultimately closed and transferred to P&L account. Part 1. Part 2, if you are treated as a non-performing asset, customer A, but that is not interest, that is interest suspense. Doubt? Clear? So customer account debtor to interest suspense account. Understood. And if I have received cash, then cash or bank account debtor to customer account. And then I will be transferring this interest suspense to interest. And then ultimately interest will be transferred to P&L. Or if you want, you can also put a direct entry like interest suspense account debtor to P&L account. Clear everybody? This is the accounting for non-performing assets where you are having that concept. Accounting for non-performing asset. Your first question itself is accounting for non-performing asset. Understood everybody? And the next model that you are having is acceptances, endorsement and other obligation. Kachitanga, you need backup of the material because in CA banking companies we are dealing it in other style. Like this concept itself will not be there in CA. Accounting for non-performing assets will not be there, but you're having that concept. And also there are some additional concepts to them like CRR maintenance, computation of CRR, computation of SLR, all those things are there. Capital adequacy norms are there, but those are not there for you. So difference aithe undi, so I need backup for sure. Now anyways, moving on to the next thing, acceptances, endorsement and other obligation. Sir, what do you mean by acceptance? Sir, listen very, very carefully. Acceptance. Sir, acceptance is nothing but bank is accepting the bill. Who is accepting the bill? Bank accepts the bill. How it will happen, sir? Say for example, Mr. A is there. Okay. And say Mr. A would like to transact with Mr. B. But Mr. A and Mr. B are not known to each other. So automatically nobody is having trust. So in between, banker will be there. Clear everybody? So Mr. A is asking Mr. B to send 100 lakhs or 1 lakh stock. Mr. B told, who are you? I cannot send you. And Mr. A told, my banker will be giving guarantee to you. That guarantee will be in the form of acceptance. So what happened? Listen very, very carefully. Outsider, that is creditor, will be drawing a bill on the banker. Clear everybody? Banker will accept and give it to the creditor. On the due date, banker will pay it to the creditor and banker will recover the same amount from the customer. Because banker is giving guarantee only on behalf of the customer, right? So banker will be meeting the bill on the due date and banker will be collecting the same from the customer. Sir, what if this customer did not give? Banker is not a fool. So banker will be taking some guarantee. Banker is already having the security. He will sell that security and he will make the money. Pakka everybody. And next one, acceptance is over. The next concept is all about endorsement. Who will endorse the bill? Of course, banker will endorse the bill. To whom he will endorse the bill? Of course, creditor. To the outsider, he will be endorsing the bill. Clear everybody? So ultimately, who is drawing a bill? Now, banker is drawing a bill on his customer. And banker is endorsing it to creditor. On the due date, customer has to pay to the creditor. If customer fails to repay, then banker will repay. Clear everybody? If customer fails to repay, then banker will repay. Banker is not a fool. He will collect the same from the customer. If customer did not pay, then automatically banker will be selling the security and he will make the money. Perfect everybody. That is a concept of endorsement. And finally, obligations or other form of guarantee, which is simply something like in a piece of paper. Just in a piece of paper, it will be written something like, we, the bankers of so and so customer, on behalf of our customer, we are giving guarantee. Our customer will be repaying you on the due date. If our customer did not repay, we, the bankers, will be repaying you. Clear, everybody? So it will be nothing but a general guarantee form. Something like we will be calling it as LOC, letter of credit, or LGs, letter of guarantees. Clear, everybody? It will be just in a piece of paper. No sort of bill, no sort of drawing, nothing will be there. This concept is nothing but acceptances, endorsement, and other obligation. And for your kind information, my dear children, all these things, acceptances, endorsement, and other obligations, these will be working out to the banker only when the customer did not repay. Will you admit or not? If the customer repays, then automatically banker will be relieved from his job. If customer did not repay, since the banker had given guarantee, he has to repay. So what is this? Asset or liability to the banker? It is a contingent liability. Clear, everybody? Why it will become a contingent liability? Because it depends on the customer. What is contingent liability? May or may not a liability. If customer pays, not a liability. If customer did not pay, for banker it will be a liability. Clear, everybody? Top pass. So acceptances. Tell me. Acceptances, endorsements, and other obligation is dashed to the banker. Cheppandi is dashed to the banker. Contingent liability. Understood, everybody? So acceptances, endorsement, and other obligation register will be there. My dear children, I don't like to call it as an account. I will call it as a register. Even if you want, you can call it as an account. But strictly speaking, it is not at all having any double entry system. Because it is a contingent liability. They will be maintaining it in just in the form of register. Having some opening balances. During the year, whatever the guarantee is given will be coming here. During the year, if customer repays, banker will be relieved from his liability. So it will be debited. Even if the customer did not repay, it will be debited. Because now it is no more my contingent liability, it is my liability. It will be converted from contingent liability to liability. And finally, you are having closing balance. Understood, everybody? Clear? That's it. So acceptances, endorsement, and other obligation. Asset liability. Contingent liability. Do you have a perfect double entry system for the same? No. It is just register form, memorandum account. Having which balance? Credit balance. All the acceptances will be at credit side. All the repayments or non-repayments will be at debit side. And finally, you will be left with closing balance. Pakka? That's it. That is what your acceptances, endorsement, and other obligation. And moving on to the next thing, rebate on bills. That is a very bacha concept. Remember, discounting on bills. Hope you know the concept of discounting on bills. So say for example, a customer is coming to the banker. A customer is coming to the banker and he is discounting a bill. Total period of total bill period is 4 months. How much is the total bill period? 4 months. Bill was drawn on January 1st. Bill was drawn on January 1st. 4 months in the sense, after how many months it will mature? Of course, after 4 months. Sorry. On April 30th, it will be matured. Am I correct or wrong? So now customer is coming to the banker on February 1st. Atla chustavaindi ante January, February, March, April. 4 months. Count that. Grace days. Fine. So grace days generally will be ignored here. But if you want, you can consider that one. Okay. So fine. Listen. So grace days you can ignore, but if you want, you can strictly add it. But to get the concept, I'm telling you. So totally, what is the due date, Amma? April 30th. Customer is coming to the banker on which date, Amma? February 1st. Already how many months expired? 1 month expired. So banker will be collecting discount for how many months, Amma? 3 months. Clear, everybody? Say for example, bill value is 1 lakh. Multiplied by rate of discount is 12%. Multiplied by how many months discount he'll collect? 3 months discount he'll collect, which will become 3,000. Correct or wrong? So now very important, listen carefully. This 3,000 is for how many months, Amma? 3 months. That is from February 1st to April 30th. But what is our year ending, Amma? March 31st. Clear everybody? So total discount on bills in the current year is equal to 3,000, of which 1 month is relating to next year. That next year portion, where we will call it as unexpired portion. What is that we'll call it as? That is nothing but rebate on bills. How much is rebate on bills? And as per our example, Amma, how many months? 1 month. 3,000 is for how many months, Amma? 3 months. So for the 1 month, how much it will get? 1,000. Pakka. So out of 3,000, 1,000 is relating to the next year. 2,000 is relating to the current year. So your journal entry will be first at the time of discounting. At the time of discounting, your journal entry will be bills purchased and discounted. 1 lakh bill is purchased and discounted. To whom you have to pay? Customer. You will be paying 97,000, where 3,000 is nothing but discount on bills. Is the first entry perfect? Now discount on bills. Close. Since it is a nominal account, how much is the discount on bills? 3,000. 2. Rebate on bills, that is nothing but 1,000, and remaining 2,000 is your income for the current year, right? So you have to transfer it to P&L account. So discount on bills account debtor to rebate on bills account to P&L account. Understood everybody? Now again in the next year, sir, this 1,000 for the current year it is rebate on bills. For the next year it is next year income kada. And hence again this ROB has to be transferred to DOB. So which is nothing but rebate on bills account debtor to discount on bills account. Clear? So first every year you have to do last year rebate on bills, whatever is there. Current year it will become our income. So rebate on bills account debtor to discount on bills account. Then you will be accepting some bills. Then again current year rebate on bills, which is relating to the next year, has to be transferred to rebate on bills. Finally the total has to be transferred to the P&L account. Understood everybody? That is a concept of rebate on bills. But remember, you have to compute rebate on bills for expired portion and unexpired portion. Say for example, customer had come to you for discounting a bill of 60 days, out of which 31 days falls in current year, 29 days falls in next year. Rebate on bills will be computed for how many days? 29 days. Next year portion or unexpired portion. Remember that one. Clear everybody? Okay, that is a concept of rebate on bills. And this is very simple, like secured and unsecured. You just check out the security. Say for example, banker had got a loan. Sorry, banker had given a loan. After giving a loan, he need to classify whether the loan is secured or unsecured. So to check whether the loan is secured or unsecured, you will be generally checking only at the end of the year. You will be checking only at the end of the year. You will not be checking during the period. Say for example, at the time of giving the loan, he had got some shares which were kept as security by one of the customers. At the time of giving the loan, bankers had got shares given by one of the customers as security, where the share price at the time of giving the loan is 80. Clear everybody? Now meanwhile during the year, it went to 40, it went to 60, it went to 20, it went to 120. End of the year, it stood at 95. What price is to be considered for checking whether the loan is secured or unsecured? Question అర్థమైందా? ఈ లోన్ ఇచ్చినప్పుడు 80, ఇయర్ ఎండింగ్ లో 95, డ్యూరింగ్ ద ఇయర్ దీస్ మెనీ ఫ్లక్చువేషన్స్ ఆర్ దేర్. ఓకేనా? సో టు చెక్ అవుట్ వెదర్ ద లోన్ ఇస్ సెక్యూర్డ్ ఆర్ అన్సెక్యూర్డ్, విచ్ ప్రైస్ హ్యాస్ టు బి కన్సిడర్డ్? End of the year, that is how much, amma? 95. Say for example, you have given a loan of 10 lakhs. How much loan you have given? 10 lakhs. Say for example, the security is kept for 1 lakh. So 1 lakh multiplied by 95. Clear everybody? Which comes to 95 lakhs. So now answer me, how much loan you have given? 10 lakhs. How much security you are having? 95 lakhs. Is the loan secured or unsecured? Totally secured. So if at all after multiplying this one, say for example this is 10,000, then you will be getting 9.5 lakhs. How much is the loan given? 10 lakhs. But how much is the secured value? 9.5. Automatically 50,000 will become unsecured. You should not consider the fluctuations during the year or loan at the time of giving. You have to consider the value of the security only at the end of the year. Perfect. Next one. That is over. Performing and non-performing. Yeah, hope this one. Likewise, provisioning norms. So just check out. You are having another classification, that is like First of all, you are having performing and non-performing. Am I correct or wrong? Non-performing are further classified into, sir, all the performing assets are standard assets. All the performing assets are standard assets. By the moment when it becomes NPA, it will automatically become substandard. Okay? It will be in that category up to 12 months. If that is exceeded, it will become doubtful. Again, that doubtful up to 1 year, D1, D2, D3, 1 to 3 years, D2, and more than 3 years, D3, and finally loss assets. Clear, everybody? So all the performing assets are dash assets. By the moment when it becomes NPA, it will automatically become substandard. Like that, it will be in the category of substandard for how many months? 12 months. If that period is exceeded, it will become doubtful. Again, in D1, it will be for 1 year. For more than 1 year, less than 3 years, until 2 years. More than 1 year until year 2. Correct or wrong? For year 2 and year 3, it will be in the category of D2. And finally, more than third year, it will be in the category of D3. And loss asset is something like if the asset is non-recoverable, say declared insolvency or died or accident, something like that, then we will be treating it as a loss asset. Percentage of provision you need to create. If it is standard and given for agricultural and SME, 0.25%. If it is commercial and real estate sector, 1%. All other standard assets, 0.4%. Substandard, secured aithe 15. Fully unsecured aithe 25. But unsecured with minimum guarantee. Infra loans plus escrow accounts, then only 20%. It is something like escrow accounts and partially secure అనుకోవచ్చు. And moving on to the next thing, doubtful D1, D2, D3. Doubtful D1 25, D2 40, D3 100. Doubtful unsecured is always 100. Pakka. And in this context, you are also having another portion, that is ECGC and DICGC cover. What is ECGC and DICGC cover, sir? ECGC and DICGC cover is nothing but insurance cover, which is given to the banker for unsecured portions. Say for example, there is a loan where a person has to give me 10 lakhs. But already some portion is secured. How much, sir? 2 lakhs is secured. Balance how much is there, sir? 8 lakhs. Now this 8 lakhs is unsecured. Now if the banker had taken ECGC or DICGC, then he will be getting coverage. Then he will be getting insurance coverage from this ECGC and DICGC corporations. ECGC is nothing but Export Credit Guarantee Corporation. It is like an insurance company. DICGC, Deposit Insurance Credit Guarantee Corporation, again because it is a company. So these are something like insurance company. Banker have to take insurance. Why banker will take insurance? Because if any customer did not pay, who will suffer? Banker. So to overcome that one, he will be taking security. So this ECGC, DICGC cover is nothing but insurance. This insurance will be extended on secured portion or unsecured or both. Chepali. Only on unsecured. Say for example, the coverage is 40%. So out of 8 lakhs into 40%, how much it comes to? 3.2 lakh. And balance how much is there? 6.4 lakh you will be having. No, 4.8 lakhs. Getting my point, everybody? So take care. One last and final thing. Say for example, 10 lakhs. Say for example, secured is 3 lakhs. And how much is unsecured? 7 lakhs. Cover is available to the extent of 40% again. Say ECGC 40% cover, which comes to 2.8 lakhs. And balance how much will be there? 4.2 lakhs. Clear? Now remember and listen very carefully. This is purely covered. No problem at all. Because even though you being customer will not pay, this 2,80,000 that ECGC cover will be paying me. So this is fully secured. No provision required. This is secured. So secured portion, whatever the category is there, you have to follow that one. In the sense, what do you mean by that, sir? Secured, standard aithe 0.25 or 1 or 0.4. Secured substandard aithe 15%. Doubtful D1 secured aithe 25, G2 aithe 40, D3 aithe 100. Clear, everybody? But generally for all these problems, you will be having only D3 category. And hence for this one, you will be creating 100%. For also unsecured, you will be creating 100%. Because doubtful D3 in the sense 100%. Whether secured or unsecured, it is 100%. But say for example, if it is substandard category, then on this secured you will be getting 15%, and on this unsecured portion you have to create 15%. Hey, logic clear? Pakka? So that is what your ECGC and DICGC. Just give me quickly. ECGC and DICGC cover available on secured portions or unsecured portions? Unsecured portions. Clear everybody? Generally in all our problems we are having which category? B3 category. So how much provision we are creating? 100%. But whatever the cover, on cover will there be percentage of provision or not? On cover there will be no provision. But on secured and unsecured portion you will be having provisions. Pakka? So that's the concept of your ECGC and DICGC cover. And I guess, yeah, banking is absolutely done. And you are having P&L account. Just remember, I'm not covering the balance sheet portion at all, because in banking, if tested, he will test P&L account. That is also as a last option. You will be generally posed with preparation of financial statements, balance sheet and P&L account. Generally, you will not be asked with insurance accounts and banking accounts. But if asked, okay, least chance, banking P&L adagadaniki scope undi. Roman number 1, income. Okay. Roman number 2, expense. Roman number 3, profit or loss. Roman number 4, appropriations. So in income, you are having two things. Sir, what is main income to the banker? Interest. Correct or wrong? Interest, others. What is main expense to the banker? Again, interest. So interest, other administration and operating expenses. Provisions and contingencies. Clear everybody? Schedule number starting from 13, 14, 15, 16. Clear everybody? Interest received, others. Interest paid, others. 13, 14, 15, 16. For provisions and contingencies, there is no schedule. It is just something like you have to open it as a working note. Sir, what will you get in provision here, sir? Something like just now we have seen provisioning norms. 0.25%, 1%, 2%, 20, I mean not 2. 1%, 0.25%, 0.4%. 15, 20, 25, 100, 100, 25, 40, 100. Did you remember? So all the provision, whatever is there, that provision will be coming here. Clear everybody? So that is a concept of your preparation of financial statements with respect to the banking. And I know I did not cover with the concepts of preparation of financial statements, but I recommend you to go with those things. So coming to point number 11, banking companies. Whatever are needed for examinations were totally covered. Likewise, non-performing assets, accounting with interest suspense. And next one, rebate on bills, on discounting on bills, acceptances, endorsement and other obligations, provisioning norms, and ECGC and DICGC cover. What are not covered? Financial statements are not covered, also not important. Just I told you the format and that's it. Clear? Just get ready. You're going to start the next concept. Yes, insurance. I'll collect I'll cover electricity after insurance, because in this 10 or 15 minutes we can complete with insurance. Because insurance we will not cover everything, only two things. Life assurance fund okati, valuation balance sheet okati. Because from examination point of view, only those two things will be asked. So I'm going to cover only those two things. Sir, listen to the next one. Sir, life assurance fund. To tell you life assurance fund, only two things. Number one is like receipts minus expenses. In the given question, you just identify what are the receipts and add what are the expenses, deduct. Also, you will be having some opening balance. For that opening balance, you have to do all those adjustments. Clear, everybody? That's it, nothing great. What is life assurance fund? Dash minus dash. What is life assurance fund? Dash minus dash. Receipts minus expenses. Add all the receipts, deduct all the expenses to opening life assurance fund. So check out. Here opening life assurance fund is 62,21,310. Just answer me. Sir, what is this called? Claims covered under reinsurance. Sir, claims covered under reinsurance in the sense, is it something like receipt or payment? Receipt. Because reinsurance, hey, if it is claimed to outsider, I have to pay. Hey, now you're an insurance company. Clear? You're an insurance company and you took reinsurance. So claims covered under reinsurance, you have to receive. Am I correct or wrong? But take care, you're having claims intimated but not admitted. Claims intimated but not admitted. Receipt or payment? Payment. So it is like an expense. Am I correct or wrong? So how much you have to pay strictly? 26,500. But how much you will recover? 12,000. So net is nothing but 26,500 minus 12,000. 14,500 will be deducted. Clear, everybody? Sir, I'll admit that this is your income, this is your expense. But this income is directly relating to this expense. So set off. I have to pay 26,500, but I can recover 12,000. Only net 14,500 will be my expense. Pakka. Now tell me, sir, bonus utilized in reduction of life insurance premium. Sir, your premium is getting decreased because of this bonus. So automatically income or expense? Expense, and hence it has to be deducted. See, 4,500 has to be deducted. Understood? Minus, deducted. And next, interest accrued on securities. Income. So you just have to add it. Outstanding premium. Income. So you just have to add it. There ends with your closing balance life assurance fund. Clear, everybody? Very, very easy. Check out whether is it revenue or expense. If it is expense, deduct. If it is income, add. And if it is reducing your income or reducing your expense, set off. Pakka? That's it. And next concept is all about valuation balance sheet. Valuation balance sheet will be prepared only for 2 years. Valuation balance sheet will be generally prepared for how many years? 2 years. Likewise, first of all, you take life assurance fund already as computed above. Here we have computed life assurance fund. Am I correct or wrong? So you take this one as the computed part. Sir, you cannot tell that this is all my fund, because out of this fund you have to repay some liability. You have to repay some liability. My dear children, this is not a general liability. This is a liability which is given as per actuarial's valuation. There is another course like how CA, how CMA, like this, another course actuary, which is being taken by IAS, Indian Actuarial Sciences. Okay. So, likewise, how our board is there, in the same way IAB board will be there. It is taking care about all these things. Of course, it's a very, very difficult course and a very immense course, where people will generally tell that if you are able to clear one paper, you will get lakhs of rupees. Ante manam CA anta ayipothe lakhs of rupees. Actually, oka paper aithe you will get lakhs of rupees anta. It's such a typical course also. Anyways, so as per their valuation, you will be getting one liability. Say for example, your fund is 10 lakhs. And as per their valuation, you have to repay 22 lakhs. So still you are having a deficit of 12 lakhs, which is nothing but treated as loss. Clear, everybody? You may be asking my question, sir, why for liability you are going for actuary? That much sense why it is needed. Because here it is not your regular liability like loan. This is a liability where you have to repay to those persons claims. Likewise, one person may meet with his accident, or one person may not meet with his accident. Getting my point, everybody? So you have to pay to all those people. To whom you have to pay? How much you have to pay in your future? Say for example, you are having thousands of policies which will mature in the next year, that next year, that next year. And also out of all these things, some of the, what is that called? Customers. Some of the insured. So whose life is assured or dying. so which you have to pay the claim to the nominee. Some policies are getting matured because of period, some policies are getting matured because of the death. So all these things has to be considered, and they will be finding the net liability as per the actuarial valuation. Understood everybody? So if you check out, life insurance fund given is 34 lakhs and actuarial valuation is 28 lakh 80,000. So automatically you are having a net profit of 5 lakh 20,000. And take care, there is another point, interim bonus 40,000 was paid. Now it was proposed that 1 lakh 10,000 was carried forward. Remember, whatever the final profit will be there, out of that final profit, 95% will be declared as bonus to the policy holders and remaining 5% will be taken by the shareholders. So in this connection, you have got a profit of 5 lakh 20,000. So find the net profit before the bonus. How much is the bonus that we have already paid? 40,000. So what is the bonus before, what is the net profit before the bonus? 5 lakh 60,000. Clear everybody? Now out of 5 lakh 60,000, they have proposed to carry forward 1 lakh 10,000. So 5 lakh 60 minus 1 lakh 10,000. You will be getting the balance. Am I correct or wrong? Out of the balance, 95% will be enjoyed by the policy holders. Clear? So you have to pay 427,500, but already you have paid 40,000 to them. And hence this will be balance payable, and 5% of 4,50,000 will be the share of shareholders. Understood everybody? Now coming to the next one, there is another bonus called reversionary bonus. What is another bonus? Bonus will be of 2 types, 3 types strictly speaking. Bonus number 1, that will be paid in cash immediately. Interim bonus, which will be paid in between the periods. Reversionary bonus, which will be paid at the end of the period. Clear everybody? So some bonuses will be considered in the reduction of premium. Clear everybody? Likewise, company has to give you 1,000 rupees. You have to pay a premium of 30,000 rupees. Out of that 30,000, this 1,000 can get set off. Clear everybody? And illustration number 22 is all about your reversionary bonus. Okay, same style you have to continue like this itself, but only new point here is all about, for 600 lakhs is the business happened to the company. 600 lakhs is the business happened to the company, and company would like to declare 105 bonus immediately. If you don't want to take that cash bonus, I will give you 185 at the end of your policy period, which is called as reversionary bonus. So now what is the telling that 3/5 of the policy holders opted for cash. Give me immediately. So automatically 2/5 will be there, right? That 2/5 will be considered as a reversionary bonus. Clear everybody? I mean to tell, this is the additional point that you have to do to the previous problem in the current problem, and then you will be getting the final answer. Clear everybody? Anyways, my dear children, that's the end of your insurance companies. More than that, I would not like to speak. And also you, enough up to that part. Prepare all the problems on valuation balance sheet. Prepare all the problems on life insurance one. More than that, it is not required from insurance companies. Yes, what you heard is correct. More than that, it is not required from insurance companies. Inka మీరు ప్రిపేర్ అవ్వాలనుకుంటే లాస్ట్ లో ప్రిపేర్ అవ్వండి. ప్రిపరేషన్ ఆఫ్ ఫినాన్షియల్ స్టేట్మెంట్స్ లో నో ఏదో ఒక చాప్టర్ లో లాస్ట్ లో ప్రిపేర్ అవ్వండి అని చెప్పాను. ఏంటది? బ్యాంకింగ్ కంపెనీస్ లో ప్రిపరేషన్ ఆఫ్ ఫినాన్షియల్ స్టేట్మెంట్స్ లాస్ట్ లో ప్రిపేర్ అవ్వండి అంటే చాప్టర్ లాస్ట్ లో ప్రిపేర్ అవ్వండి. ఇన్సూరెన్స్ కంపెనీస్ లో లాస్ట్ లో ప్రిపేర్ అవ్వండి అంటే సిలబస్ అంతా అయిపోయిన తర్వాత నువ్వు చాలా కాన్ఫిడెంట్ గా ఉంటే అప్పుడు ప్రిపేర్ అవ్వు. అంటే ఇన్సూరెన్స్ కంపెనీ నుంచి నిన్ను ఫినాన్షియల్ స్టేట్మెంట్స్ టెస్ట్ చేయడానికి ఎంత పర్సెంటేజ్ ఛాన్స్ అంటే 0.5% ఛాన్స్. ఇప్పటి వరకు అడగలేదు, వాళ్ళు కూడా ఇప్పుడు అడగకపోవడానికే ఎక్కువ స్కోప్ ఉంది. రీజన్ బీయింగ్ ప్రిపరేషన్ ఆఫ్ ఫినాన్షియల్ స్టేట్మెంట్స్ మెయిన్, వాళ్ళకి కావాల్సిందే అది. సో వెదర్ యు ఆర్ గుడ్ ఆర్ నాట్ ఎట్ దాట్ పాయింట్ అన్నది వాళ్ళ ఫస్ట్ నోట్. ఆ తర్వాత వీటి దగ్గరకు వస్తారు. క్లియర్ ఎవ్రీబడి? అండ్ ఎస్, లెట్స్ మీట్ ఆఫ్టర్ ద బ్రేక్ విత్ by 5:30 with ఇండియస్. ఎస్, స్ట్రైట్ అవే ఇండియస్ స్టార్ట్ చేస్తాం. ఇంకా ఇప్పటి వరకు లాకింగ్ ఉన్నవి ఏంటి అంటే 2 చాప్టర్లు పడ్డాయి. ఈసాప్స్ ఒకటి, ఎలక్ట్రిసిటీ కంపెనీ ఒకటి. Okay, anyways, we'll go with Indays in the next session. Bye ma. So let me start with accounting standards. Of course, Ind AS. Before that, you're having conceptual framework. So going with the important things of conceptual frameworks. Fine, qualitative characteristics are all about relevance, faithful representation, and enhancing qualitative characteristics like comparability, verifiability, timeliness, and understandability. So let us start. So main fundamental qualitative characteristics are two. Well, listen, relevance. Relevance is nothing but financial statements have to be prepared by following the relevant information. Relevant information in the sense information occurred in that particular period and to that business concern. Clear, everybody? And next one is all about faithful representation. Your financial statements prepared should be represented faithfully. In the sense you also have to follow neutrality, complete and free from error. If you are having errors, then automatically trustworthiness and credibility will be decreased. And neutrality is nothing but financial statements prepared must be neutral. In the sense you should not bias. Say for example, there is a debtor who is totally related to the board of directors and he know that he will not pay the amount, even though he is recognizing it as sales and he is showing that part as a debtor. Did you get my point? Who is a close relative to the board of director. He will not pay. So automatically it should be written off immediately as a bad. Am I correct or wrong? But he is not even creating a provision. He is showing him as a debtor. Clear? So are the financial statements neutral or not neutral? Financial statements are not neutral. Neutrality in the sense they should be free from bias. But there is a relative to the board of directors and he is having bias over to that person. Did you get my point? Neutrality is something like you should not show bias. Say for example, there are 100 debtors, out of which 10 debtors are doubtful. So immediately you have to create provision on these 10 debtors. Clear, everybody? But one particular debtor being close relative to the board of directors, he has ignored that and he has created only provision for the 9 debtors. Tell me, are the financial statements neutral or not neutral? Not neutral. They are not free from bias. They have shown bias in preparation of financial statements. Getting my point, everybody? And next one is all about complete. Your financial statements should never be complete. I mean, should never be incomplete. They have to be complete and they have to disclose each and every element. And next one, enhancing qualitative characteristics you may get for 4 marks question. Comparability. So whatever the financial statements that you prepare should facilitate the comparison, either inter comparison or intra comparison. Inter comparison in the sense your company will have to be compared with some other companies. Intra comparison is nothing but your company will be comparing with your company itself like previous year and current year. Clear, everybody? Should facilitate root comparisons, inter and intra. Inter in the sense between the different companies. Inter అదే కదా చెప్పింది. Inter in the sense between different companies, intra in the sense within the same company but for previous years and current years. And next one is all about verifiability. Your financial statement should facilitate for the verifiability. Likewise, it should facilitate for the purpose of verifying the same with the other business concerns, and it should facilitate the better decision making. And next is all about timeliness. So you have to prepare the financial statements so as to depict to the users on a timely basis. So say for example, generally current year financial statements will be prepared in the next year. Next year financial statements will be prepared in the later years. Clear, everybody? But you should not take something like current year financial statements should be prepared at the next year ending. Hardly 6 months time lapse is okay, but you're taking 12 months time lapse, which is not proper. So timeliness, you have to prepare your financial statements on a timely basis. Reason being, only upon those financial statements users will be verifying and they will be able to make the decisions. Otherwise the things will not work out in a better way. And understandability, finally the financial statements must be understandable to the layman also. Sir, my intention is all about how an engineering person can understand this financial statements. But your financial statement should be prepared even to that engineering student needs to, to that engineering person needs to understand. Sir, is it something that investor can't be an engineer? Yes, he can become. Am I correct or wrong? So if an engineer about to take his decision, does he needs to go with the financial statements or not? But to go with the financial statements, first of all, he need to understand that one. So how can he understand? It's very, very simple. Generally, he may not know the literal terminology of each and everything, and he may not project it clearly. But if the company is following the stable formats, whatever are released by law and whatever are released by accounting standards or Ind AS, then everybody can understand. Did you understand? Sir, is the concept clear? How each and everybody will be getting understandability? Very, very simple. You prepare the financial statements by following relevant laws and by following Ind AS. Automatically everybody can be understood. Clear? And moving on to the next thing. Elements of financial statements. That's all about 5 elements you'll be having. Asset, liability, equity, income and expenses. These are the 5 elements of financial statements. Incomes and expenses will be reflecting the financial performance. Performance is nothing but statement of P&L account. Whereas assets, liability and equity will be dictating the position of a company, which is nothing but balance sheet. Wherein liabilities and equity will be the part 1 and assets will be the part 2. Clear everybody? And the next concept is all about recognition and derecognition. Sir, you actually have to learn 4 things whenever you are going with Ind AS. Recognition, measurement, presentation and disclosure. Recognition is nothing but recording in the books of accounts. Measurement is nothing but that recording is fine, but with how much amount? Say for example, you have paid salary. Salary accounted or to cash or bank. I can recognize, but amount. Logic understood? I cannot tell I don't know amount. No, you have to recognize, and that is nothing but measurement. After recognition, you have to put the amount like 1,000, 2,000, how much is paid. That is nothing but measurement. Presentation is nothing but this recognized item has to be somewhere presented either in trading account or P&L account or even in balance sheet. Clear or not? So simply to tell you where the items have to be presented in the financial statements, where the items have to be presented in notes to accounts. That is disclosures. Clear? Disclosures will be done in notes to accounts. Presentation will be done in financial statements. You use the terminology. Yes, that's correct, but nothing great. Presentation will be done in financial statements. Disclosures will be done in measurement is nothing but amount, value, and recognition is nothing but recording. Recognition is nothing but, and there is another concept that is derecognition. Derecognition is nothing but cancelling the recording. Likewise, at the time of purchase, you will be writing a journal entry. Am I correct or wrong? What is a journal entry? Asset account debtor to cash or bank account. If the asset is sold, you will be writing another entry, cash or bank account debtor to asset account. This is called recognition of asset. This is called derecognition of the asset. Clear everybody? Derecognition in the sense wiping out from the books of accounts. Whatever is debited will be credited to wipe out. Whatever is credited will be debited to wipe out. Understood? That is the concept of recognition and derecognition. And measurement. Okay. Yes, moving on to the next one. 4 types of measurements you will be having. Listen very, very carefully. Historical cost basis, current cost basis, realizable value basis, present value basis. Historical cost is nothing but asset is purchased at one particular cost price. Am I correct or wrong? That is nothing but historical cost, which is literally nothing but cost price minus depreciation. Cost price includes purchase price plus direct expenses. Say for example, you have purchased an asset for 1 lakh. Installation expenses comes to 10,000. What is the total cost price? 1,10,000. Say the depreciation charge is 25,000. So 1,10,000 minus 25,000, which comes to an amount of 85,000. Clear everybody? So now you're recognizing your asset on which basis? Historical cost basis. Clear everybody? So 1 lakh plus 10,000 minus 25,000 is nothing but 85,000. Pakka. And moving on to the next thing, current cost basis. Sir, what is current cost basis and realizable value basis? Listen very, very carefully. Say for example, this is the asset that we are purchasing. This is the asset that we have purchased. Now this is lying in our business concern. If you would like to sell the same asset, how much this asset will fetch, that we will be calling it as realizable value. And you would like to replace this existing asset with a similar kind of asset. With similar kind of asset, for similar kind of bottle, I would like to replace this bottle. That is called as current cost. Current cost in the sense, replacing the existing asset with the new asset. How much you have to pay is called as current cost. Whereas realizable value, selling the same asset. To tell you, market value of similar asset to purchase, market value of same asset to sell. Understood? And finally, present value basis. By using a particular asset, a company can generate some inflows of future economic benefits. Will you admit or not? So say for example, year 1, 10,000 generated, year 2, 25,000 generated, year 3, 20,000 generated, year 4, 22,000 generated. Now you would like to know present value of all this thing is nothing but year 0. Year 1 to year 0, year 2 to year 0, 3 to year 0, 4 to year 0. So everything has to be brought to the present value, and that present value of discounting factors is nothing but present value basis. Perfect, everybody. This is the concept of measurement techniques or different concepts of measurement. The same is also applicable for liability. Quickly listen. Say for example, if you have taken a liability, say for example, you have taken a loan. You have applied a loan for 20 lakhs. But after deducting the brokerage and commission 1 lakh, after deducting another charges of 1 lakh, you had got only 18 lakhs in your hand. How much you have to repay? 20 lakhs or 18 lakhs? 20 lakhs. So your historical cost is not just the amount received, but also all the charges incurred. So 18 lakhs plus 1 lakh charges incurred plus brokerage and commission 1 lakh. So you have to repay liability of 20 lakhs. If out of 20 lakhs, if you have already repaid 3 lakhs, then the balance how much is there? 17 lakhs, which is nothing but historical cost basis. Understood? On current cost and realizable value basis, if you would like to repay this loan immediately, how much balance is there? So if you would like to repay this loan immediately, generally no need to pay future interest. Repay the 17 lakhs. But what the banker is telling you, no, sir, you have to repay the loan in the coming 10 years. But you are repaying right now itself. So I am losing 10 years interest because of you. Correct or wrong? Because banker thought that you will repay in the next 10 years and banker thought you will pay interest to them. But you are repaying it immediately. So banker is thinking that I am losing interest because of you. So I will charge a penalty on you. That penalty is nothing but prepayment penalty. What is that penalty? Say for example, 17 lakhs plus 10% penalty is charging, which comes to 18 lakh 70,000. And this 18 lakh 70,000 is nothing but value that has to be paid immediately if you would like to settle the loan, which is nothing but realizable value basis. But since it is a liability, we will not call it as realizable value basis. We will call it as settlement value basis. What is that called as? Settlement value basis. And next one, current cost basis. That is like if you would like to replace the existing loan with some other loan, then how much amount you can get is nothing but current cost basis. Finally, present value basis. Likewise, you have to liability in the sense outflow of future economic benefits. Am I correct or wrong? Asset in the sense inflow. Liability in the sense outflow. So outflow of future economic benefits were brought to the present value. Whatever the value accrues to the present part is nothing but settlement present value basis. Understood, everybody? That is a concept of historical cost, current cost, realizable value, and present value. Historical cost, cost price minus depreciation. For a liability is nothing but how much total liability you have to repay. Current cost, market value of similar asset you would like to purchase. Market value, I mean how much loan, if you are taking a similar kind of loan, how much amount you will get is nothing but current cost. Realizable value is nothing but market value of same asset if you would like to sell. And settlement value is nothing but on the spot if you would like to settle, how much amount you have to pay. That is nothing but settlement value basis. And next one, present value basis. Likewise, for assets, present values of future cash inflows. For liability, present values of future cash outflows. Understood, everybody? That is what your measurement techniques. And moving on to the next thing, capital maintenance. There will be 3 capital maintenance. Take care. And the 3 capital maintenance are nothing but historical capital. One second. Financial capital maintenance at historical cost. Financial capital maintenance at current cost. Physical capital maintenance. Clear, everybody? Of course, physical capital maintenance will be always at current cost itself. But here current cost index you have to consider average index. Here you have to consider specific index. What is this nonsense, sir? First of all, what is the meaning of capital maintenance? To flourish the business. To develop the business. Last year capital employed is 1 lakh. This year you would like to employ only 80,000. Do the business runs on the same lines? No. So how much capital minimum you have to maintain? 1 lakh. Until last year ento, current year kuda ante. Opening ento, closing kuda ante undali. That we will call it as capital maintenance. How much ever the opening capital is there, the closing capital should be the same style. Then we will be calling it as capital maintenance. Understood everybody? So now listen very carefully. Say for example, if your opening capital is 1 lakh and you have got a net profit of 20,000, how much minimum capital you have to maintain year end? 1 lakh. So how much drawings you can do? This is called as capital maintenance. Financial capital maintenance at historical cost. Say for example, drawings were 30,000. Is the capital maintained or not maintained? Because the balance is only 90,000. This is what financial capital at historical cost. And financial capital maintenance at current cost. What do you mean by financial capital maintenance at current cost? For this one, you have to check out average index. Which index you have to check out? Sir, current cost, just now I told you, if you would like to replace the current good or if you would like to purchase, how much ever you have to pay, that we will be calling it as current cost. Say for example, opening how much capital is there? 1 lakh. Each and every price of the good is rupees 10. Clear everybody? And automatically 1 lakh divided by 10, how many units you are having? 10,000 units. Current year you have got a profit of 30,000. Clear everybody? Sir, now listen very carefully. Financial capital maintenance at which cost we are telling? Current cost. So check out the average index. Capital gains in the capital gains flow, you will be having indices. Base year 2000, 2100 అనుకుని చేస్తారు కదా, అలాగే it will be given in the question. Say for example, opening index is 100. Closing average index చూడాలి. What you have to check out? Average index. If you are checking specific index, that we will call it as physical capital maintenance. Now we are learning which capital maintenance? Which capital maintenance? Financial capital maintenance at current cost. So you have to check out which index? Average index. Say average index is 120. How much is average index? Opening price how much is there? 10. So if opening index is 100 and closing average index is 120 and opening price is 10, then closing price is how much? You have to find that. You will get 12 rupees. How much you will get? 12 rupees. So, sir, opening how many units are there? So even closing also you have to hold 10,000 units for sure. But this time how much is the price? 12 rupees is the price. So 10,000 multiplied by 12. 1,20,000 is needed this time. So trader is drawing 20,000. Trader is drawing how much? Is the capital maintained or not maintained? Not maintained, because how much is there for you? 1,10,000. But you want a minimum of 1,20,000. So capital is not maintained. Clear? Hey, but can I tell that in this context, financial capital at historical cost is maintained? Yes or no? Because opening how much is there? Closing how much is needed? But how much is there? Super. Physical capital maintenance, financial capital maintenance at historical cost is maintained, but FCM at current cost is not maintained. Clear? Apply the same logic for this one also, but which index you have to check out? Specific index. Say for example 1 lakh at the rate 10, which comes to 10,000 units. You made a profit of 50,000. Totally you are having 1,50,000 in your hand. Clear everybody? Say for example, at the year end, price had reduced to 9 rupees. How many units needed? 10,000 units. So automatically how much is needed? 90,000. Trader withdrew 60,000. Maintained or not maintained? Exactly maintained. Because 1,50,000 minus 60,000 is equal to 90,000. You also need 90,000. Say for example, the balance is 80,000. Maintained or not maintained? Not maintained. Pakka. So what are the three capital maintenance you are having? Financial capital maintenance at historical cost, financial capital maintenance at current cost, physical capital maintenance at current cost. This one rupees are units. Opening rupees, opening capital rupees is equal to closing capital rupees. This one rupees are units. Opening units is equal to closing units. This one units. Opening units is equal to closing units. But what is the difference between these two things? Average price index, specific price index. Clear everybody? Sir, నేను ఓపెన్ లో ఒకటైతే చెప్తాను. Don't quickly judge the class. That is what my intention. Because ఈ ప్రపంచంలో చాలా ఫ్రీగా వచ్చే పాయింట్ ఏంటంటే జడ్జింగ్ ది అదర్స్. చాలా ఫ్రీగా హ్యాపీగా మనం కూర్చుని ప్రశాంతంగా చెప్పచ్చు, మీరే కాదు నేనైనా అంతే. బట్ ఐ వుడ్ లైక్ టు గివ్ ఎ నోట్ ఆన్ దిస్ పాయింట్. ఐ డోంట్ నో వాట్ ఇన్ వాట్ స్టైల్స్ యూ హ్యావ్ లెర్న్డ్, in what materials you have learnt. Even I don't know what is the context of your learning, but I am following study materials and I'm letting you know the same. But I can strictly and I can firmly tell that whatever you have learnt might be covering here and some extra elements might have covered. That is what my point. Of course there might be some elements which are uncovered also due to this time gap or time frame, and whatever the materials you have learned, those are ultimately prepared from study material itself. మీకు సప్లిమెంటరీ మెటీరియల్స్ మీకేనా ఉన్నవి? సప్లిమెంటరీ మెటీరియల్స్ అంటే మీరు 18th ఎడిషన్ ఓల్డ్ ఎడిషన్లో నేర్చుకుంటారు. ఓల్డ్ ఎడిషన్ ప్లస్ సప్లిమెంటరీ యూ హ్యావ్ టు ఫాలో. ఫైన్. సో లెట్ మీ ప్రొసీడ్ ఫర్దర్. దిస్ ఈజ్ వాట్ యువర్ క్యాపిటల్ మెయింటెనెన్స్ ఈజ్ ఆల్ అబౌట్. పక్కా? సో దాట్స్ ద ఎండ్ ఆఫ్ యువర్ కాన్సెప్చువల్ ఫ్రేమ్వర్క్. నౌ లెట్ మీ స్టార్ట్ విత్ Ind AS 1. Ind AS 1 is nothing but presentation of financial statements. Sir, before starting this one, would like to make you aware of one thing, that presentation of financial statement in Ind AS 1 is applicable only for standalone financial statements and consolidated financial statements at year end, but not for interim financial statements. Interim financial statements in the sense those financial statements which are prepared before the completion of financial year, something like quarterly financial statements. Hope you know that SEBI quarterly reporting has to be done to Securities Exchange Board of India by each and every company. For that purpose, Ind AS 1 is not applicable. Ind AS 1 is applicable only to SFS or CFS which are prepared at the end of the year. So some of the observations here you need to take care is all about current liabilities, current assets, non-current liabilities and non-current assets. Current liabilities, any of the four things. Number 1, if the repayment has to be done within 12 months or which is within the operating cycle, or which is held for trading, or where you cannot defer the settlement more than 12 months. Point number 1, if you have got liability in the course of trading, at the time of purchase and sale, if you have got a liability, then it is obviously a current liability. Clear everybody? Next one, you have to check out whether if it is less than or equal to 12 months or not. If it is less than or equal to 12 months, you are having a creditor where you have to repay him within 7 months. Is it less than 12 months or not? And hence it is a current liability. And with an operating cycle, say for example, your operating cycle is 18 months. Sir, first of all, what do you mean by operating cycle, sir? Operating cycle is nothing but raw material has to be converted into cash. Operating cycle is nothing but raw material has to be converted into cash. Something like raw material you will purchase. After purchasing, you will not immediately put to process of production. Am I correct or wrong? You may hold raw material for some period. Plus, you have introduced it into work in progress or production process. If you introduce today, it will not come near. I mean, if you introduce it in for production process, the finished good will not come just within 1 minute. It will take some time, which is called as work in progress holding period. Plus, if the finished good is ready, it cannot be sold immediately. It will be in the godown for sure, which is called as finished good holding period. Clear everybody? And if you have sold it on cash basis, okay, but you may also sell it on credit basis. So debtor will not repay you immediately. So plus debtor's collection period minus creditor's payment period, because creditor's payment period you have to less it because you have to pay that. All this is collection, this is payment. Understood everybody? This we will be calling it as operating cycle. Say if the operating cycle is 18 months. Within 18 months, whatever liability you have to pay, all those liabilities are current liabilities only. Sir, now you told within 12 months, standard, you told within operating cycle 18 months. Now what is to be considered, sir? Did you get my point? Within 12 months or within 18 months? Within 18 months. Say for example, standard is within 12 months, sir, but our operating cycle is only 8 months. What I have to consider? Within 12 months. Clear everybody? So simply to tell you, whichever is higher has to be considered as current liability. Understood? And last and final, you cannot defer the settlement more than 12 months. Say for example, I have borrowed a loan which has to be repaid just within a span of 3 months. But that creditor from whom I have borrowed is well known to me. I may repay the same loan even after 3 years also. He will not question it. Clear? Is it a current liability or non-current liability? Non-current, because you can postpone the settlement. Defer is nothing but postpone. But say for example, you have taken a loan from the bank which has to be repaid within 3 months. Can you postpone the settlement more than 12 months? Impossible. So in that case, it will become a current liability. Okay, everybody. And moving on to the next thing, current asset. Again, the same thing. Number 1, asset which was arised from the trading. So if trading course, if any asset is there like stock, debt or whatever, we will be calling it as current asset. And moving on to the next thing, within 12 months, if you are going to get the amount, we will be calling it as current asset. And next is all about within operating cycle, you will be calling it as current assets. 12-month or operating cycle, whichever is higher. Last and final, you are having cash and cash equivalents, but it cannot be used. It is reserved. Its uses up to 12 months. Did you get my point? You are having, say for example, what is this called? Debenture redemption investment. For the purpose of investing, you have took around 1 lakh and you are putting it in a separate bank account. For the purpose of investment, you have kept rupees 1 lakh aside. Can you use it within 12 months for your own purpose? No. So is it a current asset or non-current asset? Non-current asset. Clear, everybody? So that cash which is not restricted to use within 12 months is called as a current asset. If the cash is restricted with its uses up to 12 months, then it is called as a non-current asset. Pakka, everybody? These are the definitions that were being given in your in-days number 1 presentation of financial statements. Perfect. So non-current assets are those assets which are other than current assets. Non-current liabilities are those liabilities which are other than non-current liabilities. Current liabilities. Now, moving on to the next thing, what includes in the set of financial statements, sir? Set of financial statements includes balance sheet, P&L account, cash flow statement, statement of changes in equity, notes to accounts. Along with these things, you may also have comparative balance sheet. Along with these things, you may also have comparative balance sheet. What do you mean by comparative balance sheet? Sir, if an accounting policy is changed, do you need to give prospective effect or retrospective effect? Change in accounting policy, prospective or retrospective? Retrospective in the sense past to future or present to future? Past to future, in the sense even your past year financial statements have to be changed. Correct or wrong? For that purpose, you have to prepare an additional component that is like comparative balance sheet. Understood, everybody? So check out the 5th one, a balance sheet at the beginning of the preceding period where the entity applies an accounting policy retrospectively. If at all any change in accounting policy is there and you have to give a retrospective effect, for that point you have to consider. Say for example, till today you have followed FIFO method, but you would like to shift to weighted average method. So is it change in accounting policy or not? So which effect you have to give? Retrospective effect. So that effect has to be given only in the current year. Response, sir. That effect has to be given only in the current year by considering all the previous year financial statements. Previous year financial statements effect anta kuda current year lo matrame ivvagalam. Reason being, all the previous year financial statements were approved and closed kada. And hence you cannot alter the previous year financial statements. That effect has to be given. That effect has to be given only in the current year. All the previous year effect has to be given only in the current year. Understood, everybody? But you have to consider the opening balance sheet by changing the policy. Likewise, along with all the balance sheet, P&L account, cash flow statement, so statement of changes in equity and notes to accounts, you have to prepare additional opening balance sheet by considering this change in accounting policy. Clear? If accounting policy marite, నా బ్యాలెన్స్ షీట్ మీద ఎఫెక్ట్ ఎలా ఉంటుందని మళ్ళా నేను లాస్ట్ ఇయర్ ది ప్రిపేర్ చేసి కరెంట్ ఇయర్ లో చూపించాలి. రెస్పాండ్ పక్కా. That's the concept with respect to the financial statements. So normally financial statements as per Companies Act 2013 includes only 5 components, but it also includes the 6th component that is like opening balance sheet by changing the accounting policy. Understood? Okay, moving on to the next thing. This is all common. Going concern common, accrual common, materiality and aggregation common, offsetting okay. This one, comparative information. That's very important. And coming to the first one, minimum comparative information. Very, very simple. Sir, even when you go with the Companies Act 2013, you will be preparing the financial statements. Am I correct or wrong? For how many years you have to prepare the financial statements? 2 years. One is for current year, another is for, in order to get a clear comparison. Am I correct or wrong? But if the entity so decides, it can also give additional comparative information. It can give additional comparative information. That is their wish. They have given some additional comparative information. While giving additional comparative information, there is no rule such, no need to follow Ind AS. They have to follow Ind AS. Say for example, this company had given information not only for current year, previous year, and also that previous year. Current year is 2020-21, also given for 1920, also given for 1819. So can you tell that, sir, these 2 years are obviously we are following Ind AS. For 1819, I will not follow Ind AS. No, such kind of thing is not possible. Whatever you are presenting in the financial statements, you have to follow Ind AS. Understood, everybody? And one more thing, like this, can a company give its additional comparative information only for P&L account, and can it leave for other components like balance sheet, cash flow statement, and statement of changes in equity? అర్థమైందా క్వశ్చన్? ఫస్ట్ minimum comparison clear? How many years data you have to give? Additional comparison, if the company so decides, it can give more than that 2 years also. But for that, can it follow its own choice or it has to follow Ind AS? This is also clear. ఇప్పుడు నేను అడిగేది ఏంటంటే, company has decided to give this additional comparison only for P&L account, one component. For balance sheet only 2 years. For P&L it would like to give 3 years. For cash flow statement it would like to give only for 2 years. Possible or not possible? Yes, it is 200% possible. Of course they'll mention the same by way of note, otherwise how things will be possible. Clear, everybody? The same has to be mentioned by way of note. Understood? That is a concept of comparative information, which is a kind of new thing in your Ind AS. So that is the main concept of your Ind AS. 1. Presentation of financial statements. So take care. The main components that you have to take care is all about definitions, and the next concept is all about comparative statements. Clear? Okay. So just wait, let me write it somewhere here. So they have actually completed 2 things. So Ind AS, in Ind AS, first one, conceptual framework. In conceptual framework, main things, you may get theoretical questions also. Basic characteristics or fundamental characteristics, 2 things, faithful representation and relevance. And the next one is all about qualitative characteristics or enhancing characteristics. Likewise, you are having verifiability, okay, completeness, all those things. And next is all about capital maintenance, physical capital maintenance, financial capital maintenance. And in conceptual framework, another one we have learned, measurement basis. Okay, these are important. And coming to Ind AS, number 1, presentation of financial statements. Number 1, definition of general purpose financial statements, which includes 6 components, not just 5 components. And moving on to the next thing, what is it called? Comparative information. And the next thing is all about definitions. Okay, and let me tell you the comparative information from Ind AS number 2. Ind AS number 1 is totally new, like presentation of financial statements. There is no corresponding accounting standard on that. But coming to Ind AS 2, what is valuation of inventories or just inventories, you are having corresponding standard even inventories. So you may get some comparisons on those 2 things. Clear? Just within a span of 2 minutes, we are going to start Ind AS number 2. Okay, let us start with the next one, inventories, which is nothing but Ind AS number 2. So listen very carefully. Sir, there's a lot of difference between the names of the standard itself. AS2 is valuation of inventories. It deals only with the concept of measurement, but here it deals with inventories. Clear? How inventories will be converted into expense, this standard will deal. But how the inventories will be converted into expense, accounting standard number 2 is not dealing with the same. And let me continue with the first one, that is all about scope. Take care, this standard is applicable to all the inventories except financial instruments as per Ind AS 32 and presentation and Ind AS number 109, which is nothing but financial instruments. These standards will be strictly telling that those financial instruments which has to be carried on at fair values. Clear? So for these things, there are special standards. So you have to follow only those special standards. And coming to the next one, biological asset. Okay. Coming to biological assets, which are nothing but living animals and living plants. So coming to living animals and living plants, if at all those are treated as inventories and automatically accounting standard number, Ind AS number 2 is not applicable for that, and for that Ind AS number 41 is taking care, and for agricultural related agricultural norms, industrial norms will be taking care. Clear? And moving on to the next thing, very important, this standard will be applicable to these things, but it will not applicable to the measurement only. Producer's inventory. Likewise, listen very carefully. Say for example, there is a farmer. Who is there? Farmer. Is a farmer producer or not? Yes, farmer is a producer. Farmer is producing crop. Okay. So this is producer's inventory. For this producer's inventory, Ind AS 2 is applicable, but for measurement, Ind AS 2 is not applicable. Clear? In the same way, mines and minerals extracted by a company. That company is extracting the mines and that company is extracting the minerals, which is also called as producer's inventory. Ind AS number 2 is applicable, but again it will not be applicable for measurement. Clear? I have a question for you. Crop, which is being sold by Mr. A, who is a trader. Is the measurement applicable or not? Answer, applicable. Because Mr. A is not a farmer, he is a trader. Producer inventory. Farmer is the producer, but trader is not the producer. From the farmer, this trader is purchasing and he would like to sell the same. A concept clear? If it is producer's inventory like farmer or extracting company, then to those companies and to those farmers it is not applicable. But if he is a trader, then automatically Ind AS number 2 is applicable even for measurement also. Clear? And moving on to the next thing, commodity broker traders, which is nothing but something like share brokers, sub brokers, stock brokers, etc. and etc. To all those people also, measurement concept is not applicable, but Ind AS 2 will be applicable. And coming to inventory, inventory might be either finished goods, work in progress, or raw material, or stores and spares, or any other supplies. And next one, NRV, net realizable value is nothing but, in our simple language, estimated selling price minus estimated selling expenses. And next one, fair value. This fair value is newly covered only in Ind AS 2. This concept is not there in accounting standard number 2. Fair value is the price that will be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants. This is very important. Market participants is nothing but unrelated buyer and seller. Market participants are nothing but related or unrelated. Unrelated buyer and seller. Clear everybody? Say for example, I am about to sell the product and customer had come. He is about to purchase the product. To that unrelated person, at what price I am about to sell this product and at what price that person is about to purchase the same product, that we will be calling it as fair value. Clear? If that person is related to me, generally I'll sell this product at 100 rupees, but to that person I'll be selling it at 92 rupees only. What is the fair value? Can 92 be considered as a fair value? No, because fair value should be between market participants. Market participants are nothing but unrelated buyer and seller at the measurement date. That is also very important. At the measurement date, in the sense, generally you will be measuring the inventory at the end of the year. Yes or no? So as on that date, you have to check out. That is what your fair value. And cost of inventories, that's all common. I'll be telling you. Okay. Just listen. Costs. Two things are there. Number one, manufacturer and trader. Number two, service provider. Coming to manufacturer, first of all, he has to purchase raw material. Am I correct or wrong? So cost of raw materials purchased plus he is converting manufacturing. So we'll be having some labor, direct labor plus overheads. Understood? And coming to a trader, he is not manufacturing. He is just purchasing the finished good. So which is nothing but cost price of finished good. Cost price is nothing but purchase price plus direct expenses. Likewise, the trader is purchasing a good at 20 rupees. So 20 goods multiplied by 20, say which comes to an amount of rupees 400, but transportation expenses are rupees 40. So 400 plus 40 is my total cost of inventory if I am a trader. But if I am a manufacturer, first of all, I need to purchase raw material, then I need to go with direct labor, then I need to go with overheads. Clear? But the problem is all with overheads. Because direct labor varies with per unit of production. Cost of raw material varies with per unit of production. But coming to overheads, there are two things again. Variable overheads, fixed overheads. Variable overhead, again, no problem to me. It varies with per unit of production. But fixed overheads, irrespective of production, you are having that. Am I correct or wrong? So fixed overheads has to be apportioned. On normal or actual, whichever is higher. On normal or actual, whichever is higher. Say if your normal standard production is 1 lakh, but you are actually producing 1,20,000 units and your fixed overheads are 10 lakhs. Fixed overhead per unit is equal to 10 lakhs divided by 1,20,000 because whichever is higher. Say if your actual products comes only to 90,000 units, then 10 lakhs divided by 1 lakh has to be considered. Logic clear, everybody? So, sorry, not logic, concept. I can't tell the logic for the same because it takes time. But you remember only one thing. For fixed overheads, a portion will be done either on dash or dash, whichever is dash. Normal or actual production, whichever is higher. Perfect, everybody? So, that is the concept of your fixed overheads. And that is the concept of your manufacturers and traders, cost price. Now, coming to service providers. Sir, service provider was specifically excluded in accounting standard number 2, but Ind AS 2 is also dealing with service provider. Say for example, for your kind information, my dear Shivan, traveling agency which is providing traveling services is a service provider. Say for example, there are tourists who had come to the traveling agency and booked the car. Clear, everybody? And I had sent the car along with the driver to those customers. And the trip is for 1 month. By the year ending, the trip is still pending, not yet completed. It is in work in progress. Understood, everybody? It will be treated as inventory by the service provider. Logic clear? Traveling agency, 1 car they have booked, and along with that car I am sending 1 driver, and the total trip is for 1 month. Year ending, the trip is not yet completed. So it can be treated as inventory. Understood, everybody? But the biggest problem here is all about what is the cost of that inventory, sir. How much ever the amount that you will pay to the labor, direct labor. Correct or wrong? That is like you are paying some amount to the driver, correct or wrong? That will be treated as inventory, direct labor. Plus overheads. Of course, for that 1 month, for that car, you have to keep some repairs. Am I correct or wrong? So even it also included in the inventory, cost of inventory of service providers. So what includes in the cost of inventory of service provided, sir? Direct labor and overheads. Material will not be there for that. Sir, understood? If there is material, then automatically it will become a good. It will not become a service. So now you are just going with some service. You are providing car for the purpose of traveling. You are not selling the car. Logic clear? That is the end of cost price. So let me conclude. Cost price to a manufacturer. Cost of raw material plus direct labor plus variable overheads plus fixed overhead. Fixed overhead is equal to total fixed overhead divided by actual or normal, whichever is higher. To trader, sir, cost of purchase, which is nothing but purchase price plus direct expenses. Likewise, quoted price. Coming to direct expenses, you may have carriage inward, freight inward, traveling expenses, transportation expenses. Getting my point, everybody? All those things will be considered. And coming to your service provider, there is no dash to service provided. Material will not be there. Then what is there, sir? Labor plus overheads. Understood, everybody? Okay, so this is what the cost price. Now, some specific point, like cost will not include the following things. Abnormal losses. Normal loss will be included. Abnormal loss will never be included, because abnormal loss in the sense you are not doing the production properly, due to which there is some huge loss, which will become your general loss, which has to be charged to P&L account. It cannot be added to your original cost price. And next one, storage cost. See, this is very, very important. Likewise, finished good is ready. Yes, finished good is ready, and you are storing it in godown. You have incurred some storage cost of rupees 1 lakh. Will it become cost of inventory or not? మీకు ఆన్సర్స్ ఉన్నవి ఎస్ ఆర్ నో చెప్పడం మాత్రమే. క్వశ్చన్ అర్థం కాకపోతే మళ్ళీ చెప్తా. మీరు వినట్లేదు అయితే. ఫినిష్ గుడ్ ఇస్ రెడీ. యూఆర్ స్టోరింగ్ ఇట్ ఇన్ గోడౌన్. స్టోరేజ్ కాస్ట్ 1 lakh. Is this 1 lakh a part of inventory or not? Answer. Okay. Second example. Process 1. Output is ready. This output has to be stored only for 1 month. Only then it can introduce for process 2, and then you will get finished good. Here you are paying a storage expenses of 80,000. Clear, everybody? So will it be included in the storage cost or not? First one? No. Second one? Yes. Because second storage cost is directly related to production. First storage cost is not at all directly related to production. Understood, everybody? So depreciation, if it is relating to office and administration, it will not be considered. If depreciation is relating to production, like overheads, it will be considered. Clear, everybody? So see here, administration overheads. Salary paid to staff, salary paid to office staff will not be considered. But salary paid to supervisor, because it is a part of production. And finally, selling cost. Selling cost is not to produce the inventory, it is to sell the inventory. So it is not at all considered in inventories. So these are the 4 costs that were excluded: abnormal losses, storage cost, administration overheads, selling cost. And if at all storage cost and administration overheads are directly related to production, these 2 will be again included. Understood, everybody? Cost of service provided, just now we have done. So cost of agricultural produce from biological asset, sir, this will be directly taken at NRV. Cost of agricultural produce will be directly taken at NRV, net realizable value. And moving on to the next thing, cost formula. Yes, coming to cost formula. Listen, as per accounting standard number 2, you can use any method which is representing fairest approximation cost, but that is not needed for us. As per Ind AS 2, you can use any method like FIFO or weighted average, but consistency is very, very important. But what is more important? Consistency. Say for example, for all the similar kind of inventory, you have to follow the same method only. For all the similar kind of inventory, you have to follow the same method. Understood? For different kind of inventory, you can follow different method. But accounting standard number 2 is not having such kind of specification. So check out. You can use only 2 methods. What are those 2 methods? FIFO and weighted average. Clear, everybody? So strictly speaking, first of all, specific identification method is there. Sir, what do you mean by specific identification method? You have purchased one good at what price? If you are able to identify it specifically, then it is called a specific identification method. Understood? Say for example, you are purchasing one perk box. Perk chocolate box, say for example at rupees 100. And another perk box is purchased at rupees 98. Another perk box is purchased at rupees 102. Clear, everybody? So now these 3 perk boxes are clubbed with one another. Each and every perk box, say for example, having 50 chocolates. Each and every perk chocolates boxes were clubbed. Now I have kept those 3 boxes before you. I'm asking, pick the box which is purchased at 102. Generally, tell me the answer. Possible or not possible? Pichi answer chepkandi sir. Expiry date I will see, number I will see, anta em akkarala. So straight away possible or not possible? So and hence you cannot use specific identification method here. Say for example, it is a box wherein 10 gold rings are there. All the gold rings are of similar type, similar model. Clear, everybody? So now you have picked one gold ring and accidentally it was dropped into the same. Can you pick it or not? Yes, you can pick it. Clear, everybody? Say for example, you have taken that gold ring and you have already seen the weight, and the weight is something like exactly 10.002 grams. Clear? And the same model, what is it called? Same model of the ring is picked out, and if you are checking the weight, it is 10.02 grams. Can you identify the difference between these two goods or not? Yes or no? Yes, you can identify. 10.002 and 10.02. Say for example 10.05. Happy? Sir, is the logic clear? You take one ring. This is the ring I have picked out. Just wait. 10.05 grams. No, this is not the ring I have picked out. It is 10.002 grams exactly. Bring that ring. So is it specifically identifiable or not? Yes. So for specifically identified goods, you can use specific identification method. If you cannot identify it specifically, you can just leave the same. So for those goods which are not specifically identifiable, you are following FIFO method. First in, first out. So if you have checked out, first per box is purchased for 100. So you assume that this was sold first. Or you can also use weighted average method. What are the two methods permitted? Specific identification method or non-specific identification method. If you can identify the good specifically, which method you have to follow? Specific identification. If you cannot identify the good specifically, FIFO and weighted average. Sir, for different kinds of inventory, can you use different methods or not? Yes, because different kinds of inventory. For similar kind of inventory, can you use different methods? No, that is not possible. For PERC, you are using weighted average method. For 5-star, you are using FIFO method. Permitted or not permitted? No! Chocolates is no one type of good. Nijanga sense pancheda meeku. Why you are checking out the company? I seriously don't understand. PERC is also a chocolate, 5-star is also a chocolate. For this one, you cannot follow FIFO method. For this one, you cannot follow weighted average method. These two are similar kind of inventory. So you have to follow only one method. What is that is your pick. నువ్వు ఏ మెథడ్ పిక్ చేసుకుంటావో నీ ఇష్టం, బట్ ఆల్ ద సిమిలర్ కైండ్స్ ఆఫ్ ఇన్వెంటరీ యూ హ్యావ్ టు ఫాలో ద సిమిలర్ మెథడ్. పక్కా ఎవ్రీబడి. సో దాట్స్ వాట్ ద పాయింట్. And net realizable value. So till now you have found what is a cost price, like a cost price to a manufacturer, cost price to a trader, cost price to a service provider, cost price of an agricultural produce. Like this you have found cost price, and finally this cost price has to be compared with NRV, and finally you have to check out whichever is lower. While checking out whichever is lower, you have to do it item by item, but not grouping. Understood, everybody? So what do you mean by grouping? See here, 40 or 28, whichever is lower. 32 or 32, 16 or 24. Total how much is there? So you are checking out individually, you got 76. But say for example, grouping in the sense, total cost 88, total NRV 84. I will value it at 84, which is wrong. Clear? Generally you should not group, you have to value item by item basis or individual basis. Understood, everybody? So now moving on to the next thing. So we are actually having finished goods. Finished goods are to be valued at cost or NRV, whichever is lower. Work in progress. Work in progress is also cost or NRV, whichever is lower. Sir, you know what is the cost of finished good, but what is the cost of work in progress, sir? Very, very simple. Cost till completion is nothing but cost of your work in progress. Generally, you will be having process 1 transfer to process 2. You will be checking out somewhere there process 1 ending material 100%, labor and overhead 50%. Gurtunda? That is nothing but your cost of work in progress. Cost till completion. Generally, you will be issuing 100% of raw material. Am I correct or wrong? So work in progress is equal to cost of raw materials consumed plus other costs till the production completes. If the production is completed to the extent of 70%, consider only 70% of the cost. Understood, everybody? And next one is all about NRV. What is the next one? Sir, what is the NRV of a work in progress? Sir, think with common sense. And can you purchase a semi-stitched product from a tailor? నో, టైలర్కి ఇచ్చేది ఫుల్గా కుట్టమని, సగం కుట్టింది నువ్వు ఎందుకు కొంటావు? నువ్వు కొంటావులే అయ్యా. ఫస్ట్ బటన్ 4 ఇప్పేసుకుని అడుగుని 2 పెట్టుకుందావు కానీ. సో కమింగ్ టు సెమీ స్టిచ్ ప్రోడక్ట్స్ ఆర్ సంథింగ్ లైక్ వర్క్ ఇన్ ప్రోగ్రెస్, జనరలీ వర్క్ ఇన్ ప్రోగ్రెస్ విల్ నాట్ బి హ్యావింగ్ ఎన్ఆర్వి. వాట్ ఇస్ ద జనరల్ రూల్? వర్క్ ఇన్ ప్రోగ్రెస్ విల్ నాట్ బి హ్యావింగ్ ఎన్ఆర్వి, పక్కా. బట్ టు ఫైండ్ ద వర్క్ ఇన్ ప్రోగ్రెస్, సార్ ఈజ్ యువర్ ఎయిమ్ టు సెల్ వర్క్ ఇన్ ప్రోగ్రెస్, టు కన్వర్ట్ వర్క్ ఇన్ ప్రోగ్రెస్ ఇంటూ ఫినిష్ గుడ్? వర్క్ ఇన్ ప్రోగ్రెస్ ఇంటూ what is NRV of a finished good, amma? NRV of a finished good, estimated selling price minus estimated selling expenses. Clear? Say for example, this is your raw material, this is the point of your finished good, but your work in progress is somewhere here. So to find NRV of your work in progress, selling price of finished good minus selling expenses of finished good, then you have got NRV of finished good. From this NRV of finished good, deduct this additional cost. Then you will be getting NRV of work in progress. Clear? NRV of work in progress is nothing but estimated selling price of finished good minus estimated selling expenses of finished good minus further processing cost. What is it? Processing cost. Understood everybody? That will become your NRV of work in progress. And finally raw material. So take care till now. Finished good, cost or NRV, whichever is lower. Work in progress, cost or NRV, whichever is lower. Cost of finished good is nothing but cost of manufacturer, cost of trader, cost of service provider. Cost of work in progress is nothing but cost of raw material plus overheads till now completion. And NRV of a finished good is nothing but estimated selling price minus estimated selling expenses. And NRV of work in progress is nothing but estimated selling price of finished good minus estimated selling expenses of finished good minus further processing cost. A minus further processing cost. That is very important. Shall I proceed further? And moving on to the next thing, that is all about raw material. Remember the rule, raw material has to be valued at cost price. Raw material has to be valued at cost price. General rule, tell me, will the selling price is lower or cost price is lower? Cost price is lower. So general rule, selling price of a finished good is greater than cost price of a finished good. Response, sir. If this general rule is applicable, raw material will be valued at cost price. If at all selling price of finished good is lower, think with common sense and tell me, if selling price is lower, are you having interest in the production? And hence raw material is to be valued at cost price is a trash. So you are about to sell your raw material or you have to replace your raw material. So raw material has to be valued at replacement cost or current cost. Raw material has to be valued at replacement cost, or it is also called as current cost. So last and final, raw material has to be valued at cost price when selling price of finished good is greater than cost price of finished good. When if selling price of finished good is less than cost price of finished good, you are not having interest in production, so you have to replace your raw material with a cheaper quality, with a cheaper price, not with a cheaper quality. And hence raw material has to be valued at replacement cost. Understood everybody? My dear children, if replacement cost is more than cost price. Understood? Sir, existing raw material cost price 10 rupees. 10 rupees పెట్టి ప్రొడ్యూస్ చేసేటప్పుడే నీ సెల్లింగ్ ప్రైస్ ఆఫ్ ఫినిష్ గుడ్ రికవర్ అవ్వట్లే. అందుకు నువ్వేమన్నావు, వాల్యుయేటెడ్ రీప్లేస్మెంట్ కాస్ట్ విచ్ ఇస్ 7 rupees. గుడ్. బట్ నౌ యువర్ రీప్లేస్మెంట్ కాస్ట్ ఇస్ 12 rupees. లాజిక్ అండర్స్టూడా? Then will you value at 12 rupees or 10 rupees? That is a point you have to understand. Normally, selling price is greater than cost price. Raw material has to be valued at cost price. If selling price of finished good is less than cost price of finished good, then raw material has to be valued at replacement cost. But if the replacement cost is higher, again at cost price. Pakka? That is what your raw material valuation. And inventory recognition as expense. This concept is newly introduced in Ind AS. There is no this concept in accounting standard number 2. What is recognition as expense? Very, very simple. Current year, whatever is closing stock is there. Next year, it will become opening stock. Will you accept or not? In the current year, you are showing it at income side, but in the next year, you are showing it at expense side. Why, sir? Because you are selling. If you are selling the goods, whatever the inventory, that you have to treat it as expense. Because to know what is the GP, selling price minus cost price. In the sense, whatever the inventory you are having, it will be recognized as an expense. Understood everybody? Now one more thing. Say for example, current year cost or NRV, whichever is lower. Cost is 100, NRV is 80. You have to evaluate it. How much is decreased? You have to write off 20. Am I correct or wrong? In which year you have to write off? Current year or next year? Cheppali. Current year. Next year endadi. Asal adigina question e toppas. But that is covered in the standard and hence I asked you. And you are thinking, current year or next year, what is happening? Ni bonda em jaragatledu akkada. Current year or next year? Current year. Say for example, you have gone to next year and you have valued inventory at which price? 80. But now your actual value of inventory had got 95. Can you increase the value or not? Yes, you can increase. How much is increasing here? 15. In which year this increase has to be considered? Current year or next year? Next year lo ochindi kabatti next year. How much good is valued? You would like to make it for 105. Can you increase or not? Yes, but it should be limited only to 100. Hope you've got my logic. Because you can increase the stock. Yes, provided only up to 100 ani kaadu. Cost price, not more than cost price. Logic clear? So recognition of expense. Current year closing stock will be treated as expense in the next year in the form of opening stock because you are about to sell that good. Even if that stock is not sold, you will be treating the same again as a closing inventory. Understood everybody? Cost for NRV, whichever is lower, you have to write it off in the current year itself. If any reversals are there, in which year you have done that reversal, you have to reverse in that year. Can you reverse? Yes, but reversal can be done only up to cost price, but not more than that. Understood? So that's recognition as an expense. Now last and final one more point. Sir, if you are selling the inventory, if you are selling the inventory, it will become your general expense and it has to be debited to trading account or P&L account. If you are using the inventory in what is it called? In one particular PPE, property, plant and equipment. Say for example, you are selling cement bags. 1000 cement bags are used for the purpose of construction of building. Understood? Is your cement bags inventory or not? Cheppali. Sold cement bags inventory portion will be debited to the trading account. But used cement bag inventory portion for PPE will be added to the cost of asset. Logic clear? Inventory will be debited if you have sold it normally. But that inventory has to be taken to PPE if you have used it for the purpose of property, plant and equipment. Understood? If you are using the inventory for intangible asset, it will be added to intangible asset. So you have to check out for what purpose inventory is used. And you just need to, if it is used for tangible asset, add to tangible asset. If inventory is used for the purpose of another production of inventory, that inventory will be considered as a cost price of inventory. Clear? Hey, is your stores and spares inventory or not? Cheppali. Now the stores and spares is exclusively utilized for the purpose of producing another inventory. Understood? If inventory used for the purpose of producing another inventory. Sir, inventory to inventory enti ani anakuddu. Raw material is an inventory, finished good is an inventory. Raw material is used for the purpose of producing finished good. So in the cost of finished good, raw material cost is included. Now you are using inventory for the purpose of producing another inventory. So cost of the used inventory will be added into the cost of produced inventory. Inventory is sold, sir. Then inventory will be taken to trading P&L account debit side, sir. If inventory is used for the purpose of fixed asset, sir, it has to be added to the fixed asset, sir. If inventory used for the purpose of intangible asset, it has to be added to the cost of intangible asset. Pakka everybody. That is the end of Ind AS number 2 inventories. Also, here there is a comparison table. మీకు కావాలి అంటే మీరు అది చదువుకోండి. బట్ ఐ ఆల్రెడీ టోల్డ్ యూ అంటే ఎక్కడెక్కడైతే వస్తుందో ఇది కొత్తది ఇది పాతది అని చెప్పేస్తా ఉన్నా. బట్ దాట్స్ నాట్ నీడెడ్. అంటే అకౌంటింగ్ స్టాండర్డ్స్ గురించి తెలిసి ఆ నాలెడ్జ్ ఉన్న వాళ్ళు ఇది చదువుకుంటారన్న ఉద్దేశంతోనే ఇచ్చాడు తప్పితే ఈజ్ అకౌంటింగ్ స్టాండర్డ్ నెంబర్ 2 అప్లికబుల్ ఫర్ దిస్ ఆర్ నాట్ అని వాడు ఇక్కడ అడగడు. ఇఫ్ యు ఆర్ హ్యావింగ్ అన్ అకౌంటింగ్ స్టాండర్డ్ ఇన్ గ్రూప్ 1 దేర్ ఇట్ విల్ బి టెస్టెడ్. If you are not having accounting standard in group AS2 in group 1, it will not be tested. But Ind AS 2 నుంచి మాత్రం అడుగుతాడు. Clear everybody? And next one is Ind AS number 10. Just within 3 to 5 minutes, we are going to start that. Fine. Listen to the next one. In days number 10, events after the reporting period. So where you're having two terminologies, post balance sheet period, after the post balance sheet period, and before the post balance sheet period. Okay. So find the terminology that you're having. Fine. So listen to the next concept. That's all about in AS number 10, events occurring after the reporting period. So you're having something like post balance sheet period, which is very, very important. What do you mean by post balance sheet period? After the balance sheet date, but before the approval of financial statements. That period we will be calling it as post balance sheet period. And after the post balance sheet period, after the post balance sheet period in the sense after the no. See, just get the difference. Post balance sheet period in the sense period between, what is that? Date of balance sheet and date of approval of financial statements. Now question is after the post balance sheet period. After the post balance sheet period in the sense after the date of approval of financial statements. Point number 1. Whatever the events that were occur after the date of approval of financial statements will not be considered at all. Clear? And problem is all about the events that were occurring after the reporting date, that is balance sheet, and between the date of approval of financial statements. So now, my dear children, you have to be careful with the first word. The first word is event but not transaction. If it is transaction, very, very simple. If, say for example, last year is 11-12 and current year is 12-13. So if a transaction is occurred in 12-13, you will be putting and posting it in 12-13 but not in 11-12. If a transaction is occurred in 11-12, you have to post that in 11-12 but not in any other year. But the problem is all about after the date of balance sheet and before the date of approval of financial statements which are relating to 11-12, there might be some events occurred which are relating to the previous year. Because of which, do you need to adjust the same in the previous year or do you need to adjust the same in the current year? Clear everybody? Hey, that you should not tell. Standard will tell the answer for that. And the total events occurred after the balance sheet date but before the date of approval, where we'll call it as post balance sheet period. So events occurred during the post balance sheet period are divided into two types. Number 1, adjusting event. Number 2, non-adjusting event. Adjusting event in the sense 3 conditions should satisfy. Condition number 1, I mean 3 conditions are there. Condition number 1, there should be a situation or condition existing on the balance sheet date. There should be a situation or the condition existing on a balance sheet date, and you should have some additional evidence confirming the doubt or situation or the condition, and of course it must be material. If these 3 conditions are satisfied, we will be calling it as an adjusting event. If any of these 3 conditions are not satisfied, we will be calling it as non-adjusting event. So let me give you an example. Say for example, in February 2011, we have done a sale. Getting my point, everybody? So let me take the same example. Yes. For this period, that is before the balance sheet date, you have done a sale. Clear everybody? And debtors premises was caught by fire. Debtor's premises was caught by fire. So as at the year ending, you are having a doubt on the debtor. There is a condition that debtor may not repay. There is a situation that the debtor may not repay. Clear, everybody? Now, this is point number 1. Point number 2. During this period, clear, everybody? In between this period, this debtor, whoever is there, he has declared insolvency. He has declared insolvency. In the sense, is the debtor good or bad? So can you treat him as bad debt or not? Now this bad debt has to be recorded in which year? 11-12, 12-13. 11-12, 12-13. That should be recorded in 12-13. Because it is a transaction, not an event. You just get the point. That is the reason. First I told you, event, not transaction. He has declared insolvency, because of which we have got a bad debt. Bad debt is a transaction, not an event. Pakka, everybody. But if you observe carefully, there is a condition that is existing on the balance sheet debt. And also you are having additional evidence. Since the debtor is insolvent, your doubt, whatever is there on that condition, has confirmed. So you have to create a provision in the previous year. You have to create a provision in the previous year. Understood, everybody? So will it become an adjusting event or non-adjusting event? Adjusting. Because condition is there and evidence is also there, and of course it is material, and hence it will become an adjusting event. Pakka, everybody? And say for example, our debtor has declared insolvency after this period. Answer, non-adjusting. Why it is non-adjusting? There is no additional evidence. Yeah, you have to speak from the standard language. There is no additional evidence. Understood, everybody? Say for example, you have done the you have done sale to the debtor, and very, very important, listen carefully. During this period itself, debtor's premises was caught by fire, and during that period itself, he had declared insolvency. Adjusting or non-adjusting? Why non-adjusting? There is no condition existing on the balance sheet date. Pakka, everybody? So you need all the 3 conditions. What is condition number 1? Condition or situation existing on the balance sheet date. Number 2, additional evidence should be there. Number 3, finally it must be material. Pakka, everybody? So we'll be asking you some of the situations. You tell me whether will it become an adjusting event or a non-adjusting event. Shall I start now? Negotiations are happening to purchase a building at ₹1 crore at the year end. Clear, everybody? And during the post balance sheet period itself, the negotiations were concluded to purchase the same building at ₹1.2 crore. Em cheppana ardhamainda? Negotiations were happening. They were just bargaining. I'll purchase at this price. They are telling one price, something like that. 1 crore ki konukkuntam. And some negotiations are happening, not yet finalized. But ultimately in post balance sheet period, it was finalized and they are finally purchasing it at 1.2 crores. Understood, everybody? Answer, is it adjusting or non-adjusting? Adjusting or non-adjusting? This is non-adjusting. Clear, everybody? Why this is non-adjusting? Because there is no condition. Hey, where is the condition there? You cannot tell that negotiation is a condition. Understood? Negotiations are something like discussions. I'll purchase or I may not purchase. So that will not become a condition at all. Clear, everybody? Hey, get the difference. Please take care. Debtor's premises was caught by fire. No, wait. I am okay. Debtor's premises was caught by fire. Since the debtor's premises was caught by fire, because of that situation, he has declared insolvency. Clear? Because of that situation of fire accident, he has declared insolvency. Here, I am bargaining at 1 crore basing on that day situation. In future, I have concluded at 1.2 crores basing on future situation. Hope you have got the logic. These two are not linked. On that day condition is different, on this day condition is different. But you would like to have a condition, and because of that condition, you need an effect. And a direct relation undali. On that day conditions are different, on this day conditions are different. On that day I thought like that building is normal building and they will anyway accept for 1 crore. But today I have realized the value of the building where other parties are ready to pay 1.1 crore. So I would like to pay additional another 1 crore and I would like to purchase it at 1.2 crore. Understood? Now tell me, is it a condition? No, this is not a point related to that condition, and hence this cannot be considered as an adjusting event. Understood, everybody? Market price at the year end is 130. During the post balance sheet period, market price had come to 140, or say for example 120. Now accountant is telling, as at the year ending, I thought that the market will fluctuate. This is the condition existing on the balance sheet date. And his view is correct, and automatically there is an additional evidence that price had dropped to 120. So he is telling that as per prudence concept, I need to value it at 120, and hence for 10 rupees I will create a provision, and he will be treating it as an adjusting event. Is the logic clear? Pakka? Now answer me. Is he correct or wrong? Answer. Wrong. Because again same. Market conditions on that day is different. Market condition on this day is different. Market conditions are not same on each and every day. My dear children, not same on each and every minute also. Sir, hope you know the concept of Yes Bank. Morning the price is 273. But one scam had come out where the price dropped to 3 rupees. Around 200 or 600 on the price 3 rupees ki padindi. 7 rupees ki perigindi malla. On the same day. In the sense, hope you have got that, like market conditions are very, very fragile. How he can tell, I thought that the market will fluctuate. Nee bonda nuve and yevadana chevutaru. Chinna pilla nadina chevutaru. Market will fluctuate ani. Sir, am I correct or wrong, sir? So accountant cannot plead, my condition is correct. No. Trash. Market conditions cannot be considered as condition, because market conditions will always fluctuate. Understood, everybody? Hey, now listen very, very carefully, everybody. Again, the same thing. Likewise, company A is negotiating with company B for acquisition, for investing at the rate 60%. Investing at the rate 60%. And it was finalized only in post balance sheet period. Adjusting and non-adjusting. Answer. Non-adjusting. This is purely similar to the first example that I told you. Clear? Non-adjusting. Hey, now listen very, very carefully, everybody. Sir, there is a building. Company had already negotiated. Yes, company had already negotiated to purchase it at 1 crore. Possession is transferred. But legal formalities are pending. In post balance sheet period that the building was registered. Clear? Now tell me, adjusting or non-adjusting? Sure? Yes, it is sure. This is adjusting only. Understood, everybody? Hope meeku ikkada concept ardhamaindi anukuntunna. Basing on the condition that is existing on the balance sheet date. What is the condition that is existing on the balance sheet date? Building keys are in my hand. Possession was transferred. Legal formalities were pending. Those were done in the later point of time. That's quite common. Agreement loki enter అయిపోయి ముందు రోజే మనం ఇంట్లోకి వెళ్ళిపోయి తర్వాత రోజు రిజిస్టర్ అవ్వడం. నీకు బాగా అలవాటు. So you will be treating it as an adjusting event for sure. Clear, everybody? Hey, but market conditions are not same on every day. General negotiations are not same on every day. But negotiations concluded here, and hence it can be considered. Pakka? Okay, so that is a concept of your adjusting and non-adjusting event. Sir, answer. Adjusting events will be adjusted in the previous year financial statements. Adjusted events will be adjusted in the previous year financial statements. Non-adjusted events will be adjusted or non-adjusted? Not adjusted. Non-adjusting events will not be adjusted, but they have to be disclosed in notes to accounts. They have to disclose in AS4 is telling that they have to be disclosed in board of directors report. AS4 is telling that this is not a part of financial statements, but Ind AS number 10 is very sure that this is a part of financial statements. Non-adjusting have to be disclosed in notes to accounts or board of directors report. Notes to accounts. Pakka, everybody? Hey, my straight question. Do non-adjusting event has to be adjusted? Not to be adjusted? Not to be adjusted. But exception. Even non-adjusting event has to be adjusted. When, sir? When going concern effects. When going concern effects. So if going concern is not there, you have to prepare the books of accounts on cash basis. I'll tell you two things, remember, okay? When going concern is there, There, in the sense regular. You have to follow accrual basis and you have to follow cost concept. If going concern is not there, you have to follow cash basis and you have to follow realizable basis. Clear? So now listen very carefully, everybody. Sir, as on 31/3/2011, our business is good. Clear? And during the post balance sheet period, there was a severe earthquake, due to which our business got destroyed. Now answer, adjusting or non-adjusting? Answer, this is a non-adjusting event. Why this is a non-adjusting event, sir? Sir, earthquake occurred because of future conditions, sir. ఈ రోజు ఎర్త్ బాగోకపోతే ఈ రోజే క్వేక్ వచ్చేద్ది. My point is all about, if at all the position of 31/3/2011 is not good, then the earthquake would have occurred on that same date. So on the basis of that day's condition, in the future earthquake, no, that is trash. Understood? So earthquake is something like without any condition you will be getting on one day, so it will automatically become a non-adjusting event. But you have to check the quantum of your loss. Are you having any insurance? Yes, sir. Can you able to recover? Yes, sir. Then it will become a non-adjusting event. Because your going concern did not affect kada. Are you having any insurance? No, sir. But can you recover? Yes, I can. Going concern affected or did not affect? Did not affect. So non-adjusting. Sir, I'm hands up. I mean to tell, I can't reinstate my business. I can't run my business. I'm just closing. So is the going concern there or not? Is the going concern affected or not? And hence, even though it is a non-adjusting event, it has to be adjusted. Even though it is a non-adjusting event, it has to be adjusted. Understood, everybody? Though that is the concept. So you're having only going concern. You are not having the concept of waiver of a breach. Maybe that is there in CA final. And also in CMA final for sure. Because in days you're having there. Anyways, my dear children, that is the end of your Ind AS number 10. So in Ind AS number 10, take care. First thing, post balance sheet period, and you have to check out whether is it an adjusting event or a non-adjusting event. Adjusting event will be adjusted in the financial statements. Non-adjusting event will never be adjusted in the financial statement, but it has to be disclosed in the financial statements. An exception, likewise non-adjusting events has to be adjusted if going concern affects. Clear, everybody? That is the end of your Ind AS number 10. Anyways, I'll give 2 to 3 minutes break. And moving on to the next standard, that is Ind AS number 33. That is earnings per share. So అయిపోయింది ఇంకా, come on. Next is all about Ind AS number 33, earnings per share. Very, very simple. Nothing great at all. But just give me 1 minute. You're having... That computation is actually a bit typical. Are you sure at TPS first? అంటే computations గుర్తున్నాయా? Diluted, adjusted, restated, whatever. Fine. Now, earnings per share is nothing but earnings available to equity shareholders whole divided by WANES, weighted average number of equity shares. Now the point here is all about earnings available to equity shares. You have to compute earnings as by following Ind AS number 1. Like presentation of financial statements, you have to follow that one and you have to present the financial statements, and you finally have to find the net profit as per the respective standards. And after that, you will be just going with WANES. WANES is nothing but weighted average number of equity shares. To tell you in the simplest words, say for example, your profit before tax is 1 lakh, pay the tax of 20,000 and you will be having an amount of 80,000. Clear everybody? Which is earnings after tax minus preference dividend is equal to earnings available to equity shares. So now I have a question for you. Say for example 80,000 is your earnings after tax. Clear? Preference dividend is equal to 20,000. Transfer to debenture redemption reserve is 10,000 and transfer to general reserve is equal to 5,000. Clear? Now the question, is the earnings available to equity share 80,000 minus preference dividend is not available to preference shareholders, so will it become 60,000, or will it become, even after transferring of this 15,000, that is like 60 minus 15,000, 45,000? Or since DRR don't consider, since general reserve is available to equity shareholders, consider this one. Since this one is not available, you can deduct this one. 80 minus 30, how much it comes to? 50. Now tell me what is correct. Various alternatives ardhamayaya, like debenture redemption reserve is for the purpose of debentures, so not available to equity shareholders. Clear? Since it is not available to equity shareholders, they are deducting that one also. So 80,000 minus 20,000 is preference dividend for preference holders, minus 10,000 is for the redemption of debentures, so minus 10,000, 50. Leda 80 minus 20, directly 60, or 80 minus all the reserves are deducted, 45. Now I am asking, among these three things what is correct? 60 is correct. As simple as such. Forget about all the appropriations. You have to remember only one thing. Earnings after tax minus preference dividend is equal to earnings available to equity shareholders. Pakka everybody? There ends with the numerator, but you are having lots and lots of discussion with weighted average number of equity shares. Shall I start now? Say for example, you are having 1 lakh equity shares at the beginning of the period. That is on 1/4. Say for example, you have issued 20,000 equity shares on 30th September and you have buyback 5,000 equity shares on 1st January. Of course, your year ending is nothing but 31st March. Okay, so tell me the WANES. So for computation of weighted average number of equity shares, you just need to compute it with weighted average time weighing factor. Need to multiply it with time weighing factor. What is time weighing factor? So these 1 lakh shares are there for the whole year. Am I correct or wrong? So multiplied by 12 by 12. These shares were there only for 6 months. So multiplied by 6 by 12. These are only for 3 months. So multiplied by 3 by 12. Issue, in the sense number of shares were increased. Buyback, in the sense number of shares were decreased. So 1 lakh into 12 by 12 plus 20,000 into 6 by 12 minus 5,000 into 3 by 12. How much ever you got, that you will be calling it as WANES. Understood everybody? Now Special situation, listen very, very carefully. Say for example, you are having equity shares, 1 lakh equity shares at the rate rupees 10. And you are having 50,000 equity shares at the rate rupees 5. Clear everybody? And your total earnings available to equity shareholders are 10 lakhs. Tell me EPS. Hey, you have to hold your calculator and tell the answer fast. EPS anta meer chesede untadi. Meer chepte nenu answer cheppesta ante. You have to make it fast because I would like to try to cover even electricity and Esops also. I'll try if you cooperate. Fine, listen. Earnings available to equity shareholders is 10 lakhs. Whole divided by entamo? 8. Let me check out. So how many shares I'm having? 1 lakh at the rate 10. How many shares I'm having? But this is only 5. So I cannot take 1,50,000 directly, which will become wrong. So you have to convert. How I have to convert? Generally, it is better to convert into larger number of shares. It is better to convert into. So 50,000 multiplied by 5. Total how much it becomes? 2,50,000 divided by 10, which comes to 25,000. So can I tell something like this? 50,000 at the rate rupees 5 is equal to 25,000 at the rate rupees 10. So I'll tell that 25,000 shares are there. So 25,000 plus 1 lakh, which comes to 1,25,000, which comes to an amount of 8 rupees. Pakka. Hey, this 8 rupees is EPS for 10 rupees share. For 5 rupees share, how much? 4. Exactly half kada. Understood? Pakka. Now check out. Very, very important example and last example. Say for example, on 1/4/2011, you are having 1 lakh equity shares at the rate rupees 10 each, and somewhere on 30, no, let me take 1/1/2012, you have issued something like 50,000 equity shares at the rate rupees 10 each, but only rupees 8 paid up. Earnings available to equity shareholders is equal to 6 lakhs. Tell me EPS. No need to tell me the conversions, like for 8 rupees, how much, for 10 rupees. You tell me the final EPS, that's enough. So 1 lakh equity shares multiplied by 12 by 12. For sure. Issue 5 point. Okay. Issue in the sense, obviously you have to add. But how much is paid up? I already told you to convert into larger value of the share. So 50,000 multiplied by 8 by 10. You'll get 40,000 multiplied by only 3 months are there. 3 by 12. Clear everybody? So which comes to 40,000 into 3 by 12. 10,000. Sir, hope you have understood why I have multiplied it by 3 by 12. Because time weighing factor has to be considered. So finally 1 lakh plus 10,000. So 6 lakhs divided by 1 lakh 10,000. 5 point. Now very, very important. This 5.45 is for 10 rupees equity share. But for 8 rupees equity share, how much? Cross multiplication. 8 into 5.45 divided by 10. 4.36. Not yet over. This 4.36 for entire 12 months. Correct or wrong? So for 3 months, how much? 1.09. That's the end of your basic portion of EPS. Pakka. So now, let me go with some details which are here. Understood? Just cross multiplication. Okay. So now very, very important. If at all you are issuing a share for cash, If at all you are issuing a share for cash, you need to consider the date of which cash is receivable, not the actual date of receipt. So what are you telling? Weighted average factor, time weighing factor. Sir, say for example, I have issued 1 lakh equity shares at the rate rupees 10. Clear everybody? 1 lakh equity shares at the rate rupees 10 issued. Today is the date, say for example 39 is the date where the shareholders have to pay me, but they are actually paying on 1510. So for time weighing factor, do I need to consider 39 or 1510? Did you understand with the problem? Of course you have to consider 39 only. For that some of the situations were given here. If you are about to issue the shares for cash, then date on which cash is receivable, not the actual date of receipt. And if at all it is conversion, the date of conversion you have to consider. And if at all the shares are issued for mandatory conversion, date of contract you have to consider. General conversion, date of conversion. Mandatory conversion, date of contract. And this is okay. And for settlement of a liability, say for example you are having a loan. Instead of paying cash, you have issued shares. Which date has to be considered, sir? Date on settlement. And the next one, something like, what is this called? Acquisition. Ordinary shares are issued in consideration of acquisition of assets. You have got an asset, you are issuing shares. Date of that acquisition of the assets. And next, services rendered. Date on which services are rendered. So you have somebody had rendered you some services. To that person you have to give some cash. Instead of cash you are giving shares. What date has to be considered? And you have to consider the service rendered date. Clear? Hey, these things you are going to get in bits. You are not going to get a problem, or you are not going to question this one. You are going to get for these things in bits. So take care. And next one, if it is a partly paid up, then you have to convert into total face valued share. Clear? Now rights issue, you are going to discuss that one. And equity shares are issued for common control business combination. Common control business combination is nothing but amalgamation in the nature of merger. So this is actually advanced. I am not going to consider these things. Strictly speaking, this one, sir, just listen. If there is common control business combination, write from the beginning, from the period. If it is acquisition, then write the original date of purchase or date of acquisition. Understood? If acquisition, you have seen date of acquisition. If common control business combination, date at the beginning of the period. Bonus, share split, all these things we are going to deal. These things we are going to deal, and these are not at all necessary for you. And this is just purchase, the date of purchase. Contingently issuable shares and contingently refundable shares are not at all necessary for you. Contingently issuable shares in the sense, you may issue the shares or you may not issue the shares. There is a condition. If the condition is fulfilled, you will issue the shares. If the condition is not fulfilled, you will not issue the shares. Contingently refundable shares. If at all we have found a condition or they have satisfied a condition, then the shares must be refundable. Otherwise, the shares will continue with him. Understood? Say for example, something like we have issued equity shares to one company. Okay. We have issued equity shares specifically to one company as it would like to be a shareholder in our company. But we have clearly told you have to maintain a debt equity ratio of 2:1. If you did not maintain, we will take back the shares. Contingently refundable shares. Understood? It's actually an advanced concept, so I'm not dealing with the same. You may get a bit in this, so be careful. Something like if at all shares are issued for cash, date when cash is receivable, upon conversion, date of conversion, mandatory conversion, that is like compulsory conversion. Then you have to consider date of contract, and settlement of a liability, date of settlement. And this one is also important. Interest or principal against a financial instrument, date when interest ceases to accrue. Ceases to accrue in the sense the date is completed. So from that date interest will not accrue. Shares have to be issued. Understood? Say for example due date is 39. You have to pay on 39, but you are not repaying on 39. You have to issue shares on that day. So from that date you have to consider the shares were issued even though those were not issued. Even though you are issuing at a later point of time, that is not considered. You have to consider the date when the interest ceases to accrue, that is the due date 39. Understood? And next one, for acquisition of assets, date of acquisition of assets, shares are issued for rendering of services, date of rendering the services. If it is partly paid up share, convert it into fully paid up or face value. Rights issue we will consider now. Common control business combination right from the beginning of the period. Date of acquisition, you have to consider the date of acquisition. Understood? That's the concept. And next you need to continue with bonus issue, rights issue, and then you have to go with diluted EPS. Just wait. My bonus issue, very simple. Bonus issue reporting period you have to consider right from the beginning of the previous period. Right from the beginning of the previous period, not the current period, okay? So what is the meaning of that one? Say for example, I'm speaking about bonus issue, listen carefully. Say for example, you are having 1 lakh equity shares at the rate rupees 10 each at the beginning of the period. Hey, if you did not listen this one, idi kuda potundi. 1 lakh equity shares at the rate rupees 10 each at the beginning of the period. Clear with point number 1? Now, company had issued 1:1 shares. Or let me take 1:2. What is the meaning of 1:2? For every 2 shares, 1 is the bonus. So how many bonus shares it had issued? 50,000 equity shares at the rate rupees 10 each. This is bonus issue. Understood everybody? The issue date is something like 110. If it is normally 110, you will be doing 50,000 into time weighing factor 6/12. Understood? 1 lakh into 12/12. 50,000 into 110 to 31/3. You will be getting 6 months. So 6/12. Simply to tell you time weighing factor. But now since this is bonus issue, what happened because of bonus issue? Only shares increased, resources also increased. Cheppali fast ga. Only shares increased, resources are not increased. So you have to consider this bonus shares as if they were in the previous year also. Not only in the current year, but also there in the previous year. So it will be something like this. Say for example, last year earnings available to equity shareholders is 10 lakhs and current year earnings available to equity shareholders is 10 lakhs. Clear? Sir, strictly speaking, last year EPS will become 10 lakhs divided by, sir, last year you are having only 1 lakh, so it will become 1 lakh, which will become 10 rupees. Current year EPS, 10 lakh divided by, you are having 1 lakh 50,000. Say if it is 1 lakh 50,000, I told you bonus. Consider from the beginning of the period, not at the specific date. So 10 lakhs divided by 1.5 lakh, which comes to 6.67. Last year 10 is correct. Current year 6.67 is correct. But generally in current year, we will present current year and also previous year. Correct or wrong? So how the EPS will be? 10 rupees in the last year, 6.67 in the current year. It is showing that the earnings of the shareholder is decreased. But really you think with common sense, last year resources is equal to current year resources. But yes, last year resources is equal to current year resources. But shares are increased. And last year size ento, year size kuda ante. But since because of number of shares are increasing, my EPS is draining. So this may impact negatively in a shareholders. So consider bonus issue as if it was issued at the beginning of not just the current year, right from the previous year. So here you have to restate the previous EPS something like 10 lakhs divided by 1.5 lakh where it will become 6.67. Logic clear? Pakka everybody. Not just beginning of the current year, but right from the beginning of the, which is called as restated EPS. What is it called as? In the sense previous year, really the previous EPS is same. How much is previous year EPS? That will be 10 only. You cannot change that financial statements. But in the current year, you are restating the previous year from 10 to 6.67. Understood everybody? The same concept is applicable even for share split. Share split in the sense one share is divided into multiple number of shares. Resource is same, but number of shares are increasing. Even reverse share split, that is consolidation, which is nothing but 10 shares are combined into one share. Clear? So all these things will be applicable for restated EPS. Understood everybody? Sir, ఇప్పుడు కొంచెం జాగ్రత్తగా వినండి rights issue. I am going to deal a problem also, and this is very important for your examination point of view. Say for example, there are 100 equity shares at the rate rupees 120. Company had issued 1:2 rights issue at a price of rupees 90. Understood everybody? Pakka till this? Okay. So check out very carefully. Even for rights issue, you have to find the bonus element in the rights issue. So rights issue done at market price, discounted market price. In the sense, can I tell something like rights issue partly given for cash and partly free? Chappacha. So now we need to find how much is the partly free portion. For that you need to compute bonus factor. For that you need to compute, or it is also called as rights factor. So let us compute that one. But before doing that one, first of all you need to compute theoretical exercise price. Hope you have remembered the concept of theoretical exercise price. Morning rights issue I told you, just average price. Original shares multiplied by cum rights price plus right shares into right price divided by original shares plus right shares. So take an average price. 1:2 in the sense how many shares will come? 50. So 100 into 120 plus 50 into 90 divided by 100 plus 50. 110. The same morning example. So shall I proceed further? Pakka. Hey, now listen very, very carefully. I am going to find the bonus factor. What I am going to find? Bonus factor is nothing but cum rights price divided by theoretical exercise price. Just wait. Theoretical exercise price. Here one problem on rights issue is given. Rights factor or bonus factor. Fair value prior to rights issue divided by theoretical exercise price, which is nothing but cum rights price divided by X rights price. Hey, did you remember the concept of value of a right? Value of a right is equal to dash minus dash. Cum right price minus, this is nothing but cum right price divided by X rights price. Understood? Which is called as a factor. So as per our example, how much is cum rights price? 120. How much is X rights price? 110. So 120 divided by 110. 1.09 exactly. Okay, then you can take 1.09. Just take 2 digits. Shall I proceed further? Hey, listen very, 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 very carefully. I'm making this into 2 parts. I don't know how you have learned the rights issue, but this is the easiest way. Just listen very, very carefully. I'm making it into 2 parts. Part 1, 0.09. Okay. Multiplied by original number of shares. How many are the original number of shares? 100. How much you have got? 9. Balancing figure. Total rights issue were 50. Correct or wrong? Out of 50, 9 is bonus. Balance how much? 41. This is issued at a full consideration. And date. Say for example, rights issue was done on 1/1/2012. So now you have to consider that these 41 shares are issued on 1/1/2012 and these 9 are nothing but bonus shares. So consider these shares issued as if it were issued at the beginning of the previous period. Clear? What you have to do, total 50 shares. Out of 50 shares, separate 9 shares bonus. Right from the beginning of the previous period. Balance how much is there? 41. Treat those were issued as full consideration. You have to consider time weighing factor. Pakka. Sorry. Now, first step, what you have done? You have found dash. Hey, participate abba. What is the first step you have to do? Theoretical X rights price. Theoretical X rights price is equal to original shares multiplied by cum rights price plus right shares multiplied by rights price divided by original shares plus rights price. Then you have to find rights factor or bonus factor, which is nothing but cum rights price divided by X rights price. Cum right price is nothing but fair value. Clear everybody? And after that you will get pakka, you will get 1.0 something. Sir, మరి అలా రాకపోతే ఏం చేయాలి? నువ్వు రివర్స్ లో చేసావు, రివర్స్ లో చేసాయి. I mean to tell, if you have taken 110 by 120, you will get 0 point something. That is wrong. So don't take this one. Reverse it. 120 by 110. Pakka you have to get 1.0 something. 0.0 something multiplied by original shares. This will become bonus. And whatever the balancing figure, total right shares minus bonus shares is equal to shares issued with time weighing factor or full consideration. Pakka. Quickly answer for this one. So I'll just mark the things. 5 lakhs shares. 1:4 is the right shares. 25 is immediately prior to rights. What is mean by prior to right? Rights mundu price 25 undanta. What is the meaning of that? Cum rights price. Clear everybody? This is rights price. Just tell me the rights factor. So to tell you, 5 lakh at the rate 25 మీరు తర్వాత అనలైజ్ చేయండి. నేను ఏంటంటే కావాలో స్క్రీన్ మీద పెట్టేస్తున్నా. 5 lakhs at the rate 25 and 1:4 in the sense 5 lakhs into 1/4. 1,25,000 at the rate 20. Clear? These are the requirements. ఇప్పుడు నాకు కావాల్సింది ఆన్సర్. How many bonus shares? How many shares for full consideration? I need this one. 4 minutes time. Fine. So check out. ఎక్కడ తప్పు చేసావో నాకు తెలియాలి కదా అంటున్నాను. ఆ మిస్టేక్ నీకు కూడా తెలియాలి. సరే ఇప్పుడు అవుతుంది కదా చూడు. 5 lakhs multiplied by 25 plus 1,25,000 multiplied by 20 whole divided by 6,25,000. How much is theoretical X rights price? 24. And what is the fair value originally given? 25. So bonus factor or rights factor is equal to 25 divided by 24, where you will get 1.04. You can confine it 0.4. Clear everybody? How many of you have got this one? Okay. And now separate this 1.04 into two parts. 0.04 multiplied by original shares. How many are the original shares? 5 lakhs, which comes to 20,000. Balancing figure. Total right shares are 1,25,000 minus 20,000 is equal to 1,05,000. Understood? First cheste ostunda nu nijanga cheyaledu. Shall I proceed further? Okay. So ippudu em cheyali sir? Sir, this 20,000 has to be considered right from the previous period multiplied by 12 by 12. Current year multiplied by 12 by 12. Even previous year also multiplied by 12 by 12. This one will not be considered in current year, previous year at all. Will have to be considered only in the current year with the date of issue. And the date of issue is nothing given, so you can directly take 12 by 12. But if the date of issue is given, then you have to consider that date. Perfect, everybody? That's the concept of your rights issue. And next one, diluted EPS. Diluted EPS is nothing but, sir, there are two concepts: potential equity shares, future equity shares. So you have to prepare the mindsets of the equity shareholders that, hey, you all equity shareholders, get ready. In future, you are going to get some more equity shares holders and they will be joining along with you. But our resources will not increase. So your earnings will decrease. You logic understood? You have issued convertible debentures. In future, these debentures will be converted into equity shares. And whenever these debentures were converted into equity shares, number of equity shares are increasing, but resources are not increasing. So you have to warn all the existing shareholders that, hey, you all existing shareholders, get ready. In future, some more additional equity shares will come and no resources will increase. So automatically there will be a drop down in your EPS, which is called as diluted EPS. Anti-dilution is nothing but reverse. Because of the shares are converted, because of the debentures are converted into equity shares, EPS is increasing. Such a kind of thing is no need to consider. Anti-dilution is not to be reported. You have to report only diluted EPS. Shall I proceed now? So diluted EPS, you will be having three things. Diluted EPS for options, diluted EPS for debentures, and diluted EPS for preference shares. Sir, normally how to compute EPS? Earnings available to equity shares divided by veins. Now what happens, earnings available to equity shares plus potential equity shares. Clear? Divided by veins plus potential equity shares of veins. Earnings available to equity shares plus debenture holders converted into equity shares divided by normal veins plus this one. I'll just make it a change. Just check out. I'll give you the final answers. Reasons avanni kuda meer tarvata chuskondi. Final answer for options is EAES divided by veins plus additional number of shares. What is that? I'll write here. And next, coming to this one, EAES plus interest after tax. Plus interest after tax. My dear children, if debentures are converted into equity, do you need to pay interest or not? In the sense, your earnings will increase to the extent of interest. If your earnings are increasing, you have to pay the tax kada. So to that extent, it is decreasing. Logic understood? If debentures are converted into equity shares, no need to pay. To that extent, your earnings are increasing. But you are considering it after tax. After tax in the sense, you have to pay the tax, so your earnings will decrease. So interest after tax. You can also take interest into 1 minus t. Clear everybody? And whole divided by veins plus conversion number. And next one for preference shares. EAES plus preference dividend. My dear children, what is EAES is equal to dash minus dash? Earnings after tax minus preference dividend. But when these preference shareholders are converted into equity shareholders, no need to pay preference dividend. To that extent, your earnings will increase. So EAES plus preference dividend whole divided by normal veins plus conversion number. You have to check out that conversion number. I cannot tell you. Say for example, given in the question like 1 lakh preference shares are there, and these 1 lakh preference shares are converted into 10 equity shares. 1 lakh preference shares, each and every preference share is converted into 10 equity shares. So how many equity shares are there? 10 lakhs. So along with this normal veins, you have to write plus 10 lakhs. Logic clear? If given that 1 lakh preference shares are there and 2 preference shares are converted into 1 equity share, in the sense how many will increase? 50,000. So then you will be writing 50,000. Understood everybody? So like that conversion number, in the sense basing on the question, you just need to find it out. And what is this one? This is very important. Additional number. Sir, I'll just ask you one thing. Listen very, very carefully. Amma, options in the sense issued at a discounted price. Options in the sense issued at a, say for example, 1 lakh options, market price is 75. We are issuing it at 60. What is market price? You are issuing it. Sir, 60 rupees resource you are getting. If resource you are getting, you can do the business. But I need to consider that element for which resource I am not getting. Hey, am I correct or wrong? Bonus issue nunchi ide kada maatladutundi. Bonus issue, rights issue, share split, reverse share split, resources are not increased, but number of shares are increased or decreased. For that you have to compute adjusted or restated EPS. Then diluted EPS for future. In future, your debentures or your instruments are converted into equity shares without the change in resources. How much is the market price? But how much is the resource you are getting? You need to consider resource you are getting or not getting. Not getting. How much resource you are not getting? So 1 lakh multiplied by 15 divided by 75. 20. Now I need to consider only 20,000 as additional number. Sir, how, sir? I'll give you another style. Just listen. Everybody. Sir, can I tell something like this? 1 lakh multiplied by 60 divided by 75 is equal to how much? Tell me. Entama? 80,000. So can I tell, sir, 1 lakh issued at the rate 60 anna, 80,000 issued at the rate 75 anna, same. Chappali. So I want those shares which are issued for free kada. So how many shares are issued for free annattu? 80,000 at 75 annattu. Ante kada. So now how many shares are issued at free antunna? 20,000. Logic understood Sir, originally 75 sir. Issued at 60 sir. How many shares issued sir? 1 lakh issued at 60. So I would like to consider at original price how many are issued. So I am telling that 1 lakh at 60 anna, 80,000 at 75 anna okate. Due to which I am considering that I am issuing 1 lakh, but I am telling that 80,000 are issued at 75. So I can tell that 20,000 are issued at free. Clear? So now in additional number I need to consider free total. Free portion. So for that free portion I am telling you the answer directly. Number of options multiplied by fair value minus issue price divided by fair value. Ante 75 minus 60 divided by 75. Check out 1 lakh into 75 minus 60 divided by 75. You will get a direct answer 20,000. Understood? That is what options point. And if you have done this one, you will get 1 EPS. Hey, getting my point? Earnings available to equity shares divided by variance plus additional number. Earnings available to equity shares plus interest after tax. Say for example, interest is 12,000 and tax rate is 30%. Clear? How much interest after tax you need to consider? Yes, 12,000 minus 30%. You will be directly getting 8,400. So that must be added. Clear everybody? Divided by variance plus conversion number. And after doing this one, you are going to get diluted EPS. I'm very sure. Just hold these things. Hold these things and you can just go through a one solution. You'll understand it very easily. Pakka everybody. And that is the end of your Ind AS number 33. Okay. So just we are having Ind AS number 37. Sir, now tell me quickly what you want me to cover. You want me to cover Ind AS number 37, Esops and electricity companies. What is your choice? How many of you want Esops? How many electricity company? How many Ind AS 37? Majority of you want sorry, I'll do one thing. I'll try to cover Ind AS and Esops. I may take 5 or 10 minutes extra. Clear? And I will not cover electricity companies then. And in the meanwhile, everyone bore kodte, you can just drop away. Because I'll try to cover the total just within a span of 20 minutes or 15 minutes. But koncham late aite avvachu. Daniki prepared ga undandi. Now, let me start with Ind AS number 37, which is very, very easy. Just if you have got the definition, the things are over. So, first of all, provision. Sir, what is a provision? Provision is a liability. Provision is a liability with uncertain timing and uncertain amount. Liability, generally, you are having certain amount. Creditor is a liability. How much you have to pay? You know that one. But provision is a liability, but the amount is uncertain. But the timing is uncertain. Likewise, say for example, you have taken a loan. After 5 years, you have to repay. After 10 years, you have to repay. You have to repay to the creditors after 3 months. Timing is certain. Amount is certain. But provision, of course, it's a liability, but the timing and amount is uncertain. So what do you mean by a liability? Liability, please be very, very careful. Obligation, first of all. What do you mean by obligation? Sir, obligation is something where the business concerned should take the responsibility for repayment of an element in the financial statements. Clear? Sir, is the business obliged to pay the creditor or not? Yes. But frankly speaking, is it required by any law to repay the creditor? No, law em cheppadu. Will you generally have a contract? Supplier ki business ki contract untunda? No. But even though he will repay, because to maintain good relations. So obligation is something, either you are having law, either you are having contract, or either you are having a legislation. Not only these three things, this is something like a legal obligation. And next you are having constructive obligation. Constructive obligation is something like, what is it called? Just to maintain some good relations. Understood everybody? To maintain some good relations, to do a business in future, to maintain some future economic benefits, you have to repay that one. So obligation can be of either legal or constructive. Legal in the sense you are having a contract, law, legislation, etc. Constructive in the sense no specific implicit is there, but you are paying in order to maintain some good relations. Okay, everybody? And now this is what called as an obligation. This is what called as an obligation. If that obligation is as of now present, then it will become a liability. If that obligation arises in future, it will not become your liability. Clear everybody? Sir, say for example, yes, just listen very, very carefully and answer me. You are having a machinery. You have purchased. The life of the machinery is 10 years. What is the life of the machinery? In the 5th year, you are thinking in the 1st year that I may need to make some repairs, and you are creating provision for repairs and renewals. Purchase in the 1st year, life is 10 years. At now you are thinking that after 5th year I may need to put some repairs to my machinery, and hence I have created provision for repairs and renewals. Answer. Can I create a provision or not? Is it a present obligation or not? No, it is a future obligation. Because you are in year 1, you are thinking in the 5th year repairs will come. And for that purpose you are creating a provision right now. Yeah, I am not telling that you should not create a provision. That is your choice. But as per Ind AS number 37, it is not a provision. Because liability is a present obligation, provision is a liability, provision must be a present obligation. But here provision for repairs and renewal is not a present obligation, it is a future obligation. Pakka. Now I'm just modifying the definition. It is required by law. It is required by law to put the repairs in the 5th year. And hence company is creating provision for repairs and renewals. Now answer me, is it present obligation or future obligation? Present obligation, because obligation is something which can be repaid either by a legal obligation or a constructive obligation. Pakka everybody? I'm modifying it a bit now. So you are at the end of year 1. Clear everybody? Already machine got repaired. So you would like to put the repairs in the next year, for which you are creating a provision for repairs and renewals. Present obligation or future obligation? Present, because already year 1 completed, you have used the machine, already there is a repair for the machine, and hence you have to put the repair for the machine. You are obliged to put the repairs. Understood everybody? So, is provision for bad debts a provision as per Ind AS number 37 or not? Quickly, yes or no? Is provision for bad debts a provision as per Ind AS number 37 or not? No. Why no? No, that is not the point. Provision is a liability, but provision for bad debt is not a liability. Provision for bad debts is decreasing from debtors kada. So provision for bad debts is not a liability, and hence you cannot call it as a provision as per Ind AS number 37, because as per Ind AS 37, provision is a liability, but provision for bad debt is not a liability. A straight question, okay? You are making a sale now. You have given 1 year warranty period. You have created provision for warranty in the current year. Sale, say for example, after the sale 2 years warranty given. In the current year you have created provision for warranty. Is it a provision as per Ind AS number 37 or not? Yes. Because whenever sale is done, your obligation is already erased. It is a present obligation. Whenever you are selling the product, your obligation is erased right from the next moment. Customer next 2 years lo eppudu vachi repair cheyamana kachithanga cheyalsinde. Enduku? Because of sale happened. So obliged event is nothing but sale. It is a present obligation. Clear everybody? See, actually, in days number 37, provision, you should need lot of sense. You have to use lot of sense. Whether is it present obligation or future obligation. Hope you have got different kinds of things in my example now. Understood? So be careful. Judgmental issues will be there in that. So you have to be very, very careful. And contingent liability. So contingent liability, I'll tell you two things, listen carefully. Whether it may become a may or may not become a liability. So present obligation. Present obligation in the sense, pakka it's your liability. But you are unable to measure reliably. You don't know how much amount will be gone. There is no measurement. And hence it has to be treated as a contingent liability. Understood everybody? And the next one is possible obligation. So till now we have done about present obligation. As of now you feel obliged to repay to the liability holder. Or a future obligation. In future liability is arising. But another obligation, possible obligation, may or may not. Likewise we have dealt with bank. Acceptances, endorsements and guarantees. If that person paid, I will not pay. If that person did not pay, I have to pay. A possible obligation. May or may not. What is the concept? May or may not. Shall I proceed further? So now listen very, very carefully. If it is a present obligation, generally it will become a liability. Provided if it is not able to measure at all, then it will become a contingent liability. Listen very, very carefully, everybody, with respect to present obligation. Present obligation plus measured reliably. Timing and amount certain, then it will become general liability. Present obligation plus measured reliably but timing and amount is uncertain, then it will become a provision. Present obligation and can never be measured reliably, this will become a contingent liability. Understood everybody? Now coming to possible obligation. A possible obligation will always become a contingent liability. Possible obligation always become a contingent liability, whether or not it is able to be measured reliably or not, because possible in the sense may or may not. It is depending upon the future uncertain events. If that event had occurred, I have to pay. If that event did not occur, no need to pay. I have given guarantee to you on behalf of that person. If that person repays to you, I will not pay. If that person did not repay to you, I have to pay. So my obligation is depending upon the future obligation, other obligation, and that other obligation will have to be performed in future. I don't know whether it is done or not. Future is always uncertain, and that is not in my control. It is in his control. So contingent liability is a possible obligation which will be confirmed in future upon happening or non-happening of one or more uncertain future events. Understood everybody? So that's what your contingent liability. And just I have already told you the difference between provisions and contingent liability right now itself. And very, very important, provision. So if at all you are having a present obligation and probable that outflow of resources can be done, reliable estimate, measured reliably annanga. But provided the timing is uncertain, amount is uncertain, you can create a provision. And next one, very, very important, provision has to be measured before tax. And listen very, very carefully while considering provision. Say for example, you have created a provision to repay 1 lakh after 2 years. Listen, we have entered into a contract. We have entered into a contract and we are performing the contract. You are in the current year. You have thought that I may breach the contract in the next year and I may have to pay the penalty in future to the extent of 10 lakhs, and I have created a provision in the current year. Possible or not possible? Question kavalante malli aduguta. Performing a contract. If you breach the contract, you have to pay a penalty of 10 lakhs. So business concern thought that in the next year it may breach the contract and hence it has to pay a penalty of 10 lakhs. So it has created a provision in its books of accounts. Yes or no? Why no? Penalties ki provision leda name leda. You can create a provision for penalty also. మీకు అర్థమైందా? క్వశ్చన్ అర్థమైందా? యు ఆర్ పర్ఫార్మింగ్ ఏ కాంట్రాక్ట్, మేబీ నెక్స్ట్ 2 years 3 years 4 years ఎంతో కొంత మనకి సంబంధం లేదు. నెక్స్ట్ ఇయర్లో వయలేట్ అవుతాము అని అనుకుంటున్నాం మనం. ఓకే, యు ఆర్ హ్యావింగ్ సమ్ సోర్స్ దట్ యు విల్ వయలేట్ ఇన్ ద నెక్స్ట్ ఇయర్. ఫర్ దాట్ యు హావ్ క్రియేటెడ్ ఎ ప్రొవిజన్ ఆఫ్ 10 lakhs. ఆన్సర్ మీ yes or no? No. Why? సింపుల్ అమ్మా. It's a future obligation. Very, very simple. Future obligation, ante. But you have already breached a contract. Already breached the contract. So now you have to pay the penalty. So you can create the provision. Because it will become your present obligation. Understood? Now, can the provision be discounted or not? You have created a provision to meet after 3 years. Since you are having a present obligation, you have created a provision which has to be met after 3 years to the extent of 9 lakhs. In the current year, at what price I have to write? No, you should not write it at 9 lakhs. You have to discount the same. Clear, everybody? While discounting, you have to use one standard rate. Government bonds yield rate vadali. Which rate you have to use, Amma? Government bond yields rate. That rate will be given to you in the question. And very important thing is all about, you just need to consider pre-tax, not the post-tax. Which rate you have to consider? Pre-tax. Sir, ante em cheyali? 1 by 1 plus I whole power n. Present value factor. By considering this present value factor, say for example, you got something like 0.932 వచ్చింది అనుకో. So 9 lakhs multiplied by 0.932. Say for example, you got around 8 lakhs 38,000. So you have to record the provision in the current year at 8 lakh 38,000. Logic clear? Provision has to be discounted for sure. Understood? Sir, but this discounting of provision is not there as per accounting standard number 29. Discounting of provision is there only as per Ind AS number 37. Sir, can you create a provision for future operating losses? Ante future lo loss ostundemo ani current year lo can I create a provision? As per Ind AS number 37, you can create the same, but as per accounting standard number 29, you cannot create the same. Understood, everybody? And I wanted leaving this concept, reimbursement. Or else just wait, just within 2 minutes I'll tell you that one also. Reimbursement. Likewise, you have to pay 10 lakhs. Say for example, you sold a watch, and you have given a warranty of 1 year. Now that person had come to you and he is asking to repair the same, but I'm telling warranty cannot be extended on the same. So he has filed a suit on me, so that I have to pay a penalty of 20,000 to him. But it is not my mistake. It is the manufacturer's mistake. Understood, everybody? So I am suing another case on the manufacturer. He filed on me, I filed on him. I have to pay to him, I have to receive from the manufacturer. That is called as reimbursement. I have to pay in our example how much? 10 lakhs. Say for example, I have to receive 8 lakhs. Clear, everybody? 8 lakhs will become like my income, 10 lakhs will become like my expense. So say for example, I am able to receive 12 lakhs. Clear? Can I recognize 12 lakhs? No. Your recognition will be only up to 10 lakhs. Your reimbursement can never exceed the provision amount. Yay, if you receive, account the same after receipt. But now you have to recognize only to the extent of provision amount. Understood, everybody? That is the end of your Ind AS number 37. And just within 2 minutes, I am going to start Esops. And yes, you may take another 10 minutes or 15 minutes to complete Esops. 15 pattadu. Maximum I'll try to complete it in 10 minutes. Okay. If you want to leave, you can leave right now. Okay, let me start the final concept, Esops. Employee stock option plan. You are having 2 types of plans in this. Actually, there are 3 types of plans. Esops, ESPPs, SARs. But you are having 2 types of plans. Esops okati, ESPPs okati. First, I would like to go with ESPPs. Employee stock purchase plan. You are having ESPPs, and also one problem you are having on Esops. Let me start with ESPP. Any doubt or clarified or done? Sure? Sorry. Just listen. ESPP is nothing but employee stock purchase plan. It will be having vesting period less than or equal to 1 year. Sir, I hope you know vesting period. Vesting period, exercise period. I hope you know these things. Assuming that you know these things, I'm teaching this one. Vesting period is nothing but that in that period where the employees have to fulfill the conditions. Exercise period is that period where the employees can purchase the shares. Clear, everybody? So vesting period will be less than or equal to 1 year. Then you will be calling it generally like ESPPs. Employee stock purchase plan. Sir, reserve is created for future or present? Future. If it is less than or equal to 1 year, do you need any reserve? Obviously no. Already we have discussed that employee stock options outstanding account is a reserve. Did you remember? Employee stock options outstanding is not needed to create if your vesting period is less than or equal to 1 year. Clear everybody? Employee stock options outstanding account is not at all needed to create provided if your vesting period is less than or equal to 1 year. Shall I proceed further? So listen very carefully what you have to do now. First of all, you have to create an expense. What is that expense, sir? Employee compensation expense. Say for example, already you know that rights issue will be given at what price? Discounted price. Rights issue will be generally given only to the existing shareholders. But sometimes shares can be offered at a discounted market price even to employees under the scheme of Esops and ESPPs. So market price, say for example 120, but you are offering it rupees 90. And how many options? 1 lakh options. All the employees have subscribed 1 lakh options now. Now what is the entry you have to write? So you are getting some cash, am I correct or wrong? Hey, respond. How much cash you are getting? 90. So 1 lakh multiplied by 90. Clear? Now, sir, listen. If you have issued a share in market, how much you will get? 120. Correct or wrong? But how much, since I have gone under the scheme of Esops, you are paying me 90. How much is my loss? 30. But I don't tell it is my loss. I will tell that I am compensating to all my dear employees. Clear everybody? And hence we will be writing like employee compensation expense. That expense will be borne by the company. That expense will be borne by the company. Because if at all a company had issued a share in the outside market, it is getting 120 rupees. But since I am feeling that employee is in a large group of organizations, I am giving 120 rupees share at just rupees 90, bearing that 30 rupees as an expense. So employee compensation of expense 1 lakh multiplied by 30. To equity share capital account, which is like 1 lakh multiplied by 10. Generally the face value will be 10, and whatever the remaining 1 lakh divided by 110, or you can take it as balancing figure, will be transferred to securities premium. Finally, this is an expense which has to be closed and transferred to P&L account. P&L account or to employee compensation expense account. I'll ask you a question now. Where this employee compensation expense will be shown in P&L account? Debit side ante kodta. Perfect answer. Head you have to tell. What is a head? Employee benefit expense. Did you remember that head? Bonus, gratuity, provident fund, salary, wages, everything along with this employee compensation expense. Shall I proceed further? And very important. Listen carefully. If it is Esops, your vesting period will be greater than 1 year. If it is Esops, your vesting period will be greater than 1 year. You check out how many number of options are there in your hands. Sir, my number of options are like 10,000, or already we have discussed 1 lakh. What is my expense per option, amma? 120 minus 90. 30 rupees is my expense per option. Divided by, check out what is your vesting period. Say if it is 4 years. So how much you are going to get? 1 lakh into 30 divided by 4 years. I have to write off 7,50,000 every year. I have to write off 7,50,000 every year. Hey, did you get my point? What is vesting period here? 1 year or more than 1 year? Here, vesting period less than 1 year or more than 1 year? So total employee compensation is apportioned only in 1 year. But now your vesting period is more than 1 year, that is 4 years. Total employee compensation expense is 30 lakhs for a period of 4 years. So 30 lakhs will be apportioned for 4 years. 30 lakhs divided by 4 years, where you are going to get 7.5 lakh per annum. Shall I proceed? First entry will be employee compensation expense account debtor. How much? 2. Very important. I have to create a reserve. Employee stock options outstanding account, which comes to an amount of 7,50,000. Sir, why you are creating a reserve? Because in future, at the time of subscription of shares by all my employees, I may have to bear an amount of rupees 30 lakhs. For that, each and every year, I am creating 7.5 lakh reserve. Whenever I am creating this 7.5 lakh reserve, 7.5 multiplied by 4 years, which had become 30 lakhs, and it will be saving me at that moment. Understood everybody? Sir, for bonus issue, are you utilizing reserves and surplus or not? Bonus issue, are you utilizing reserves and surplus or not? Even this is also a kind of bonus. 30 lakhs is like bonus. So for that I have to utilize reserve. And don't use P&L account. You create a specific reserve for that one. Use this reserve. Logic clear? Instead of using general reserve, you create a specific reserve for these 4 years and you just use this reserve at that point. So now the next one. P&L account debtor to employee compensation expense account 7.5 lakh. You have to reproduce this for 4 years. And at the end, now these employees will be subscribing. How much, sir? Bank account debtor 1 lakh into 90 they will give. Clear? Now what debit I have to do? 1 lakh into 30. Not easy. Because employee compensation expense is closed every year. You have created a reserve. Now use that reserve. So you have to debit employee stock options outstanding account to equity share capital 1 lakh into 10 to securities premium 1 lakh into 110. Pakka. But say for example only 90,000 employees were subscribed, sir. Remaining 10,000 employees did not subscribe. So at that time we will be telling this one as vested options lapsed. We will be telling this as, sir, if the vesting conditions were satisfied, we will be telling the options were vested. If the vesting conditions are not satisfied, we will tell that the vested option, those are not at all vested, unvested. We have offered to all the employees, if you work with us for 4 years, I will give you 1 lakh options. All the employees worked with me for 4 years. I have given 1 lakh options, but out of which 10,000 options did not subscribe. Clear? Think with common sense. Sir, bank, I have got only for 90,000. Okay. Equity share got for 90,000. Okay. Securities premium got for 90,000. Okay. But Esops, how much I have created? 30 lakhs. 7.5 lakh multiplied by 4 years, I have created 30 lakhs. Correct or wrong? But how much is needed to me? 90,000 into 30, which is 27 lakhs. Correct or wrong? How much is wasted now? So transfer it to general reserve. Because Esops is like a specific reserve, kada. So whatever the balance of Esops is there, Esops, employee stock options outstanding account debtor to general reserve account. Understood everybody? Now, say for example, in the first year itself, 2,000 options related employees left the organization. Clear? If 2,000 options related employees left the organization, why to create an expense on those people? So totally how many options you are having? 1 lakh. Minus how many left? 2,000. Multiplied with 30 per option divided by 4 years. Is the logic clear? Pakka everybody? That's it. So how much ever you will get, you have to go with that one. Just wait. Reason being, ఇంకొక మోడల్ ఉంది. ఆ మోడల్ మీకు కవర్ అయిందో లేదో నేను చెక్ చేయాలి. కవర్ అయింది అంటే ఇట్ విల్ టేక్ అనదర్ 5 minutes. ఎస్. Sir, I have told you directly 1 lakh and 1,40,000. 2 lakhs 2,000 minus 600. You have to wait. That model is covered. Yes, that model is covered. You have to wait. So listen, I'm giving you one final example which will cover the entire Esops. So this is possible only when there are no changes during the whole Esops period. But listen very carefully to the example that I am giving. Originally 1 lakh options are there. During first year, no options left. During second year, no options left. During third year, 20,000 options related employees left. During fourth year, something like 10,000 related options were left. Shall I start now? So check out very, very carefully. If you understood this table and if you have got this table, entire Esops will be done. Even if you want, you can write the table also. Year 1, year 2, year 3 and year 4. First of all, check out number of options remaining. Year 1, how many remaining? Year 2, Year 3 out of 1 lakh, how many went? So balance you are having. Again out of 80,000, how many went? So finally you are having 70,000. Clear with point number 1? And next you need to check out what is the expense per option. I already told you something like expense per option. Did you remember? Sir, as per our example, how much? 120. Exercise, what is it called? 120 is the market price. And what is the exercise price? 90. And automatically how much expense you are having? 30. So expense per option 30, 30, 30, 30. Sir, in some questions you will not be provided like this. Clear? In some questions you will not be provided like this. 120 minus 90, 170 minus 110. Instead of that one, he will tell you fair value per option. Instead of that one, he will tell you. Then you have to take directly fair value per option. Expense per option ante market price minus exercise price. If that is not there, you can take fair value per option. Sir, fair value per option may change in each and every year. 9, 10, 3, 4. You take only those things. Clear? And next one. Listen very, very carefully, everybody. Vesting period. As per our example, how much is the vesting period? 4 years is the vesting period. Now, very important. Cumulative expense. Hey, check out, I'm writing cumulative expense, total expense. What do you mean by that one, sir? Initially, I'm having 1 lakh. Initially, I'm having 1 lakh multiplied by 30 rupees is the expense divided by 4 years multiplied by 1 year is completed. Come to the second slot, okay? I'm having 1 lakh multiplied by 30 divided by 4 years but 2 years completed. Hope you are getting my point because I have used the word cumulative. Next one. How many are there? You cannot take 1 lakh now. Take only 80,000. So 80,000 multiplied by 30 divided by 4 years multiplied by 3 years. Last, how many are there? Multiplied by 30 divided by 4 years multiplied by 4 years. Clear? Hey, wantedly I am changing one figure, okay? Take this one as fair value and take this as 28. Clear? Then what happens? 1 lakh into, instead of 30 you need to take 28. That's it. Logic clear? So now check out how much you have got. 7 lakh 50,000. Entama? 15 lakhs. 18 lakhs. 21 lakhs. I hope you have taken this as 30 only. And meeku computation kosam 28 vaste you should take 28 ani cheptunna. Clear? So take this as 30 now. But if it is changed, you change it. That is what my point. Shall I proceed further? Now listen very, very, very carefully. Expense to be recognized. First year same, 7.5 lakh. This is cumulative. Am I correct or wrong? How many years expense you have taken? For 2 years, how much is there? 15 lakh. Already how much is recognized? Balance how much is there? That's it. Okay, now check out here, okay? Everybody. How much is for the 3 years you are having? 18 lakhs. How much already recognized? First year 7.5, second year 7.5. So totally 15 recognized. So 18 minus 15. 3 lakhs. And same 21 minus 18. 3 lakhs. Clear everybody? Hey, wantedly I am writing here one more thing. Listen carefully. Something like at the year end you got 17 lakhs. Clear everybody? Now this will become negative 1 lakh. Correct or wrong? So now what your journal entry? Very, very simple. Employee compensation expense account debtor to employee stock options outstanding account. 7.5, 7.5, 3 lakhs. Up to this okay. But in the last year negative is there. Am I correct or wrong? Negative in the sense you have to cancel Esops. Negative in the sense cancel Esops. So then your journal entry will become employee stock options outstanding account debtor to general reserve account. Employee stock options outstanding account debtor to general reserve account. Pakka everybody. So please take care with these columns, okay? What is the first one? Number of options remaining. What is the next one? expense per option, that is market price minus exercise price. If needed, you can also use fair value and then check the vesting period, and then 2 columns. What are the 2 important columns? Cumulative expense recognized. This is very, very important. Number of options remaining multiplied by expense or fair value divided by vesting period multiplied by total period. I mean vesting period multiplied by total in the sense completed period. If it is 1 year, 1 year, 2 years, 2 years, 3 years, 3 years, 4, 4. And finally, expense to be recognized. Difference between 2 consecutive years. Okay. And that is the end of your total marathon class on corporate accounting. Thanks for your extended cooperation. Hope the class is absolutely clear to you. Nen munde cheppanu, I have actually gone through the study material and covered for you. So whatever the kinds of discrepancies, if any, are there, I'm sorry for that. And one more thing. So coming to corporate accounting, be careful about Ind AS. నా ఇంటెన్షన్ ఏం లేదమ్మా, బికాస్ నార్మల్గా మీ ముందు సిలబస్ ఓల్డ్ సిలబస్లో ఫస్ట్ అటెంప్ట్ ఓల్డ్ సిలబస్లో స్టార్టింగ్ ఒక 4 years or 3.5 years వరకు స్టాండర్డ్స్ మీద ఎక్కువ కాన్సన్ట్రేషన్ లేదు. హార్డ్లీ వాళ్ళు ఎన్ని అడిగారు అంటే ఒక 4 marks అడిగేవారు, లేదా హార్డ్లీ 6 marks. కానీ ఫ్రమ్ ద పాస్ట్ 1.5 year or 1 year దే హ్యావ్ ఇంక్రీజ్ ద వెయిటేజ్ అండ్ దే ఆర్ ఆస్కింగ్ ఫర్ 15 marks. సో ఈసారి కూడా ఖచ్చితంగా 10 or 15 marksకి రావచ్చు. అయితే హోపింగ్ దట్ యూ విల్ నాట్ గెట్ ఇట్ ఫ్రమ్ Ind AS 19 ఇట్సెల్ఫ్, ఆర్ వచ్చినా సరే మీకు డైరెక్ట్ థియరిటికల్ క్వశ్చన్ వస్తుంది. బికాజ్ మీకు టీచర్స్ టీచ్ చేసేటప్పుడు చెప్పి ఉంటారు Ind AS is totally a very Ind AS 19 is a very advanced standard. CA ఫైనల్ వాడు కూడా చాయిస్ తీసుకునే ఒక స్టాండర్డ్. సో ఎనీవేస్, that's the end of your marathon class. Thank you for your extended cooperation. All the best for your examinations. ఎప్పుడు జరుగుతాయో తెలియవు, కానీ ఖచ్చితంగా జరుగుతాయనే తెలుసు. And hope you have to clear in your CMA inter in this attempt, and immediate గా నెక్స్ట్ CMA ఫైనల్ కూడా అయిపోవాలి అని మనస్ఫూర్తిగా కోరుకుంటూ, all the best for your entire career. Bye ma.